This is the 2022 Yahoo Finance All Market Summit. New challenges, new opportunities. Our world is at a critical juncture. For the first time in decades, there's the real threat of nuclear war, and the economics of so much in our lives has been upended. Interest rates and inflation are skyrocketing. Stocks are stumbling. The political and cultural divide in our country is deeper than ever. The next pandemic lurks around the corner. It's a time of great challenge for sure, but as we fix our problems, as we surely will, it's also a time of great opportunity. Today, we're going to hear from some of the top names in business, public policy, healthcare, entrepreneurship, and a whole lot more. The leaders driving positive change for business and society as a whole. Join us now as we present the 2022 Yahoo Finance All Market Summit. New challenges, new opportunities.
Hello everyone, I'm Andy Serwer, Editor-in-Chief of Yahoo Finance. Thanks for joining us for our 9th annual All Market Summit. The theme of today's event is New Challenges, New Opportunities. We've assembled some of the best guests and conversations ever. Thanks to our sponsors, Northern Trust and Grayscale, as well as all the amazing guests you're about to see. There's no better place to start than with GM CEO Mary Barra, a business leader who arguably more than any other is at the center of the many new challenges and opportunities in our world today. I met her a few days ago in Detroit at GM's famed design center and started by asking her about a brand new business, GM Energy.
One of the things we want people to understand is not only is an electric vehicle your mode of transportation, how you get from point A to point B, but it can also be a power source. And I think that's going to be very important as we look and really strengthen the grid in whatever country we're doing work. And in addition, we can leverage the technology we have, the battery technology, to provide clean energy, energy storage, and also supplement the grid. So we're really excited about the business opportunity based on the Ultium technology that we have.
How big a business can this be for your company, and where do you see it in 5 years, for instance?
You know, we haven't put those numbers out yet, but we see it being a significant growth opportunity for the company. So when you look at, not only are we moving into electric vehicles that we think in the, near to medium term will be growth, because where we have opportunity to, perform better is on the coast. That's where EV adoption is happening more quickly. Then you look at BrightDrop, and we don't really have a light commercial vehicle business, so getting into the electric light commercial vehicle business is growth for us, as is GM Energy. When you look at it being another reason people buy an electric vehicle, but also what we can do beyond the vehicle from an energy perspective.
And you have all manner of electric vehicles out there coming. What GM vehicles are on the road right now that are EVs, and which ones are coming, say, in Q1 of next year?
Sure. Well, right now we have the Bolt EV, the Bolt EUV, which I'm driving. Mm-hmm. We also have the GMC Hummer EV, and we have the Cadillac Lyriq that is just starting production. So that's all out right now. Mm-hmm. I do have to say we've had such strong demand for the Hummer and the Lyriq that, we're into next year from an order perspective, in some cases beyond. But then in first quarter, we'll launch the Silverado EV. And then if you go a little bit longer, into second and third quarter, we'll have both the Chevrolet Blazer EV as well as the Chevrolet Equinox EV. So, when we get to this point next year, we have a lot of models in the heart of the market, the largest segments in the market.
We're here in GM's Design Center. Talk to us about what this means to GM history and also what it means for the future of the company.
Well, this is literally the building and the room where we review new vehicles and look at them from a design perspective, clay models or we have a lot of technology in this room from a virtual perspective as well. So this is where it happens. This is where decisions are made. And it's a vital part of the design process, because no matter how much technology you have on a vehicle, it has to start with being beautiful. And I'm so excited about the new designs we have coming out.
I want to ask you about the economy, and you have obviously a unique perspective because you can talk to your dealers and they can talk to you about consumer demand. Where is the economy right now based on where you sit, and what do you see going forward?
Well, we are starting to see some, changes from a used car pricing perspective, and we're watching and we're seeing, right now it's very hard to know exactly what's happening in the market because, we have been supply constrained for so long, so we know there's pent-up demand, but also there's challenges in the logistics and moving vehicles once they're built. Even we still are dealing with semiconductor shortages, but then when we get to that point, getting vehicles moved to get to the dealers has been challenging as well. So it's really an interesting time. We're watching almost on a daily basis to see what's happening. We still see strong demand for many of our products, especially our full-size trucks and our mid-size crossovers. But again, we're watching all the signs. I mean, I think we're listening to what everyone else is saying around the globe, and so we're preparing next year for a year that will look more like. We have a little, it will actually be more demand, but a little less demand than what we would think, because, we're going to be conservative, make sure we set our cost structure up that way. So then if things turn out better, we're well positioned. But most importantly, because we have so many important EV launches next year, as well as cruise growth, we want to make sure that we can fund our future regardless of where the economy is. If, a downturn, recession, all those words that are being used, we want to be prepared regardless of the environment.
And you're not seeing higher rates impacting consumer demand?
We haven't so far, but again, it's a very unique situation because we've been supply constrained for so long. And so that's what we're watching, because we know a vehicle is a very important purchase that people make, and that they may make different decisions depending on how they feel about their own personal economic situation.
And you mentioned the chip shortage and supply chains a couple times now. And how is that being mitigated? Is it improving? And then what about some other supply chain issues you might have with batteries and the inputs that go in there?
Sure. Well, from an overall supply chain, we do see the semiconductor supply improving quarter by quarter. But we still see more volatility than we're used to. I think one of the reasons for that is the supply chain has been stretched so thin. So we're looking for improvement as we go forward, but it's still there and it's still an issue. As I said, logistics is getting the vehicles moved is another challenge. But then when you look at other supplying for EVs, one of the things that's going to be key to unlocking more Hummers, more Lyrics, and all of our vehicles is the battery plants. And we're actually running the battery plant in Ohio now. And as that is able to ramp up, more cells will provide our ability to provide more electric vehicles. I would also say GM, we actually have signed agreements for the production that we need between now and 2025 to get to our 1 million units in 2025 in the United States, and more than that in China. So we're on track to do that, and we have that supply chain secured.
You just mentioned China. I want to follow up there. You've had such success in that country with Buick. There are a lot of new EVs there. What does the future of that marketplace look for you?
Well, we still think there's tremendous opportunity there. As you mentioned, the Buick brand is very strong, as is Cadillac, and we also have Chevrolet there. But we also have a joint ventureship with Wuling that allows us to sell not only the Baojun brand, but some other vehicles like the Hongguang Mini EV has been one of the highest selling vehicles this year from a Chinese perspective for EV. So we think there's opportunity. We're definitely seeing the landscape change. We're seeing more competition from domestic suppliers, but we think, especially in luxury and with Buick, the strength of those brands, we think is going to remain strong.
I want to drill down on a couple domestic brands, Equinox, for instance, which sounds like a car for everybody, right, with a price point. It's an EV coming out in a year or so. Talk to us about that one. That
comes out in the second part of next year. And what's so important about the Chevrolet Equinox EV is that it's in the biggest segment globally, the biggest segment from a North America perspective as well, and it's about affordability. So if you're around $30,000, you really get into the sweet spot of the market. And we've been really excited because we revealed the vehicle, and people, there's been such a strong positive response to the vehicle. And when people get in and actually get to drive it and see how great driving an EV is, and then they see the technology on that vehicle, it's got a 17.7-inch screen. It has safety features and safety technology. People are going to realize they're getting a great vehicle and able to move into EVs with confidence.
On the high end, the Celestiq.
Yes.
Am I saying that right?
Yes,
It's a sort of a customized Cadillac, right? Talk to us about that one.
Well, so it's a bespoke Cadillac. It really, if you look at what Cadillac means for so many people, people still use the term Cadillac for standard of the world. And we really believe with all the work we've done, not only in our internal combustion with the Escalade V and the Blackwing series and the attention to design, as we move to our all-electric future with Cadillac, Celestiq is going to be the pinnacle from that perspective. It will be hand-built on this site. And, the customers that will be able to customize the vehicle from interior, exterior. So we're really excited. The response for, people that we've really revealed the vehicle to has been very, very, very positive. And so this really is one of the final steps in regaining that standard of the world for Cadillac. And the response has been tremendous across all of our Cadillac products.
Mary, GM stock has lagged a bit over the past year or so, and I'm wondering what you would say to shareholders. Should they buy the stock, hold the stock, own the stock going forward?
Well, I think there's been so much attention earlier this year was how many EVs are you selling today? And we were in a difficult situation because we did the right thing for the consumer and for safety. And when we found there was a manufacturing defect in the Bolt cell, we stopped producing so we could do the replacement cells for our customers. As we've moved through the year, we were able to start building the Bolt again, and we've actually had 2 record months in a row of sales of the Bolt EV and EUV. So I think that impacted the early view. But what I would say to shareholders is take a little bit longer view, because this isn't a one-year race. We are at the very early stages of driving EV adoption. And when you look at the vehicles that we have coming out next year with the Silverado EV, the Equinox, and the Blazer. Again, those are big segments of the U.S. industry, and to have really credible products in that, I think, is going to allow us to grow, and that's why we're confident that we're going to hit our ability to produce 1 million units and see strong demand for our vehicles by the time we're at 2025.
Let me ask you about the workforce here at GM. Everyone's back at work. How's that going? Are you retraining people to work in facilities that manufacture EVs? Talk to us just generally about that.
Sure. Well, one of the things I want to give a big shout out to is our manufacturing, our warehouse, our design, our R&D. They have been working all through. I mean, they were off for a very short period of time at the early days of the pandemic, but they have been at work all along. And so without them, we don't produce vehicles, we don't design vehicles. So first of all, very happy and proud of that team. We are in the process of having people come back to work now. We're going to be communicating more because we've recognized to maintain our culture and to get the interaction. We've hired probably about 10,000 people into the company during the pandemic, and so having those people actually come to work and I call it's that 5 minutes before the meeting starts and the 5 minutes after it ends, that if you're on Zoom or Teams, you just hit leave. But the work that you get done, the integration, the mentoring, the learning, I think is invaluable. So we're going to be having people that have been working remotely start to come back to work. We're working with each of them. It's almost a plan for every person to understand how we do that in each area. But I'm confident that we'll move through that in early next year. We're going to share more with our employees in the next couple of weeks, and we'll have people come back. And then the final question you asked was training. And we actually, on this site, also have technical training. So for especially our manufacturing team, when they need to learn how to build an EV and to do it safely, because if you think about, very different from an internal combustion engine to safely designing, testing, validating, and building and servicing electric vehicles. And there's training that happens right here, but we actually have a senior leader dedicated to make sure we do all that safely and our people are trained.
And charging stations, a big issue across the country. You just signed an agreement with Pilot. How are you thinking about that and how it connects to the vehicles that you make?
Well, charging is the next hurdle. Once people get past range anxiety, and all of the EVs we have coming will be over 300 miles on a charge or more if a person chooses on select models. So the next issue becomes, but where can I charge it? And so we've learned for most people, if they own a garage, they'd like to charge at home. And that's why, for instance, on the Bolt EV and EUV, we are providing assistance or providing the charger for them. But as we look across the country, we know there needs to be more done for the charging infrastructure. And so our arrangement with the pilot company is to put charging at the location, so as people are on a road trip, because Pilot covers most of the country, they're going to have the opportunity to charge. If they're a GM vehicle owner, they'll have the ability to have special discounts and know that they have availability. We're also doing work with our dealers, because if you think about our dealers, they know the communities and very well, and not just to charge at the dealership, but for where do we install chargers in the local community. And so we have a partnership with our dealers that we're investing. Overall, GM is investing $750 million to support a robust charging infrastructure. We're also working with a number of other startup EV charging companies to make sure that charge anxiety is something that people don't have to worry about.
Final question, Mary. Governor Newsom in California has mandated that all new vehicle sales in the state of California after 2035 need to be EVs. Is that reasonable, possible, and what do you anticipate in terms of other states or countries mandating rules like that? Well,
first of all, we're very aligned with what Governor Newsom mandated, because at the beginning of last year, we said our plan is to have all of our light-duty vehicles be electric by 2035. So that's the plan that we're working. So we'll be ready. So your question, is it feasible? Absolutely. I do believe there'll be other states. I know there's other states looking or have already made similar decisions. And we know that's happening in countries in Europe as well. So we're well positioned to meet that challenge. And we think it's the right thing to do.
Mary Barra, thank you so much for your time.
Thank you.
Welcome back to the Yahoo Finance All Market Summit, sponsored by Northern Trust. Reid Hoffman is one of the most prolific tech entrepreneurs of our time, having co-founded LinkedIn and now investing in the future of society as a partner over at Greylock. Hoffman is also a champion of leadership improvement and just doing things a better way. Joining us now is none other than Reid Hoffman. Reid, always nice to get some time with you. Thank you for doing this conference. We really appreciate it. So let's start in tech. You know, the title of this conference is New Challenges and New Opportunities. And I think for the audience watching this, one of their biggest challenges is understanding what is going on right now in tech. We see stories of layoffs. We see stories of stock prices falling. In your community, what's the mood and what might happen next?
Well, one of the things I love about tech is even in capital challenge times, there's always optimism. And so, yes, obviously we've had this kind of 10 plus year bull market, lots of investment all over the place. I think part of what you're seeing is this kind of retrenchment, refocusing, saying, okay, we can't do 7 initiatives or 10 initiatives. We can only do 3 or 5. And that's causing some restructure. I think that restructure is very good for the company. It's very good for the industry. I'm not at all worried actually ultimately about the vast majority of people's jobs, because I think there's still a lot of capital flowing in to everything from startups to large companies saying, hey, technology is part of the future. There'll be some painful dislocation that obviously we should soften that and make that work as well as possible.
How scarred is tech after a year like this? In many respects, I think from an investor standpoint, many have never seen this type of commentary, this type of vibe.
Well, I think it's always, you'd prefer to just be the kind of the simple heroes, the ride in. We built new product services, new technology. Obviously, as technology has become more fundamental through all walks of society and life, you're part of the kind of conversation and melee, which includes not always like, well, hey, is this stuff you're doing with facial recognition tech? Is that scary or alienating? And what should we be doing with it? Other kinds of things as social media and kind of information systems. These discussions I think are good because they're how we figure out what we're doing. And I think obviously you compound that with the economics and it's hard, but I think that it's still, kind of fundamentally like scarred is I think too strong. I think learning, it's kind of what is the kind of old aphorism, what doesn't kill you makes you stronger. I think actually, in fact, generally speaking, I think what you're seeing is lessons being learned and evolution happening.
What's one of the good lessons?
Well, I think one of the good lessons is to stay very focused. I think one of the things that the 10 plus years of bull market has allowed, kind of like, let's experiment with X, let's experiment with Y, let's experiment with Z, let's just try lots and lots of things. And I think one of the things is say, it is good to innovate, it is good to do new things, but let's go like intensely. It's almost like some of what we learned from Steve Jobs at launching at Apple. It's like, focus on a couple of things that you're launching really intensely and trying to make them as good as possible. And I think that's kind of one of the lessons for investors and executives and employees, and in terms of, don't kind of like spread out like spaghetti all across the field.
You know who seems really focused, Reid, and it's an executive I'm sure you know very well. That's Satya Nadella. Now, he's speaking at our All Market Summit too, but here's someone that is, I think, stayed laser focused. Of course, great brand, but it seems to be doing a lot right in a very challenging environment.
I think that's 100% correct. I mean, Satya is, I think, one of the great executives of our time. I think the kind of ways that he's going, look, Microsoft obviously has tons and tons of opportunity. How do you focus on building and taking what Satya calls, borrowing from the industry terms, Carol Dweck, et cetera, growth psychology to earn your trust with your consumers, trust with your partners, and be very, very focused on that. And so I think one of the things I've had the honor and pleasure of being on the Microsoft board, working with him on this, is to see, kind of like, okay, we're going to do X, we're going to do Y, we're not going to do Z, and we're going to change these other things to being much more limited and focused in terms of how we're operating.
I mentioned on the intro that you are trying to change society, and I really do think you are. Let's start with transportation, and let's start with Convoy Trucking. You were an early investor in that company. Where are they now? What does their valuation look like, and what do their forward plans look like?
Well, just like any public market, well, they're not public, but any kind of scale technology company, valuations are always a little bit more pressed from the reset of the public markets. That's the index of everything. But they're doing a great job. Their shippers kind of find that the flexibility and the use of mobile phones to track and schedule and do everything and to coordinate with the drivers and to be able to get a much larger fleet. A lot of the convoy drivers are, kind of family-owned, 1 to 5 trucks, and to be able to get those into the really good shippers and the good shipping lanes are all working really well. I think they're doing a great job of kind of like, how do they innovate on, and this is one of the funny things from being a software guy, about physical things like, okay, how do we have trailers so that we can drop the trailer off, make it efficient unload, but pick up another trailer and immediately go on to the next job, and programs like that, which are all kind of a funny form of innovation. But of course, we live in the world of atoms, not just in the world of bits. And so those kinds of innovations are also part of what are simple innovations to the efficiency of the whole system.
Another potential winner is Joby, a company you're very familiar with, an early backer there as well. I know they're not helicopters, but take us through this play and what are they trying to disrupt? And when might we actually see these flying over our heads sometime?
Well, I hope within a few number of years. Joby's now a public company, so reports on all this stuff in the schedules and in its public filings. And it's funny because part of your questions are revealing like I've become somewhat of a not just the how do we transform the network of professionals with LinkedIn, or the network of travel with Airbnb, but also now the network of transport, because you got, convoy with trucks, but you also got like, how do we take how we're working with cities and make them 3D so that now, as opposed to like, how do you get to the airport in a environmentally friendly way, not with the vagaries of traffic, and how do you essentially add this third dimension to commuting, to and from the airport, to and from other transport, across places where bridges would otherwise be kind of super tight and have like these traffic congestion points. How do you ease all this up? Because by the way, as you begin to get the kind of the flying in these electric cars, the Jetsons, helicopters, in an environmentally friendly way, it will also help everybody because of the ease of congestion. And so, obviously, I'm looking forward to being able to ride in one. We're still in a place where it's only test pilots, but they're super quiet and they're super safe.
So the goal is there to create an Uber for the skies.
Yes, exactly.
So I know AI is very near and dear to your heart. Elon Musk, he's trying to roll out, you know him, he's a good friend of yours, trying to roll out these robots, I think Optimus robots, to just help make things, I would imagine, faster. Is that a reality? Are we looking at a future where the factory floors are things that look like me, just in robot form?
I think that's a when, not an if. Although I also am a great optimist on how a lot of the kind of AI technologies are actually going to be human amplifying. I mean, we already see this as you automate factories more. There's a lot more jobs for humans as well. Now, obviously, the productivity goes up of like, for example, in Amazon and sort of package coming out of the factory per kind of per human being there. And so you up productivity. That's, of course, how productivity is generated and society benefits from it. But I think there will be a lot of roles for humans, too. But I do think this kind of humanoid robot, once you're beginning to get the software right and all the AI and the things that like OpenAI and Microsoft and other folks are working on, that will actually, in fact, create great enhancements and amplifications on the factory floor as well.
What are the dangers to having this type of technology walking around?
Well, I don't think people normally kind of worry about things like kind of like military, like autonomous weapons and that kind of thing. And I actually think those worries are not as significant, are not the real worries. I think the real worries are hands of AI and bad actors, cybersecurity, other kinds of things like that as the kind of key things. So on the humanoid robots, I think the real question is, how do we transition as society? Just like when we move from agriculture into manufacturing, and now we have 4% of the workforce in agriculture where it used to be 80%, how the workforce will begin to transform again when you have these kind of AI amplifiers in manufacturing and other kinds of things, and robot amplifiers. what does that new world look like, and what does the transition look like? Because the transition from agriculture to manufacturing in the cities was actually quite painful. Hopefully we can learn from history and make that easier and less challenging.
Let's dive into, before we run out of time, on leadership, another topic that you are very, very passionate about. I follow your LinkedIn page extremely closely. I really enjoy your posts on this, but what are you telling the next generation of leaders now, the companies that you are invested in? They have had a challenging year. 2023 is shaping up to potentially be challenging, at least in the first half. What's the best advice you're giving them?
Well, it's roughly around the things of take the challenges and convert them, which are painful, you wouldn't have necessarily selected them, and convert them into making your company stronger, making your relationship and trust with your customers stronger. So you do kind of restructures and you do refocusing early in it. You bring your company along. If you have to do a reduction in force, you do it compassionately. I think Brian Chesky at Airbnb has shown how to do that. Kind of as one really, really good example. And what you do is you don't do it as a, like the market's doing us to this, or you do this as this is our chance to learn and be better and stronger as an organization, and as we play a role for our customers and society.
When you talk to folks, do you see mistakes popping up, that there's a common thread of things that they shouldn't be doing in this environment, but are now starting to creep up?
Well, some of it is is only playing defense versus offense. So only kind of worrying about like the downside as opposed to how do you strengthen. Another is sometimes making changes too late and kind of just hoping that, because, look, the market will, in the future return to kind of, after you kind of this kind of contraction will return to, paying attention to the future, and technology swings more intensely with that to both positive on the upside and more challenged on the downside. And that will happen, but make the decisions early. Not doing it in as a compassionate way, which is to say, how do you say, whether it's Brian Chesky or Reed Hastings or others, how do you say this as compassionately to employees and families as you're making these changes as possible? Those are kind of, I'd say, standard things that people should pay attention to in this. And then obviously the specifics depend on the specific company, the specific industry, the specific people. Lastly,
Reed, one question from the Yahoo Finance ecosystem that they were curious about from you. LinkedIn, in its present form, is this what you always imagined it to be?
Well, I'd say we're still on journey to what I imagined it to be. And Ryan Roslansky and the team are great innovators and leaders of this. I think we're just at the beginning steps of how like learning plays into it. We're at the beginning steps of how do you use your network to get news and information in addition to kind of job opportunities and recruits and sales. I think we're just at the very beginning days. And matter of fact, just 2 weeks ago, I was chatting with Ryan about some interesting things about like what we might do next year, the year after. And so I'd say my hope is the best is yet to come.
Do you want to share them?
Can't, unfortunately.
Fair enough. Well, Reed Hoffman, we will leave it there. Thank you so much for your time. We greatly appreciate it. You're always gracious with the folks here at Yahoo Finance. We'll talk to you soon.
Great. Thank you.
All right, we want to get a quick check of the markets here, and we are in rally mode. We see the NASDAQ is up over 2.5%, and let's take a look at the three-day price action because this has been an on again, off again, risk on, risk off rally. It happens to be risk on right now, but investors really getting some whiplash. Here's the Dow. It's lagging a little bit today, but I think 1.88% investors will take that. That's good for 560 points, and we want to take a look inside the market because we have seen some of the mega caps leading early on today. We're seeing that with tech, that is advancing by 3% after getting whacked last Friday. That is followed by consumer discretionary, materials, real estate, financials. Those are rounding out the outperformers. So nice to see that risk rally on. And here's the NASDAQ 100. And we can see Tesla up over 3.5%. So is Amazon. So is Microsoft. Alphabet catching up with them. NVIDIA up over 4.5%. Now we got to get to bank earnings because it is earnings season. After JP Morgan last Friday, we have Bank America this morning. And let's see, we got it up 5 1/3%, it looks like. Let's put a year-to-date chart. I do have some numbers for you. Net income, well, actually, let's take a look at this. We got net income, it fell 7.9% to $7.08 billion, or 81 cents per share. It did beat analyst expectations of 78 cents per share. Company-wide revenue rose 7.6% to $24.5 billion, and that is more than analysts forecast, $23.6 billion. Also, loan loss provisions, they had to increase that for credit to $898 million, and that is following a $523 million buildup in the previous 3 months. And just one more statistic here, net interest income, 24% to the north side to $13.6 billion. And I think that is because of the yield curve. We didn't get a chance, but bonds backing off some of those huge moves that we saw last week. So is the U.S. dollar. So I think markets are just running with this little easing in financial conditions, however long that may last. Here on our travel page, we're seeing Trip.com. That is up 5%, followed by Hilton. That's up about 2.5%. Airlines and cruise lines seem to be in the 2 to 3% range. And we want to take a look at our meme stocks. We have Nokia up over 4%, Hood up over 5%, and I'd be remiss if we didn't check out our crypto before we go. Bitcoin up over 2% over the trailing 24 hours, and we will be right back.
Coming up, from the desktop to the cloud, how Satya Nadella reestablished Microsoft as a dominant player in the tech industry. He joins Yahoo Finance's All Markets Summit right after the break.
Right now, the worst place to be is stuck in between. Accelerate your investments or pull back. Change the plan or stay the course. That's why Northern Trust is here. With specialized expertise, a history of success through every economic climate, and proven strategies rooted in data and analytics, giving you more control, clarity, and confidence. For now and whatever's next, Northern Trust Wealth Management.
Satya Nadella has been Microsoft's CEO since February 2014 and chairman of the board since 2021. Nadella transformed Microsoft from a stodgy tech giant to a new force in software and cloud computing. He isn't just a tech savant. Nadella also led a cultural revolution at Microsoft, putting people and ideas first. That leadership and vision put Microsoft back on top in the tech world and gave it a rare $2 trillion market cap to boot.
Satya Nadella, Microsoft CEO, thank you so much for joining us. As you know, we're doing the All Markets Summit. I kind of want to jump in with a question on just the general economic climate that you're seeing right now. Obviously, we're talking about rising interest rates, inflation. You know, one of the questions that we're asking a lot of the CEOs is whether or not they're seeing signs that we're going towards recession. I kind of wanted to get your thoughts on that.
First of all, it's great to be with you, Dan. And overall, we definitely see constraints in the macro environment that are leading to customers and everyone sort of essentially asking the question on how do we drive productivity? I mean, at some level, when we think about software and technology, this is in some sense showtime for enabling any company to be able to do more with less. And so when I think about even, let's say, what's happening with cloud migrations, right? Cloud migrations were super critical during the pandemic, even for resilience. And now cloud, if you're not on the cost frontier of the cloud, then you're falling behind on productivity. If you're not on the efficiency frontier of cloud native applications, you're falling behind on productivity. If you're not able to use the hybrid work infrastructure to bring everybody to be able to sort of participate, collaborate inside the organization, you're falling behind. So this idea that everybody now needs to really, show the results of productivity, do more with less, whether it's the operating expenses and the leverage there, or even your capital efficiency. So that's what, in some sense, is, I would say, with all the macroeconomic headwinds, which I think all of us face, none of us are immune. The tailwind, at least we as a company have, is our ability to deliver these solutions. That, software is ultimately the biggest deflationary force businesses can use to tame all of the forces that are there for around inflation.
Well, that's something that I kind of want to touch on as well. Is Microsoft itself having to make adjustments? And then what kind of opportunities do you see in the current economic climate?
Yeah, the opportunity I see is for us to be able to take that entire stack, whether it's cloud infrastructure or the cloud native databases and application development or something like Power Platform, right? I mean, that's a great example of how you can involve everyone inside your workforce to help with automation and drive productivity up. And of course, everything that we're doing with Microsoft 365 and Teams in helping customers just really deal with what does productivity and collaboration look like in a hybrid work environment. So we are definitely seeing tailwind there. We are seeing share gains there. We feel very, very optimistic about our own ability to deliver value to customers and do well in the marketplace. But I think at the end of the day, even, by the way, that also applies to Microsoft. We are applying it ourselves inside, right? How can we be more efficient? And whether it's in our people operations or in our R&D, or whether it's in our finance and our supply chain. So I think you'll see us use, in some sense, take our own solutions and deploy them as efficiently as possible to drive productivity and leverage in operating expense and capital efficiency. Capital efficiency is another one. One of the things that I'm seeing a lot of businesses, I mean, take the energy crisis that we have, in particularly more acute in Europe right now. Multiple things, right? If you move to the cloud, by definition, you have the most efficient use of the scarce energy resource. Second, let's take a manufacturing plant. If you create a digital twin of a manufacturing plant, one of the benefits is you can make it more power efficient, right? Because you can do the simulation to do the power draw that's most efficient. In fact, you can reduce waste as well. So overall, things of that nature, I think, are going to drive up productivity.
I want to talk about kind of the idea that we're moving towards a hybrid work environment. I know that's something that Microsoft has talked about. You mentioned it earlier. What are you seeing there as far as customers moving to a hybrid work environment? Are they continuing to do so? And will that stick around?
Yeah, in fact, we just released some data, called the Work Trends Index, which is sort of survey data that's got good cross-section of customers, geographies, industries. And there are 3 points, Dan, I would say that sort of stand out, right? The first one is what we call the productivity paranoia. Basically, 85% plus workers or the members of the workforce think that they're being productive. 85+% of the managers think that there's more to be desired on productivity. So there's that paradox. And I think the best way to bridge that paradox is not to have more dogma, but more data. Things like Viva Pulse can help everyone get to the same data. And more importantly, something like Viva Goals and OKR system can help everyone align, right? So instead of this being some kind of an argument, let the data really help us move forward. The second one is people come for other people, right? People don't come to work or any place because of policy. They come because of the connection they want to have with other people. So that I say that we all have to learn new soft skills as even leaders to facilitate those moments where people can come. And of course, even tools like Viva Connections and so on can help. And then the last thing is, just because you had an offer and you recruited somebody doesn't mean you don't need to re-recruit. And so this is where, again, everything about what you as a leader can do to re-recruit employees, help them with even their own career progress, right? One of the things that we are seeing is, skilling. I want to be able to come in. I want to be able to make progress in my profession. And so anything that we can do to help show that we are re-recruiting them and then energizing them, I think is all going to be very, very helpful. And so a lot of what we have done, in particular with Microsoft 365 Teams and the product suite called Viva, are all focused on that. But at the end of the day, these are tools. What is required is a little more enlightened management and leadership and skills that all of us have to learn.
You talk about the productivity paranoia, and I know that's something that some employees are touching on now, where they're nervous that if they don't go in 5 days a week alongside their colleagues, then they'll be left in the dust. I guess, how can organizations kind of avoid that for lack of a better term, discrimination against workers who are fully hybrid or fully remote?
Yeah, see, this is where I think one has to have really outcomes that need to be measured and goals that need to be aligned, and then having that data around them really define what's working or not working. We're not saying, obviously, you remember even during the height of the pandemic, 50%, 60% of the global workforce was showing up at work because the frontline workers don't have an option of not being in the front line. So we are talking about knowledge workers primarily who are, there's a structural change, and everyone's exercising that flexibility that they had during the pandemic now in the post-pandemic world. So I think the way to manage that would be to really make sure that you're very clear as leaders and managers about what the goals of the company are or the team are, setting the norms for how people collaborate and communicate, because you can't sacrifice ultimately what you have to deliver to your customers and your constituents. But then ensuring that the flexibility is not being misused, but it's in some sense, it becomes a competitive advantage for you because the tools are there. So one of the things at least we're trying to make sure everyone knows is between Microsoft 365 and Teams and Viva, I feel that the tools are there for one to really make hybrid work productive.
I guess one question that I want to touch on is diversity at Microsoft. Obviously there's a big push there as far as trying to expand the employee base. What are some ways that Microsoft is working on that, and what kind of benefits does it see as a result?
Yeah, I mean, to start with sort of the core business case, I mean, if you want to empower the world, you need to represent the world. So in some sense, Microsoft's own goals around representation are all about ensuring that we have a very diverse workforce that then allows us to build the products and services that, empower the world, which is our mission. In order to go make progress on it, one of the things that we do is really create transparency around these goals. In fact, each year we publish the report. We're just, getting ready to publish our next report for the year where all of the data is available. And one of the things I also like is each year we publish more data. So there's more transparency. The data, that also comes with metrics that you set. We have a clear set of goals. In fact, compensation, even at the highest level, including mine, are triggered by us hitting these goals. Niccol. So overall, I feel that we have the right process, but a lot of progress that needs to be made. And one of the things that we're also focused on is not just about bringing people in, it's also about the inclusion, right? The culture of inclusion is an everyday exercise, right? It doesn't matter what happened yesterday, but what is the lived experience of every individual, right? Aggregate data sometimes, it doesn't really represent the lived experience for any individual. And so that's continuous process. You can never claim anything. All you can at least do is to have a culture that allows every leader, every manager, and every employee to have both the confidence as well as the introspection capabilities to say, let's just push and make sure the diversity and inclusion are key priorities for us.
And I just want to ask one last question. As far as Microsoft in the cloud, it's clearly one of the leaders in the industry. How is that kind of helping with all of these various objectives, whether it's ensuring employees feel like they're wanted, eliminating that productivity paranoia, and then helping to help companies deal with the current economic climate?
Yeah, I mean, to me, the idea that digital technology is got transformative capabilities, I think, are very clear. Everybody recognizes that digital, even in this macroeconomic headwind, no one's sort of looking at their IT budget or digital budget as the first place to go to cut, because they realize that coming out of this constrained economic environment, they'll be stronger if they use technology to drive productivity. So very specifically to your point, people are looking to say, am I on the right cost curve? That's where something like cloud infrastructure is massive, right? Because after all, you only pay for what you consume. I mean, there cannot be a more capital efficient way to run things than the cloud economics. The other way is if you're not building cloud native applications, I mean, just to put it in perspective, right? If you are just doing application development like you did even 3 years ago, 4 years ago, and are not using some of the things like the container technology or some of the stuff like our Cosmos DB, it's like 100x different in terms of efficiency. Or using tools like Teams and Viva to drive hybrid work, because after all, that's a reality we all face. So I think in each layer of this technology, you want to make sure that you are on the right cost curve and you're using the best tools to drive productivity and your ability to do more with less. So that's what's exciting for us. We know that this is a great time, quite frankly, to be having all of these conversations with customers and also making sure that we're delivering for them.
All right, Microsoft CEO Satya Nadella, thank you for joining us.
Thank you so much, Dan.
Up next, how record executive Steve Stoute is empowering artists and sending shockwaves through the music industry.
Steve Stoute is the founder and CEO of United Masters and Translation LLC. He's a music industry pioneer and advertising entrepreneur who has produced albums for Mariah Carey and Nas and led production for Gwen Stefani and Enrique Iglesias. With funding from Alphabet, Apple, Andreessen Horowitz, and Disney, Stoute's companies operate at the intersection of technology, culture, innovation, and storytelling. Steve, thanks so much for joining us. You've been in the business back when they were trying to legislate hip hop. And back then,
yeah,
if you
trying to legislate it now as well.
Still, yes.
Yeah.
And if you didn't have a contract, you just couldn't break into the business. Prince talked about being independent. It didn't take on. Now we have artists talking about being independent.
Yeah.
What happened?
Well, I think when Prince said it, nobody really understood what he meant. He was way ahead of his time. He's a visionary. He's a visionary musically, and he was a visionary on understanding the music business. And in fact, he changed his name to the artist formerly known as Prince to get out of his contract. And I think just in general, people thought it's Prince, it's eccentric, not that it was actually a fundamental business reason why. And over time, people really started to understand the value of ownership. They can own your name, they own your likeness. It's in the recording contracts. That's the fundamental understanding of a recording contract, is that they own you. And as music has gone digital distribution, and TikTok and Instagram has become the new MTV, and Apple Music and Spotify has become the new record store per se, and radio, the value of a record company is absolutely diminished. And that's where United Masters come in, because we connect the artist and the creator directly to the distribution platforms.
Now, I went to CultureCon, and Lena Waithe talked about the correlation between show business and the music industry. And in it, I was asking about generational wealth.
Yeah.
And she talked about, she's like, you realize that even now, she's like, we give away our intellectual property.
Yeah.
But she said, we don't even get money from residuals from streaming.
No.
So this whole same thing where you have a lot of people who are talking about going independent, and particularly now with the pandemic, we had so many, what they call a gig economy, people going independent. How do you see this coming up? Like particularly with corporate, you talk about the studio industry, we're talking about corporate America.
Yeah.
This whole kind of like move, and they're talking about the Great Resignation towards, no, I need to become the master of my own fate.
Yeah, well, so there's a couple of things that I'd like to discuss. So Lena is correct. If you don't own, you can't create generational wealth. That's the whole, you have to have an asset to pass down. You have to have an asset that keeps putting off money and putting off value or creating value in order for you to pass it to your siblings and pass it to the next generation. So if you sign a record deal and you give away those rights, I mean, you have nothing to pass down. You have this short-term financial gain of the money they gave you to purchase those rights. I think what you've seen is this sort of shift as generations have evolved, where we've gone from the indentured servant to slavery, to the employee, to ownership. And I think that's where we are. And just sort of the work in the cycle of value creation is like, I don't want to be an employee. I just don't want to be an employee anymore. I want to own. So even if you work at a company, you want equity. And if you're a creator, you definitely want to retain the value of the intellectual property that you created. So that's just the evolution of the way things have evolved. And that's a good thing, because those stories that we all grew up on watching, I don't know if it was the 5 Heartbeats or whatever tragic, story of a creator who created something and then looked up and ended up, they didn't own anything, and that their name and their likeness and their work was gone, are not stories that people want to replicate anymore. These next generation of creators are entrepreneurs, and that's actually exciting for me to go from being in the record business and not understanding, as a record executive, actually economics of the business. And I tell a lot of people who are friends of mine that work at record companies, they work there, they don't realize that what they're doing is empowering these companies to take these rights. But as I've evolved as a person, we're able to build this business to help provide these opportunities, you're seeing it opened up a lot of eyes. And that's why, you know, out of all the things that I've done in my career, I'm really most proud of United Masters, because it's not about me. It's about helping the next generation of artists own themselves.
Going to United Masters. So I just remember, you know, people growing up, if they grew up on MTV and making a band, like I said, there was this big thing about people weren't talking about ownership. It's like, I want the chain.
Yeah.
How does United, people had the chain, but
the jacket, anything.
It's too short.
Some symbolism, some short-term symbolism. Yeah.
Nothing that you said that was an equity or asset. And I think Too Short rapped about, you know, it doesn't matter if you had $80,000 car, but you lived in your mom's basement.
Yeah.
How is United Masters helping these independent artists come into their own and own their own stuff? What does it do?
Well, the first thing that we're providing is a very simple interface so that you can distribute your music. And, you know, when you go through us, you don't have any issues about ownership. It's yours. You retain the rights, period, right? So we're first providing that. That's just distribution. On top of that, we also provide brand services. Okay. So we have a company, Translation, that works with some of the greatest brands, the NBA, State Farm, AT&T, and many others. And between the brand side of the business and having the artists, we actually make connections. And we've created a marketplace where the brands and the artists connect. Brands want to be on the front end of understanding culture. These artists are creating culture, so there's obviously a synergy there. And we put that together at scale, whether it be sync, so you're watching a commercial or you're watching a feed on social media, the music behind that feed, we're trying to provide all that through our independent artist network. So we're providing artist distribution plus brand opportunities to underwrite a lot of the things they want to do, go on their first tour, shoot their videos, whatever they want to do. We have brands that are helping underwrite that and putting money in their pocket. So it becomes distribution plus opportunity, which no one else in the marketplace even comes close to providing those services.
So you talked about distribution plus opportunity. You started off in the record industry. Why did you make the switch into branding, advertising with Translation?
That's a long story, but it started with, oddly enough, I worked on the film Men in Black, the soundtrack Men in Black. And it was one of these things where the glasses sold 14 million, and the album sold 10. And the glasses not only sold more, but we were a big reason why the glasses were selling, but we got no credit for it at the record company. And I was like, I'd much rather, if we can create culture and then somebody else monetizes it, I'd much rather be on the side that monetizes it. So it wasn't a coincidence. I knew that music actually creates cultural moments that then creates consumer behavior, contagious consumer behavior, where you got it, I want to buy it, like you got that haircut, I want that haircut, that kind of thing. And I went on the advertising side. The company that did the product placement to put the glasses in the music video and all that is a company that I first went to, and I left the record business and I wanted to learn the advertising business, and I learned it. And then in 2004, I left and I started Translation, and I've owned the company since 2004. I can't believe it's been
That's
almost, it's 18 years, 17, 18 years.
So we talked about branding. One of the things that I want to bring up is in 2020, after George Floyd, a bunch of companies, Black Square, were involved in ESG, environmental social governance. We care about social justice.
Yeah.
However, it is now 2022 and we've had more cases since George Floyd.
Yeah.
How does this whole branding, ESG?
That's it. And the DEI, diversity.
Yes.
Right. Diversity offices and stuff. You know, it's sadly enough to say that every time something happens, you see industries. I could talk about the advertising industry for a second. They always say, oh, we got to do better. And then they just go right back to what they were doing before. And I wrote a lot about this because unless the brands say, unless you have a certain amount of people that are diverse, or this is your employment requirements, then why would I be in business with you? I hold you to a standard. Unless it affects your money, These brands, these agencies, specifically on the creative agency side, they're not going to police themselves. So then they go around and they go, and on the brand side, they go, oh, we're going to put a black square. Like, that's not going to do anything. A black square means nothing. That's not commitment. That's commitment to somebody, a social media manager, just making a square black. What are you going to do about the infrastructure on your hiring process? What are you going to do about your board? What are you going to do about your marketing campaigns, and how inclusive are they? Like, those are the infrastructure things that need to be checked. And unfortunately, what I've seen over and over again is that this stuff, when it's in the top right-hand corner of the Washington Post or the New York Times, everyone cares. Then as soon as it dissipates and something else comes up, like the war in the Ukraine, all that stuff just goes to the side. So nothing really changes. I'm doing the best that we can. At United Masters, at my companies, we're hiring, we're fully diverse. Like, I'm committed to that. But I've always been committed to that. Like, it's not a new thing. The commitment is real. And there are some brands that I will say that has done a really good job and have reached out and said, I want to do better. I'm trying my best to do better. Show me the way. And I'm proud of those partners. Google is one of those partners. Apple is one of those partners. There's some brands like the NBA that is absolutely, Adam Silver believes that is core in diversity. So there's some, but then there's others that honestly, they visit the subject right when the sun is shining on them. And then as soon as it goes away, then they go back to business as normal. Yeah, normal, usual, that kind of thing. And it's sad because you really do want your board and your marketing to reflect society. You become actually a much better business when you have diverse thoughts at the table. You become.
Thank you.
I mean, you're a much better company. It makes it better to have those. It better. Like, you have, but like, it's almost like the nepotism is so strong that you choose nepotism over outcome.
Thank you so much, Steve, for shining a light and coming to AMS and sharing these words with us. Hopefully our independent artists who are watching are listening and learning, and also those creators out there who want to become their own employer.
That's right. Well, thank you so much for having me. Such a pleasure. And I love the fact that you asked me those questions, because I can't not talk enough about helping our people. I can't talk enough about helping independent artists and providing them the tools and the education to own their future.
Thank you.
Thank you.
The global pandemic resulted in booming business for the healthcare sector. LabCorp CEO Adam Schechter is here with his vision for the future of this industry. That's next.
Welcome back to the Yahoo Finance All Market Summit. We're speaking here now with a longtime healthcare executive who's running one of the world's largest clinical laboratory networks. It is at the forefront of the testing and diagnoses for various diseases and conditions, including COVID-19. Joining us now is LabCorp CEO Adam Schechter and Yahoo Finance's David Briggs. Welcome, guys. This is going to be a fun conversation.
It's great to be here. It's nice to see you in person. Finally.
I know.
Finally.
I guess the pandemic's over, right? We can just wrap this up and go home.
I wish it were over.
Well, speaking of, I think it's clear that the first thing we have to start off with you today, obviously, is just what's the market looking like right now? COVID, we know that, PCR testing, those testing sites closed down. That was a huge boon for you guys. But where do you go from here? Have you been able to return?
Well, first of all, we learned a lot from the pandemic, and we learned a lot about innovation, about science, about technology. We learned about scale. So at one point, we were able to do over 300,000 COVID tests a day. Since that time, we're doing less and less COVID tests. And as we sit here today, we're doing less COVID tests than what we did at the beginning of this year. But the real question is what's going to happen as we go into the flu season. We've seen an increase in COVID cases in Europe, and that typically is an indicator of an increase coming to the United States. So at LabCorp, we're prepared to run as many tests as we need to. We currently have more capacity than we need, but we're going to make sure we do everything to get people through the upcoming flu season.
Are you anticipating a surge over the holidays in cases and ideally in testing?
I would assume, based upon what we're seeing in Europe, that there will be an increase in cases and testing required as we go into the end of this year. We'll be prepared for it. Let's hope we don't need it, but I want to make sure that we have the capacity just in case we do need it.
So for that capacity, you're maintaining that, and you plan to maintain that, especially for COVID, for some time?
So we're maintaining about 4 times more capacity than the current number of tests that we're running, and we always want to stay at a significantly higher number that we can run versus what we are currently running. So we'll continue to watch the cases. If they go us, we're going to increase our capacity again. What we've learned is we can scale quickly now. So we'll be prepared for whatever we need to do as the United States go through the winter and flu season.
Good to be able to surge up and down. What about the at-home testing part? That's something that at the very beginning you weren't necessarily very big on. And of course, as you mentioned, innovation, that's something that now we see is a huge market, and people are maybe more willing to take tests.
Yeah, I think people, if they don't need to go to the doctor's office, they prefer to stay home. And if they don't have to be exposed to other people that are either sick or may have COVID, they'd rather stay at home. So we launched LabCorp On Demand, and you can now run over 100 different types of tests from your home. Either you go online and you can order the tests that you want, and then you can collect the samples at your house, send them to us, we'll run the test and give you the results. Or in some cases, you can actually order the test, go to one of our service centers, our phlebotomist can take the blood for you and give you results. So we are seeing people more and more apt to do at-home collections, and we want to make sure of 2 things. One, that we continue to communicate with the physicians, because we believe that the physicians are so important to the healthcare of the patient. But at the same time, if patients want to do some testing on their own, we want to make sure that we give them the results, not only in an accurate way, but in a way that they can understand the results.
It was, for many reasons, a devastating pandemic, not just for the economy, but for families around the world, and still is. How significant a silver lining were the advances, though, in diagnostic testing? And what do you think is the best application when we come out, officially out of this pandemic?
Now, that's a great question. And I think the world has a better understanding and appreciation of diagnostic testing today than it did before COVID. And what we've learned is that people want to know more about their health, and not just in the United States, but around the world. And we learned that the science and the innovation and technology that we've brought to the US has applications around the world. So we're going to be bringing more of our innovative tests globally as we go into the future. But what we've learned from COVID is that you have to be aggressive and you have to challenge the big scientific issues. Our scientists are remarkable, and the things that they did for COVID, I don't think anybody would have dreamed they'd be able to do. They were just met with these big challenges, and they found a way to be successful. We now need to do that in cancer, in Alzheimer's disease, and in other areas. So for example, for cancer, right now, if you want to see what type of cancer people have, sometimes you have to do surgery, take a piece of the tissue of the organ to understand that. Our hope is in the future, we'll be able to do that with a blood test. And those are the types of things that we're trying to figure out.
A biopsy.
Instead of a biopsy, we're trying to find a way to do it through a blood test.
Extraordinary. How close are we to that?
We're still years away, and it's going to take a lot of science and innovation. But there are some tests today that are called liquid biopsies that are beginning to give us an understanding of how we can move forward and get better and better at doing it in the future.
I wonder, we've talked about all the positive and the growth, but obviously, number one, you had to scale up and down with staff for COVID. Yes. And secondly, LabCorp really had a really big market when it came to business and employers.
Yes.
How has that shifted with work from home, with the difference in drug testing? You know, we've seen a push for legalized marijuana as well. So how has that all come together in terms of shifting how the business functions?
Yeah, no, it's a great question. And once again, I think COVID had many unintended consequences in the world, whether it be children that had to study from home for a period of time, whether it be parents that no longer wanted to go into the office. Leaders had to change. I mean, hopefully I've become a different leader, and I hope a better leader than I was before COVID. But we've learned to have to be more empathetic and to understand that our customers are going through a hard time, that our employees are going through a hard time, that almost everybody around the world is having difficulties based upon what's happening in the world today. So I think we've learned a lot about leadership and how to lead through these difficult times. What we've also learned is that you can't be stuck in the way your business ran in the past. You've got to be open to new ideas, to new ways of doing the business. Things that if you would have asked me 4 years ago, can you actually have these jobs done at home? I would have said, no way. We've learned you can. And in certain instances, we've learned we can do things remotely that we weren't able to do before. When it comes to hiring and finding ways to get people employed quickly with our work that we do with employers, we found that a lot of employers are much more distributed now than they were before. So we have to find ways to interact with them as opposed to going on site, but do it through things like at-home testing and so forth.
Testing, when it comes to, you guys are heavily involved in drug testing. Cannabis, marijuana was mentioned there. There is a multi-trillion-dollar quest for a roadside cannabis test. Are you guys looking at that?
At this point, we've not pursued that, but we continue to look at every test where we think we can bring science, innovation, technology to make a difference. So in the future, there may be an opportunity for us, but not at this point.
So explain to me this at-home market opportunity, because it seems like on one hand, you know, there's this push for non-clinical spaces, and by that I mean the retail pharmacies and, you know, more retail outlets for people to find your tests, or the at-home option. And one of the biggest conversations throughout this pandemic has been health equity, and this plays a huge role in that. Who has access? Because I know there's a statistic about, you know, every human or every American lives within, or 90% of America lives within 5 miles of a pharmacy. Well, that's, you know, 5 miles. No one's walking 5 miles, right? Yeah. So put that in context of this prospect of an $8.5 billion market by 2030. Yeah. And what stake, you've been a leader in testing so far. What stake do you think you're going to have in this market?
Yeah, so the first thing I say is health equity is important, and it's something we all have to pay attention to. And to be honest, there were things we thought we were doing great when it came to health equity, and through COVID, we learned a lot. So for example, we thought by sending kits to people's homes, if they have COVID, we can make a difference. But there's a lot of people in this country that don't have homes today. So there was no place to send the kits. So therefore, we had to find mobile ways to get kits available to people in other parts of communities. Like you said, people live within 10 miles of being able to get a sample to LabCorp, but 10 miles is a lot for a lot of people. So we continue to look for new innovative ways to ensure that we can bring our testing to everybody across the country in a fair, equitable way. There's still work to be done there. The at-home market's going to be interesting, Anjali, because I think COVID has changed things a bit. Typically, people said, I want a highly accurate test that I can get the results in a day or two, but that is fully reimbursed by my managed care plan. For COVID, they said, give me the result as fast as you can. I'll pay whatever it takes in order to get what might not be the most accurate result quickly. I don't think that's going to be the dynamics as we move into the future. So we have to be careful with some of the learnings from COVID and how it may apply to other diseases in the future. So I still think the at-home market is yet to be defined and determined, and there's still a lot more work we have to do.
Is the best practical application flu testing at home?
So we have flu testing at home. We have a combination test of flu, RSV, and COVID, all in one test for an at-home test. I think that's a great application because a doctor can ask their patient to be tested without having to come to the office. But for something like cholesterol or diabetes, the question is that a good use of at-home testing? And I'm not quite sure yet. We'll have to see that over time.
What about broader costs for this? So on one hand, you have, inflation, kind of a big issue. And then on the other hand, you have a lot of focus on healthcare costs broadly. With this pivot to at home, you have, individual tests being shipped out. Is it as cost effective? Are we looking at, you're able to kind of shift things so it's not increased cost for the patient?
Yeah. So the first thing I'd say is I think healthcare costs in this country and almost every country around the world is a very significant issue that's getting worse by the day. Whether it be the United States or it be parts of Europe, we are spending more in healthcare today than we were prior to COVID, and those costs are increasing. We have to find a way that what we do in healthcare, including diagnostics, helps reduce cost. The good news is diagnostics is about 3% of healthcare spend, but over 90% of decisions are made with some type of diagnostic test. I think that we can show through prevention of disease, detection of disease earlier, things like liquid biopsies in the future for cancer, that over time we can help reduce healthcare costs. I think it's incumbent upon all of us in healthcare to find ways to help the United States and other parts of the world reduce cost.
One thing to help in that capacity would be identifying Alzheimer's earlier, and you mentioned that earlier when we talked here. Where is the science on that, finding an early biomarker? It doesn't get the attention, certainly that COVID does, and really that it should. Where is the science on that?
So it's still evolving, and there's no doubt that Alzheimer's disease is one of the most significant issues in the world. Every one of us knows somebody that suffers from that devastating disease, and it costs trillions of dollars in cost around the world, not just for patients that have the disease, but for caretakers and other people that are caring for people with the disease. So we are dedicated, we are spending a significant amount of energy and resources in research and development to help find better biomarkers for Alzheimer's disease. Also, some of our pharma colleagues are working on new potential drugs and treatments for Alzheimer's disease. I think you need both of those together, because it's not enough to tell somebody that they could get Alzheimer's disease. You need to tell them they could get Alzheimer's disease, and there may be a treatment or things that they can do about it in the future.
You've seen the controversy of the FDA approval process when it comes to Alzheimer's drugs. What do you make of that?
Yeah, I have a lot of faith in the FDA. I think the FDA is one of the best regulatory, if not the best in the world. And I think it's just a lot of complicated data that they work their way through. We saw some new data that looks promising, and I have no doubt the FDA will do its due diligence to decide whether or not that deserves to make it to the market in the future.
You mentioned just a moment ago the idea of costs increasing generally in healthcare. I know during the pandemic we also saw hospitals and other clinical settings where people weren't coming in to get those tests, and so it was really squeezing those healthcare settings. Do you anticipate that you're going to feel a little bit of that squeeze with the reduction in people going to get care?
Yeah, the first thing I'd say is that our frontline healthcare workers are the true heroes through the pandemic. The people in our hospitals that came in every day, they are the heroes of the entire pandemic, our frontline workers. But there's no doubt that hospitals are suffering right now, and it's very difficult. You see in their quarterly earnings how difficult the environment is for them. I think as a country, we have to do everything we can to support what I believe is one of the best healthcare systems in the world. So I do believe it's going to be hard for them. I do think that we're going to have to find ways to support them. There may be some impact on our business, but overall, our business is very broad, it's very global, and it's not just hospital-based, it's also physician and other healthcare professional-based. So I think we'll be okay. I do worry about our healthcare system in general.
Those hospitals, like just about every profession in this country, are seeing an employment shortage. Dire. Are you seeing that across your business and the 100 countries, frankly, that you're in?
Yeah, so we are seeing a shortage of workers across many aspects of our business, and I think it's across many aspects of all businesses. So we're doing everything we can to attract, retain, and develop the employees that we have. And there's no doubt that the hospitals and other parts of the health system are feeling that same pressure. You do see it in other parts of the world, frankly, and I think it's something we're going to all have to figure out how to deal with.
More acute here?
No, I would say there's other countries that it's equally acute in, but I think there's multiple reasons for it. There's some people that don't want to go into an office or into a hospital or into a service center any longer, would rather try to find ways to work from home. I think there's a whole host of issues that we're trying to solve for there, but it's something that as a healthcare system, across all of healthcare, we have to solve together.
Definitely. And when we're talking about the whole world, obviously that's something that we didn't touch on a lot right now, but talk to me about the global trends. Do they all kind of align with what you're seeing in the US when it comes to this at-home testing as well? Or is it different, especially in remote areas or places that you don't necessarily get a chance to get medicines to?
I think it's a bit different, frankly. I was in Japan a couple of weeks ago, and I've gone to Japan for 25 years. They have a terrific healthcare system. They were interested to hear about at-home testing. They don't typically have that. But the first time I've been there in years where they've actually were asking questions about what did we do for COVID, what did we learn? And when I would talk about the at-home collection, there was certainly some interest there. So we'll see.
I imagine, universal healthcare systems or government-run healthcare systems would be a little bit easier to deal with when it comes to that kind of a market, maybe.
Well, I think they all have their nuances, that's for sure.
Nothing's easy, right? All right, well, Adam Schechter, CEO of LabCorp, thank you so much for joining us, including David Briggs, here today.
Good to see you. Yeah, such a pleasure to be here. Thank you.
Up next, his company created the vaccine for COVID-19. Moderna CEO Stéphane Bancel tells us how the life-saving technology is a game changer for future medicine.
Welcome back to the Yahoo Finance All Market Summit. Moderna has had a historic rise from a small biotech to a major vaccine player in the past 2 years. The company just inked a deal with Merck to license its cancer vaccine candidate and has a growing pipeline targeting other diseases. Joining me now to discuss all this and more is CEO Stefan Bancel. Stefan, thank you so much for joining us once again. Absolute pleasure to have you with us at this summit.
Thank you so much for the invitation.
I want to start off with the news. Obviously, that deal with Merck, really big game changer for you guys when it comes to just the trajectory of the company. You're no longer on your own. You're no longer just a COVID company. Things are moving along. Tell us about this deal.
Yes, so we're very excited that Merck decided to exercise their option on our personalized cancer vaccine. You might recall we've done a partnership in 2016 where Merck funded the manufacturing infrastructure for cancer, the phase 1 and the phase 2 that is still ongoing. The phase 2 full readout will come in Q4 this year, so we're talking a couple months now. But Merck decided recently to exercise their option so that we're going to be 50-50 profit share as partners. As you know, Merck is the leading company in immuno-oncology. The product is being tested in combination with Keytruda, and it's really, I think, hopefully the data is positive when it comes out in Q4, but it will be very transformative for patients because that's a personalized product we make for every human being, starting with the sequencing of their DNA. So that could potentially be a total game changer in cancer.
Yeah, and this, I know you've been waiting for me to ask you about anything but COVID, right? At this point, you're just like, please ask me about more than the COVID vaccine. Well, now's your chance because I also want to ask about all the other candidates you have in your pipeline. You do have an RSV candidate that you've been pursuing, as well as a combo flu and COVID candidate. So talk to me about that and where we're looking, especially for respiratory diseases that we know are still on the horizon for this winter. What are you looking at when it comes to the timeline for these other candidates?
Sure. I mean, as you say, and as you know, Moderna is a platform company, and unfortunately, most people know us about COVID. We're very, of course, thankful and grateful for the ability to help that we've had during the pandemic and still now with the Omicron booster. But Moderna is a platform company. So let's start with vaccines, where indeed, in addition to the annual updated booster, for COVID, we are going to get in Q1 of 23 our phase 3 data for flu. And we have feedback from the regulators like the FDA that study should be enough to file for the conditional approval of a product. So we could have a product for flu on the market in the fall of 23 and in a few countries around the world. Then, as you say, RSV could also come around Q1 timeframe. This one is a bit more difficult to know because it's a case basis. So we need to have people basically contacting the disease like we had in the COVID phase 3 study. But that should come in the Q1 timeframe according to current epidemiology analysis. And then, of course, the combination. As you know, we are working with a COVID plus flu in a single dose, also COVID plus flu plus RSV in a single dose. So you see Moderna really pushing the vaccine portfolio for respiratory disease, but also for latent viruses, those viruses that once in our body are in our body forever. We're working on HIV, we're working on CMV, EBV, the virus causing mononucleosis, for which there is no vaccine on the market. So we are trying to build a very large franchise around vaccine. Then we spoke about cancer a minute ago. And then another big news that we shared at our annual R&D Day in September last month was some early indication. I think we need a couple more months, but it starts to look good in rare genetic disease, where we inject mRNA IV going into your liver to basically give the instruction to the kids that have that genetic disease of a protein that you and I have in our liver that makes us not sick. And so we think it's a very large opportunity as well. Those products should move very quickly to the market because you do your phase 1-2 directly into patients. You do not go in healthy volunteers. And if you have a good signal in the clinic, you go very quickly into a pivotal. The regulatory agency helps you to move fast because those kids have no hope. There's no treatment today on the market for those diseases. So that's a third pillar of Moderna. And as you know, our partners at Vertex have said that before the end of the year, they will file to the FDA an IND to go into the clinic with yet again another fourth technology for Moderna to inhale mRNA, in this case against cystic fibrosis. So you can see the company's vertical expanding, and in each of those verticals, because we have a platform, the ability to scale very quickly.
Absolutely. Talk to me about that, because it seems like not only do you have the pipeline and the platform, but also now you have a robust manufacturing network. So how does that play in with what you built up through the pandemic to what you can now do?
And that's an excellent question. Indeed, COVID accelerated the company by around 5 years in terms of manufacturing infrastructure. As you know, we today have a plant in Norwood, Massachusetts, in Switzerland, but we're also building in Canada, we're building in the UK, we're building in Australia and in Kenya. So a very strong network across the world. And so now we can scale this platform. As you know, the pharmaceutical industry is a world of analog medicine. If you look at any great pharma company or great biotech company, there is no correlation between two of their assets because the chemical structure is very different. Well, in case of Moderna, all of our drugs are made with the same technology. We just changed the order of a nucleic acid, the code of life, the 4 letters of life, like software is made with zeros and ones, and we go at it again. If you look at it today, we have 26 vaccines in development, 26. That is almost as large as the entire vaccine in clinical trial by the rest of the industry combined. And you're going to see us doing the same in rare genetic disease. If we have good data with Vertex in the lung, you will see us bringing many more drugs against lung disease. And again, the cancer vaccine is yet another example of what can be done with mRNA that you could not even think about with other technology, which is we make a drug for every human being that's different. You could not do that with a small molecule.
Yeah, absolutely. So tell me about that, because obviously COVID set up the company to do more. You had the validation with getting your first commercial product out there, and everyone still, unfortunately, like you said, just knows you as the COVID company. But you are now, with relationships with the FDA, you are able to get some of these candidates further ahead. But there also is some competition in some of these sectors, such as RSV, such as cancer. So do you feel like you've set up the company now that you're at a position where you can compete with some of these traditional players?
Definitely. I mean, if you look at it in terms of R&D scale, with 46 programs, we have more programs than most biotech company and looking like a kind of mid-sized, large pharma company. We have many dozens of drugs that are in the lab right now that I will expect in the next 12 to 24 months to move into development. So could I see a world in the next 12 to 24 months where we have 100 drugs in development? I think it's highly possible. And we have a capital for it. We shouldn't forget Moderna has around $17 billion of capital, which is an incredible number for a biotech company only 10 years old. And so we are already accelerating. And I think that from a manufacturing standpoint, as we discussed, we have a very broad commercial network. And then in the countries, we are today present in 11 markets, the top 11 markets in terms of EBIT margin around the world. We're opening another 10 countries this year. And so we're going to be basically present in most countries, and where we're not directly present, we're going to use distributors. And so I do think Moderna is getting ready to compete with large players like we have done in the vaccine front. If you look at it, J&J had a vaccine, Novavax had a vaccine, AstraZeneca had a vaccine. And at the end of the day, the mRNA technology showed the superiority of a product and the ability to update the product with variants very quickly, which is why mRNA is the de facto technology now for COVID.
So talk to me about the COVID market now. You're still in it. It's still a significant portion of revenues, right? So you do have to still pay attention to that. Talk to me about the global market. You just mentioned all the countries you're in. I know there's also a lot of focus on the health equity aspect, and Moderna has a track record of slowing down clinical trials to ensure equity, to opening up the doors for the mRNA hub in Africa, and also distributing at low tiered prices. So how do you see the company now with all these other candidates playing within that same realm? Do you see this continuation, and do you have the room to continue distributing to low and middle income countries as well?
Sure. I mean, those are great questions. So first, the commitment that Moderna has to fight COVID forever, because as you know, the virus is not leaving the planet, is unconditional. We believe we have a massive public health responsibility to always update the vaccine to bring the best possible science to protect people. We believe people are going to need once a year a booster. As you know, this year it's a bivalent. It has 2 mRNA in the dose. But if in the future we need 3 mRNA, 4 mRNA to give the breadth of coverage, we will do so. That is our commitment. And then, as we discussed, we're going to combine this with flu and other respiratory virus to make it easier for people to get strong, broad protection against many viruses. Also to reduce healthcare costs. As we know, when you go to get different vaccination, the cost of administration is a big part. In some hospitals, it's actually higher than the cost of a vaccine. So I think there's a big role we can do there. And in terms of low-income country, actually this morning, we've announced an extension of our partnership with COVAX for 2023. We think it's really important that the vaccine is available at cost for low-income countries. As you know, the plant in Kenya that Moderna is building with our own capital is yet another proof of our commitment to low-income country. And so we want the products to be available to people around the world, not only people in America.
I'm glad you brought that up. I saw that announcement. And I wonder, when it comes to the mRNA platform, let me get nerdy with you for a second here. The mRNA platform does have that quick, very strong efficacy that we saw, but also does wane, as do most protection. We do see that with the antibody titers. But is this something that you are looking at? Is it something that needs to be changed or tweaked about the platform to give longer, maybe more stable protection? Or is this just how the technology works?
So I think we should not forget with COVID, which is the virus has changed a lot. And if you remember when the virus was mutating very slowly, like Alpha and Delta in 2021, you saw great performance of a vaccine. We should not forget that with Omicron, the genetic drift was so gigantic in only one step that I think no vaccine with no technology would have been able to hold efficacy of infection strongly, because it's linked to antibodies, and antibodies wane with time. That is not linked to mRNA, that is linked to our immune system as humans. The piece that is very important to see is that despite the lowering of efficacy against infection, the efficacy against hospitalization and deaths are still very, very high. Mm-hmm. And that's because, as we believe, there is very strong T-cell immune memory component in terms of the technology. So I think it's a bit like flu. You know, you need to get annual flu shot, not because the protein technology is not good. I believe it is really good, but because it's a different virus. And so you need to re-educate your immune system for this different virus, especially if you are high risk. Again, a 25-year-old who doesn't get an annual flu shot, are they going to die? If they have no comorbidity, highly unlikely. But a 60-year-old person that has a comorbidity factor needs their booster because their antibody is a very important component of their protection.
Right. So I'm so glad you brought up the annual flu shots, because we know that the one question that everyone has is the COVID vaccine going to become that? Is it going to be an annual COVID booster for a very long time to come, or maybe for the rest of our lives? And how do you merge that with the fact that there's already low uptake of this new variant booster?
So I think it's interesting. The uptake is actually stronger than seasonal flu from the data I've seen recently. So we'll have to see toward the end of the season, what does it look like? It's the first time we're going to be more in an endemic setting than a pandemic setting. So I think we'll be smarter in a month or two. But the current data show that it's a better uptake than seasonal flu shot. And I think it's going to be like the flu, which is, again, if you're 25-year-old, do you need an annual booster every year if you're healthy? You might want it to protect other people. You might want it because you don't want to get sick and miss work or miss a vacation or so on. But I think it's going to be very similar to flu, where the key is going to be people at high risk, people above 50 years of age, people with comorbidity, people with cancer and other conditions, transplant. And that's really important to think about. And if you look at it around the world, that is 1.5 billion people. So it's a lot of people that are going to need an annual booster, and people that are younger are going to have to decide for themselves what they want to do. I mean, the example I always use is myself. I've been taking a flu shot for the last 20 years. I just turned 50. So in my 30s, in my 40s, I took an annual flu shot. Is it because I was worried of being hospitalized? Of course not. I just didn't want to be sick. I wanted to be able to work. And I believe that the best thing we can all do in medicine is prevention. And vaccine is one of the most amazing healthcare tool will all happen. So I took a vaccine against flu, so I did not get sick, and so I could, have a normal life and work and take my vacation and be with my friends and family.
Something we all want to be able to do, especially during the holidays. CEO of Moderna, Stéphane Bancel, thank you again for joining us today.
Thank you for the invitation.
Coming up, he's finance's Dr. Doom. Famed economist Nouriel Roubini joins us next with his take on the state of the global economy. Nouriel Roubini is a best-selling author and economics professor at New York University's Stern School of Business. He doesn't consider himself a pessimist, that his warnings about global economies have earned him the nickname Dr. Doom. And Roubini's predictions have been spot on. Among other events, he foresaw the global financial crisis of 07 and 08. Because he's been so right, everyone from pundits to policymakers wants to hear what he has to say. As the New York Times put it, he's the seer who sees it coming. Roubini's new book, Megathreats, is sounding the alarm about the next great crisis, which he says could be bigger than anything we've seen before.
Nouriel, great to see you. Congratulations on the new book. I guess Megathreats, a little bit gloomy and doomy, but realistic, as you like to say. You have 10 megathreats that we're facing, and I want to get into all of them. But I was struck by the very last two sentences of the book, which says, fasten your seatbelts. It's going to be a bumpy ride through a very dark night. So just collectively, is the picture right now really that bad?
Well, I just spent the last few days in Washington for the annual meetings of the International Monetary Fund and the World Bank. And there are people literally starting to talk about the risk of World War III, literally, because we are in a geopolitical depression. One of the many mega threats in the book is one that we have now a confrontation between US and the West on one side, and a number of revisionist powers. It's not just Russia, it's China, it's Iran, North Korea, and even Pakistan, in effect, is an ally. They're essentially challenging the economic, social, and geopolitical order that the US and Europe and the West created after World War II. We have a Cold War, and there's a chapter of the book about the new Cold War, but the risk right now that this Cold War eventually ends up into a hot war. There's already a hot war in Russia and Ukraine. This conflict can escalate and get NATO, the US, and allies involved. It's a risk. Russia is seriously threatening using tactical nuclear weapons. The negotiation between the US and Iran on the nuclear deal are not going anywhere. And Israel is saying if they're going to become nuclear and they're one step away from it, we're going to attack them. We'll have another major shock. And look what's happening between US and China on the South and East China Sea and Taiwan and so on. We are also, unfortunately, on a collision course with China. So right now is a Cold War. It's getting colder, and the economic consequences are severe. Deglobalization, decoupling, fragmentation of the global economy, deglobalization, balkanization of global supply chains, trade in goods, in services, in movement of labor, capital, technology, data, information is going to be split. We're a divided world, and there's going to be a world in which there will be more inflation, less economic growth, because instead of producing the most efficient parts of the world, we're now talking about friendshoring, about secure trade rather than free trade.
That is a fairly gloomy picture, and there are 10 mega threats in your book. Let's talk about economics, though, first. Stagflation, which, of course, is inflation and a stagnant economy at the same time, which we saw in the 1970s, but you said that what we're going to be going into right now makes that look like a walk in the park. Why is that?
Well, we are having, like in the 70s, a number of negative supply shocks, 3 of them currently. One was the COVID shock that led to a shutdown of economic activity, bottlenecks in global supply chains, reduction in the labor supply, and so on. Second one was the Russian invasion of Ukraine that led to a spike in energy prices, food, fertilizers, industrial metals. And third one this year is the continuation of the zero-tolerance COVID policy of China. Those have led to a reduction in growth and an increase of cost of production. And with loose monetary and fiscal policy have caused inflation and now a sharp slowdown of growth. We're headed towards a recession. However, in the book, what I point out is that the era of great moderation, where growth was okay, inflation low, 2%, is over. And now we're going towards an era of what I call great stagflationary and debt instability and crisis. On the supply side, there's not just the 3 negative supply shocks. In the book, I identify 11 other ones that are more medium long term. They're going to reduce potential growth and increase cost of production. Just to be brief. First of all, deglobalization and protectionism. Secondly, reshoring of manufacturing from low-cost China to high-cost Europe and US. Friendshoring. 3, aging of population, not only in advanced economies, but also in major emerging markets like China, like Russia, like South Korea, and so on. Young people produce and save and consume less. Older people don't produce and save. That's inflationary. 4, we are having restriction to migration. In the past, migration from south to north, from poor to rich, was keeping a lid on wage growth. 5th, we have decoupling between US and China. 6, a broader geopolitical depression. 7, we have now climate change that in many ways creates a reduction in growth and increases the cost of food, of water, of energy and fuels and so on. Additionally, we have other shocks. We have cyber warfare. We have pandemics going to be becoming more frequent and more virulent because of climate change. Climate change causes more zoonotic diseases. And finally, we have a backlash against liberal democracy and populism of the extreme right and the left, because there is a rise in income and wealth inequality. Authoritarian, aggressive autocrats, populists of the right and the left are coming to power. They blame the rest of the world and they go to war, like it happened in Russia. We're also weaponizing the US dollar as a tool of national security and foreign policy. That oiling system of the global international monetary system is breaking down, and that's going to lead to more friction, more cost of production, less economic growth. So on the supply side, these are 11 factors that are medium long term. And on the demand side, we're under a mountain of debt, not just public debt, but also private debt. There's a debt trap. So central banks have no option but monetizing these fiscal deficits. And like in the 70s, we have negative supply shock. We monetize fiscal deficit, we end up with inflation, recession, stagflation, but we end up also with a debt crisis. Why so? In the 70s, we had negative supply shocks, but debt ratios in advanced economies were low, so we didn't have a debt crisis. After the global financial crisis, we had a debt crisis, mortgage debt, housing, banks, but we had a negative demand shock and a credit crunch, so we had deflation. So we could have massive monetary and fiscal easing. Today, we have the worst of the 70s with negative supply shocks and the worst of the post-GFC period, where we have right now debt ratios that are higher than ever in history.
Let me ask you a question.
So we're going to have a stagflationary debt crisis.
Right. Often recessions or downturns are caused by a lack of demand, but you're saying that this could be caused by supply constraints. Is that correct? How
Absolutely.
Unusual is that?
Well, in the 1970s, we had 2 negative supply shocks. One was the Yom Kippur War between Israel and the Arab states that led to a spike in oil prices in 73. The second one was the Iranian Revolution that led again a spike in oil prices. This time around, the spike is not just in oil prices. It's in oil prices, it's in natural gas, it's in food, it's in fertilizer, it's in industrial metals. Semiconductors. Global supply chains have bottlenecks that have not been resolved. The zero tolerance policy of China is leading further to these supply bottlenecks. And as I pointed out, these are just in the short run: Russia, Ukraine, COVID, China. There are 11 other forces that are medium long term that are all of them also negative supply shock, reducing growth, increasing the cost of production. And with loose monetary and fiscal policy, they lead to inflation, recession, therefore stagflation.
Now, another problem you see out there, also an opportunity, is artificial intelligence. A lot of people are pinning a lot of hope on AI, but you see potential downside there.
Yeah, the downsides are that while AI, machine learning, robotic automation increases the economic pie potentially, it also leads to losses of jobs, of labor income. And initially people thought will be only routine jobs that are mechanical, like some kind of low value added blue collar jobs. But increasingly right now, even cognitive jobs that can be divided in a number of tasks are also being automated. And even creative jobs. There are now AIs who can create actually a script of a movie, or make a poem, or write art, or paint, or even a piece of music that soon enough is going to be top 10 in the Billboard magazine chart. We're getting to a point in which AI is going to disrupt massively all sorts of jobs. Just to give you one example, it's only a matter of time until we're going to have autonomous vehicles. It's great, because there are about 300,000 people who die every year of car accidents, 2 million who have serious injuries. If we can even reduce that by 99%, social is a great thing. But you have what? 5 million Uber and Lyft drivers, 5 million truckers and Teamster. Their jobs are going to be gone for good. Which kind of jobs they're going to get? Initially, people were in agriculture. Then they move into industry. Then they move into services. Now, most of the automation is occurring in services, including transportation.
Let me ask you about deglobalization, because it seems to be a big theme, and it's obvious there's a lot of authoritarian regimes in the world which are cutting off the WTO, all those agreements. Why is that? What is it in the human being's mindset that goes from democracy to authoritarian and back and forth, it seems, over time? Why does that happen?
First of all, there is a backlash against globalization because globalization led to benefits. The economic pie grew, but like technology, it led to winners and losers, and we did not compensate or give new jobs to the losers. Lots of people in low value-added industry, but now even services are losing their jobs and income. That's why there's a backlash. There are also environmental issues. Now there is geopolitics, like friendshoring and secure trade, and so on and so on. I think that the rise of these authoritarian regimes of the extreme right and left, and by the way, it's Putin in Russia, is Erdogan in Turkey, is Kaczynski in Poland, is Orban in Hungary, is Meloni now in Italy, is the Swedish Democrats right now that just won in Sweden, is the Brexit decision. It was on the right, of course, the election of Trump. And there are also populists of the left. In Argentina, there used to be populism of the left. In Venezuela, but in the last year, in Peru, in Chile, in Colombia, and most likely in the elections in Brazil, populists of the extreme left are going to come to power. I think that is driven mostly by economic malaise. When there is a rise in income and wealth inequality, and we've seen it across the world, in advanced economies, emerging markets, those who are left behind. It doesn't matter whether they vote for the right or the left. Those who vote for the right are usually socially and religiously conservative. Those who vote for the left tend to be liberal. But on economic issues, they're nativists, they're nationalists, they're against migration, they're against free markets, they're against the forces of economic reform. Why? Because they're left behind and they blame the elites, economic, financial, political, for leaving them behind. That's why there is a severe economic reason behind this backlash against liberal democracy and extreme populism of the right and the left. But as we know, populism of the right and the left doesn't lead to economic opportunity. Eventually leads to inflation, stagnation, and financial disaster and default.
How worried should we be about the US-China relationship?
It's a very serious issue. I believe that we are already for sure in a Cold War, and we'll have a decoupling between US and China, trade in goods, in services, in the movement of labor, of capital, investments, but more importantly right now, everything is important is having to do with technology, data, and information that is, from a national security point of view, severe and important. So the decoupling is occurring. The Cold War between US and China in terms of overall political and geopolitical relations is becoming worse. And the reason why Xi Jinping right now is seeking a third term and possibly a fourth is not because he wants to pass to history as the man who reformed China, it's because he wants to pass to history as the man that united mainland with Taiwan. So I believe the next 5 to 10 years is going to be the time where there's going to be a confrontation between US and China on the issue of Taiwan, and that could be a trigger of this Cold War becoming a hot war. We don't know whether it's going to happen, how it's going to be resolved, but that's where we get to World War III, among other things. But in some sense, World War III has already started. It started in Ukraine, because this conflict has broader implications that going well beyond Russia and Ukraine. It's the beginning of something else.
You didn't mention climate change, so I'm assuming you're not worried about that.
Well, there's a full chapter about an uninhabitable planet, about climate change. And it's a long discussion, but the reality of it, there's a lot of talk about doing something about climate change. There's a lot of talk about ESG investment, environmental, social, and governance, and so on. But the reality is a lot of it is greenwashing. A lot of it is green wishing. A lot of it is green fig leaves of people who say we're going to do something. Governments, firms, individual, they're doing nothing. Glasgow and COP was a total failure. At the current level, we're headed towards an increase of temperature by the end of this century of 3 degrees. Even 2 will be a disaster. 3 means that half of the world will be in places that are either underwater or too hot to live. And if you worry about a few 100,000 migrants from Central America moving here, wait until there'll be not a few 100,000, but millions or billions of people who have to move from places that you cannot live to other parts of the world. That's going to be an economic and financial disaster.
All these mega threats, Nouriel.
Yes.
What can we do about them?
Well, in the book, after the 10 chapters where I discuss them one by one, in each one of them there are solutions. There are 2 paths for the future. One is dystopian, and the other one, what I call utopian or less dystopian. In the dystopian one, of course, all these things feed on each other, and there's an interaction between each one of them, and then we end up into essentially disaster. We can destroy each other with a nuclear war, with geopolitical collapse, with climate change, with financial meltdowns, with the collapse of liberal democracy, with pandemics, and you name it. There's another part in which we have policies at the national level and international level slowly resolve this problem, and therefore the future maybe is not utopian, but we avoid the disaster. It's still a challenged future. It's one that has lots of trouble, but we manage it. However, in the epilogue of the book, after this 11, 12 chapter, I say, from my point of view, I believe that the dystopian one, as of now, is more likely than the utopian. So the utopian, of course, is the desirable one. The question is whether there's a political will, domestically, internationally, to cooperate and collaborate to avoid the oncoming meltdown and disaster. I fear not.
Quick two-part last question. What do you think of the nickname Dr. Doom, which is what people call you, number one? And number two, are you ever optimistic?
First of all, I usually say that I'm Dr. Realist, not Dr. Doom, but it's more catchy to be called Dr. Doom.
Okay.
And I think that warning about the risk is very important, because until now, we've been kicking the can down the road. We've been sticking our head under the sun like ostrich, and right now we're facing major mega threat: economic, monetary, financial, social, political, geopolitical, environmental, health, trade, and technological. And unless we address them, we're headed towards disaster. So it's worth to have people like myself who warn you about the risk, and for every problem there is a solution. But at this point, we cannot keep on kicking the can down the road, because we're reaching the point in which these things are going to materialize in a way in which, not only in the next 10 years, each one of these mega threats that I discuss about the next decade is materializing today. If you look at them one by one, debt, inflation, stagflation, environment, geopolitics, pandemics, and you name it, things are happening today. So we have to worry about it today, not about the future.
Nouriel Roubini, thank you so much for joining us.
Coming up, new challenges present new opportunities. How Yahoo CEO Jim Lanzone plans to take this internet pioneer into the future.
Jim Lanzone is the CEO of Yahoo. With more than 20 years of leadership experience in technology and media, he's built a track record of driving growth and innovation. In a world where internet companies come and go, Lanzone sees big opportunities for Yahoo, which is still one of the most popular websites nearly 30 years after it was founded. Before coming to Yahoo, Lanzone served as CEO of Tinder, the highest-grossing non-gaming app in the world. He was also president and CEO of CBS Interactive and the first chief digital officer in the history of CBS.
And let's welcome in Jim Lanzone into the Yahoo Finance studio. Your first time.
First time. I'm a rookie. I'm glad to finally be here downstairs from my office.
Welcome. I know we work in the same building. Don't always get you down here. As we just pointed out, you have been at the helm of some major companies that I think a lot of viewers are familiar with. CBS Interactive, Tinder, Ask Jeeves if we want to go back. But I want to start with a company that I think some viewers may not be as familiar with, which is eTour.
Oh, wow.
And that is, of course, a startup that you founded back in the 90s. And it was right in the middle of the dot-com boom. And I want to start there because I get the sense in looking through a lot of your interviews that your experience in the dot-com boom, the ensuing crash, has really informed a lot of how you think about operating these companies. So my question to you is, how do you think about that period of time? And knowing what you experienced then, how do you view what's happening today, especially in the tech landscape?
Yeah, I mean, it really is a great question. And again, I want to say I love being down here. It's great to finally be here. And hey, we follow Dr. Doom, so we can spin this to a more positive place. Yeah. But look, that definitely informed it. I was one of the co-founders. I wasn't the CEO. I was like the product guy, co-founder of eTour, which by the way was not a travel company. It was a touring the web. It was like a search and navigation company that was founded in 1998, so a long time ago. And we went way up and way down. Raised $50 million when that was a lot of money, and almost went public. And then the market crashed, and we crashed, and it's heartbreaking to put in that company, we founded out of business school. I mean, I'd never really had a real job before doing that. I'd just been an intern. And so, you put your heart and your soul and people trust you and believe in you, and it sucks to go through that. And that crash, which, more movies should be made about that time period, but it certainly informs it because, first of all, I learned a lot that I know about product management and how to manage internet companies that helped me later on. A lot of hands-on experience. And then, going through that, which then happened again in 2008, happened again in 2020, happened again this year. And, what I would say is every one of them is different. If you kind of look at the causation of each one of these, right? You can't really equate the dot-com boom and crash to COVID and what happened with the world shutting down, or the global financial crisis, or now, which is kind of an interesting combination of both. They're all unique, they're all different, but certainly, and we could talk about it, some of the ways that could inform both opportunities and challenges.
Yeah, I mean, let's talk about that a bit more. What do you see as the parallels that are there, and how does what you experienced in the 90s kind of inform what you're seeing today? Yeah, and again, I think, it's ironic, but after that startup, I wound up at Ask Jeeves, which was a public company. We then sold it to IAC in 2005. I became CEO right after that and was there for a long time. When I left, I then actually got funding to do another startup. And the market crashed again 2 weeks after that. So right in the heart of me getting funding. And what I'd say in both situations, and I think it's a parallel for today, is first of all, if you're an existing company, one that has been through the boom and raised money during the boom at valuations that were pretty rosy, and you went through hiring and perks for your company, and probably easier on the revenue side because other companies weren't going through those challenges. You have to really reevaluate quickly and get those costs under control. Kind of reevaluate how you view your market and your valuation. In a lot of cases, if you're a public company, again, it's easy to sit there and think about the way things were and
and operate that way, I think the companies that adapt the most quickly, if you're an existing company, are the ones that are going to make it through. I think Bill Gurley, who was one of my investors at Clicker, which was my second startup, said it right a couple weeks ago. He said, this is the best time to get funded as a company. And I agree. If you look at every one of these crash periods, those are when some of the best companies have been born. Or when early stage ones could make it through the gauntlet, then the rewards on the other side of that are great. I actually, that leads us to Yahoo, but I think we're in a very similar situation here.
So let's talk about Yahoo. Obviously, you're the CEO, you're a big boss. This is a brand that's gone through many iterations. Started in the early 90s, co-founded by Jerry Yang. It was a search engine. Since then, it's grown many tentacles into content. We've got Yahoo News, obviously Yahoo Finance, Yahoo Sports. When you look at it today, how do you define the Yahoo brand?
Well, coming in from the outside, the great thing is that you're not tied to the past. So, and I always say this about this opportunity, and I just passed my 1-year anniversary here, but if you didn't know what it was called, and I think the brand has a lot of strengths. I had somebody pretty prominent tell me a couple weeks ago, he thinks the brand is worth as much as Apollo paid for all of Yahoo. So, there's a lot we have to do to earn that, but it is, I think, a great brand that has a lot of goodwill. If we treat it right, things can happen. But the truth is, if you were to come in today and just look at it objectively, without the brand, you would say hundreds of millions of users, doing billions of revenue, that's very profitable, and is pretty entrenched in the various verticals in which it's strong, right? Top 2 in email, sports, news, finance, and these are amazing categories. We have a huge advertising business. We're one of the biggest ad sales forces on the internet. We have real ad tech. Behind the scenes. There's a lot of other things we haven't even talked about, including AOL, which, again, in my past, I've learned how things like that, which is even older than Yahoo, it's very, very profitable. If you were to take an objective look at those assets, you would say that's an amazing, investment opportunity, given the fact that we've been spun out of Verizon, we're private again, and that allows you to do, the things that you need to do behind the scenes to improve it. And if I were to look at it again objectively, I'd say it's not, I think one of the things people can mistake about Yahoo is thinking of it as one thing. Right?
You've said you hate the question whether it's a media company or a tech company, a content company, but
yeah,
there are a lot of people who are saying, well, what defines the Yahoo brand?
It's a product company. Email is a product. We still are in search and one of the top 3 players in search, that's a product. Yahoo Finance. Content is one of the products that we offer on Yahoo Finance. Stock charts, information, these information sets that we provide to allow somebody to become a better investor. Those are all product features. And I do think at the core, we have media. Technology enables literally all of it. But at the end of the day, we are a product company, vertical by vertical. And I look at the brand independently as well. Yahoo Finance is a very strong brand, one of the best. And one with some of the most traffic in the finance vertical. So does Bloomberg, so does Dow Jones, so does CNBC. That's very different than Yahoo Sports with ESPN, or it's very different than news or email versus Gmail. And as so as a brand, I think about them pretty independently. Will they get woven together, at a larger level? Yes. Are the days gone when you think of it as a portal? Yes.
So you mentioned some numbers here. I know you like to highlight this a lot. 900 million users. You're talking about Yahoo assets, billions of dollars in revenue. You talk about the profitability. And yet I know over the last year, you have been asked over and over what the turnaround story looks like. Why do you think it's been defined as that if those numbers are there?
Probably because it hasn't historically been successful at pulling that off. Again, I think the bar changes. I think what the team in the 2000s were dealing with was coming in on the heels of a decision you could not reverse, which was giving search to Google and literally paying them to do it, and then the aftermath of that and trying to figure out what the business could be. Again, you were talking a much bigger company with much more to lose at that point. You had a turnaround, attempt in the 2010s again, and not just Yahoo, but the AOL properties as well. That all got solved in a way by being brought inside of Verizon for 5 years. And so our team comes in at a very different spot. What I do know is that this has all of the bones of a great turnaround opportunity, as I know it, as I've been through them before. A ton of traffic in very important monetizable categories, with being number one or number two in those categories. Those are things I can work with. We can put great teams against that, reinvigorate these products, which is certainly needed. In a lot of these ways, there are reasons why these things are number one or number two. There's also reasons why it hasn't totally fulfilled its potential in each one of these. So that you can work with. And coming from where we're coming from now, coming out, is an incredible investment opportunity, for those who've been behind it. And it's why, in this case, I ran towards the fire to want to do this. Because, people have asked me, what is the thing that surprised you the most about Yahoo? And they've asked me continually, and it's been the same two things. Number one is how many people are rooting for us. I think in this world, people want, for whatever reason, they would love to see Yahoo be successful still. This isn't a brand people are rooting against. They may wonder whether we can do it. That's a different story, but I think they would love to see us do it. And the other is that in a lot of ways, it's not a turnaround. Turnarounds are in trouble. This company is in really good financial position and has amazing assets.
So let's talk about the strategy that you have put in place. You've added, maybe you should say, shaken up the structure a bit, right? Individual assets now have their own general managers. That's sort of been the first thing we have seen. The changes
now
here
we're inside
too.
Baseball.
But you've also talked about seeing a spin-off in these individual brands, that you think that they can stand alone. And I can't help but think that if you think about, sort of the major, tech companies, and I know you don't want to define Yahoo as just a tech company, but you look at somebody like an Alphabet or somebody, like a Meta. They've got multiple brands that have sort of come together. Why think about them separately, and why the idea of going towards that spin-off?
Well, let's work backwards. First of all, I think they think about them separately. They weave them together. Again, YouTube is woven into Google, but those are two different teams, two different brands. Instagram and Facebook, and now the VR side, these are all individual divisions run by general managers. Susan is an amazing CEO who runs YouTube with Neil. That's very different than the team running Google .com or the cloud business with Thomas. So Amazon is very much the same way. And so there's something about Yahoo where people want to think about it it's got to do with the history of it being a portal. Think of it as one thing. Certainly the brand is consistent in this case, but I think, and that story could take care of itself, but the first step is to work on them individually. Now, if you do that, and I'm not worried about it, so the notion of what will you do with these things, will they all go public together, will they all live together, will they spin off, those are all things we have the option to do, but I don't think about them because I still feel like I just got here, and our team wants to be the one to create this value. And create them across the board. So I think these are all investment opportunities. The end game for each of them is something we don't have to think about yet.
I want to end on a personal question, because in prepping for this, I looked at a lot of your interviews, and correct me if I'm wrong, but I get the sense that you like being the underdog. You have a bit of a chip on your shoulder. So my question to you is, whatever you want to define Yahoo as, let's call it a turnaround story if that's what people are saying. What do you have to prove by building out Yahoo to where you want it to be?
It's interesting. I'd say of the things that I could have done, I would say in a way they maybe would have been more in the realm of something I could have proven. In this case, this is something I've done a few times before. My teams have been very successful doing them. We have great people. We've met great people here as well, brought in new people that we didn't work with before. I'm loving the way the team here is shaping up. I love being a part of that, right? The two things I love to come to work to do are to build great products and to have a great team and of great people who love working together. And if you can do those two things with an asset that has the ability to be invested in the right way and create upside opportunity, I love doing that. There's not a day when I don't love getting up and coming to do this. There's not a day when I have angst about whether we can do this. I have anxiety sometimes about just the amount of things we have to do, but that's different, right? There's no question to me that this is doable. And so, yeah, look, when I had another CEO as a compliment, call me a journeyman the other time, a couple months ago, because I've been to several different internet companies at this point. I've been doing this 25 years. But for me, I know it when I see that, that opportunity. And so, that past is always there. I'm not afraid of being the underdog, and I do kind of, like it. It's it's harder than being just somebody on the rocket ship. And, it's going to go anyway, whether you're there or not. I like to make a difference. The people I work with feel the same way. So I think about it probably a little more like that.
Jim Lanzone, thank you so much for joining us today.
Awesome.
Coming up, what's next for the markets and the global economy? Northern Trust's Katie Nixon joins us next.
Welcome back to the Yahoo Finance All Market Summit presented by Northern Trust. Stocks and bonds are in bear market territory as the world faces macroeconomic headwinds driven by rising inflation, geopolitical tensions, and an energy crisis. Here to talk about what this means for investors and more, let's bring in Northern Trust Wealth Management Chief Investment Officer, Katie Nixon. Katie, it's great to see you. Certainly has been a troublesome time here in the market since the start of the year. S&P coming off its fourth down week in the past 5 trading weeks. We just got another hot inflation print for the month of September. Help us make sense of where things stand today.
Well, Shauna, first of all, thank you for having me today. It's a pleasure to be here in the studio with you. Finally. So great to be here. And yes, it's been a really tough time for investors. But I think a little perspective is helpful during times like this. And, as you noted, we're in a bear market, doubtless. But we've been here before. And if you look back in history, over the last 100 years, we've had 26 bear markets. We've had 14 since World War II. We've had 3 since the year 2000. So in some ways, this is uncomfortable but familiar territory. And we know bear markets end. The average bear market lasts about a year. We entered into this bear market in June, so perhaps we're hitting the mid-mark of the average. The backdrop certainly matters, and more severe bear markets tend to take place with more systematic risks or deep recessions. We don't see either of those things. So I do think that kind of history is important. And it also is important to look at returns. And as you noted, of course, we've had a very tough time for equities. Equities fall anywhere between sort of 20 and 40% in bear markets. We're just over 20% today. But we also know that during bear markets, there tends to be a lot of volatility and there tends to be a lot of up days. I mean, today's a good example. We had a couple of examples last week where we have these, incredible rallies in the middle of a bear market. So I do think investors should have some historical perspective and then perhaps take a deep breath, because although it's really tempting to try to time investing over a bear market cycle, gosh, when you see those numbers ripping up and down, you feel like you should do something. Unfortunately, the best but most uncomfortable thing to do is to do nothing, because we have these great days in the market that are quickly followed by some tough days, and they all happen in the middle of a bear market. And Shauna, I was thinking this morning, over half of the best days of the market happen in a bear market. So again, I think it highlights the perils of trying to time markets and the risk that you're going to be out of the market on those best days and the real damage that can do to your return over even a 10-year period.
It certainly is important not to time the market here. Before we get more into that, though, Katie, when you take a look at current valuations, S&P, like you mentioned, off more than 20% year to date. NASDAQ down more than 30% year to date. You mentioned the fact that you don't see a deep recession on the horizon. Do you think, though, we are at risk of a recession, and what does that potentially look like?
Certainly, Shauna. I mean, I think absolutely we can anticipate a period of economic softness here. And I do think the definition of a recession sort of ebbs and flows. But let's just say, for the record, a period of economic softening is what we anticipate for 2023. But I think you mentioned valuation, and that's really, really important, because if you think about this particular bear market, it kind of is in 2 phases. The first phase is very much a valuation-driven experience. And interestingly, you even mentioned like the NASDAQ and then the S&P. The NASDAQ is the growthiest index. The S&P is also a pretty growthy index, and they're very sensitive to changes in interest rates. We know the market is a discounting mechanism, and when you have a higher discount rate, you have a lower present value. So the growthiest, NASDAQ, was hit the hardest. The S&P's been hit pretty hard too, and valuation contraction has been more than 100% of the market downturn this year. Earnings have been up. So all of what we've seen this year has been a contraction in valuations. That's phase 1. The second phase is related to your question about a recession, and that is what's going to happen to the E of the price to earnings, the earnings. And we think earnings are probably going to be soft in 2023. We have an estimate far below what Wall Street analysts have right now. We think they're just a little bit too optimistic on the go-forward view, given the fact that we are entering a soft period.
And Katie, what is your estimate on earnings, and why do you think Wall Street is a little bit too optimistic at this point?
So, I mean, we've seen corporations, U.S. large corporations, be incredibly resilient in the face of an incredible amount of headwinds. We've had higher rates, we've had pandemics, we've had problems in getting workers back to work. Despite that fact, we have had pretty good earnings, and I think everyone was sort of waiting with bated breath for the shoe to drop in the second quarter, and it didn't. We had a good second quarter. Estimates have come down in the third quarter, but the third quarter might shape up to be pretty decent too. So I think Wall Street analysts are just building off those kinds of estimates. But for us, with a softer growth outlook in 2023 and the fact that the S&P 500 has about 40% of their revenues tied to overseas growth, we just think those headwinds are pretty strong, and we come in sort of around $228 for S&P earnings for next year.
And you mentioned that statistic there, 40% of revenue coming from overseas. That, of course, brings up the strong dollar, the risk of the challenge that poses for companies here. How are you assessing that risk? And I guess how long do you see that risk lasting here? Because it doesn't seem like anything is going to take some of that strength out of the dollar anytime soon.
Well, you're right to bring up the dollar. As they say, our currency, your problem. And it has been a significant problem for U.S. corporations overseas, and also for the translation of non-U.S. investments back to U.S. dollar terms for our investors and for our clients. Developed markets, ex-U.S., have outperformed the U.S. on local currency terms, but when you translate it back to the dollar, it's been a huge headwind. So what could stop the dollar? Well, what propelled the dollar has been a very aggressive Fed coming out first and very aggressively with this rate hike path that has been extremely front-end loaded to face inflationary pressures. We think we're closer to the end of the policy tightening. We'll probably see the last rate hike in early 2023, and we also see inflation coming off the boil. Those two things should help to stabilize the dollar. So we don't anticipate we're going to see the kind of strength that has created these headwinds in 2023.
You mentioned inflation coming off the boil. To put it in your terms, do you think we have seen inflation peak?
So inflation has so many dimensions, and many of them, particularly the ones that were really pressured because of COVID, have been abating. Supply chain constraints have come off. We see prices coming down in used cars. I mean, we're all talking about used cars these days. It's a pretty important price barometer. So we see inventories up, prices down, and some of the things that have been really impacted by COVID. So generally speaking, we do see inflation coming down. We saw an Empire State Manufacturing survey this morning that had some interesting insight on prices coming down. Where we are still concerned, though, is in wages. And also, frankly, in owner's equivalent rent. These two pieces of inflation are sticky. Owner's equivalent rent, we can all see that prices have stabilized and have come down, but it takes a while to get that through the inflation pipeline. So we're not going to see the benefits of that until well into 2023. And wages have stabilized, but at a high level. So we do see lots of inflation elements coming down, and we are watching really closely what happens to wages, because that's going to really dictate what happens to CPI and core PCE in 2023.
Yeah, the last jobs print that we got, wages were moving to the upside. Unemployment rate actually went down. So even though we did see a little bit of cooling in that headline number, those two factors were really something that a hawkish Fed obviously would keep a very close eye on. What's your assessment just of the jobs market and how substantially we need to see maybe some of that growth begin to cool in order to get inflation under control? You're
absolutely right. It's economics 101. We have more demand for labor than we have supply, and it's really shocking actually to look at the numbers. When you look at the JOLTS data at over 10 million job openings, and then you look at the number of unemployed people in the U.S. at around 7.5 million, there's just a mismatch. So yes, the ultimate soft landing would be slowing demand enough that the brunt of that is felt on the opening side. So companies just freeze hiring versus actually increasing unemployment. That's a pretty tough needle to thread.
It certainly is a very tough needle to thread. Katie, I want to go back to what you said earlier when you were just talking about, you gathered some data, I know, on the cost of panicking, pulling your money out of the market in a volatile time like this. What can you tell us about that and why it's so important to stay invested through uncertain times?
I know, it's so important always, but more important during volatile times. If you missed just the best 10 days out of the last 10 years, so you're talking 2,500 days, your return went down by 40%. If you missed 20 of the best days, it went down by 2/3. So there's a really high cost of missing out. And as I said before, we tend to see very strong days of the market during bear markets. And the really tough time for investors, and again, it goes back to market timing is always difficult, but it's really difficult during these times of high volatility and bear markets. The reason is the best days and the worst days tend to clump together. So you're never going to get it right because you're going to have a terrible day followed by a great day. So the best advice, the best guidance for investors, especially during times like this, is stay the course, stick with your strategy, make sure that your equity risk, that your risk assets are aligned to your longer term goals so you don't have to worry about shorter term volatility, but you really need to stick to your strategy or you'll risk missing out.
So you don't want to try to time the market, you don't want to panic and pull your money out. You mentioned strategy there. Where are you seeing the most opportunity today?
So it's really interesting because I do think it's an opportunity right now for investors to rethink fixed income. We've been talking about the bear market in equities, but my goodness, we have had a steep reset in interest rates and a bear market in bonds. And right now, fixed income is actually paying income. So investors who had been forced to take risk in prior periods because there was no return can really think more, I think, deeply about their risk tolerance. And fixed income might be a good place to be right now. We're seeing 4% type yields in muni bonds. So you are seeing some pretty nice current returns out of fixed income. So that's a place I would say would be a great place for investors to reconsider. Those who have been sort of bearish on bonds because the rates were so low. Well, now we seem to have much better rates. The last thing I would say on that, though, is from an equity perspective, we still do see the best opportunities in U.S. equities, just the best visibility, the best transparency around what's going on. And we do see areas outside the U.S. as having some exogenous headwinds, specifically related to energy, that are just really hard to price into markets right here.
When it comes to the growth versus value debate here in the U.S., obviously growth has underperformed. Is now the time to put money to work in some of those undervalued names?
You know, we always preach diversification, and I will say that with an economy that's slowing and interest rates probably stabilizing, it's not a bad opportunity for growth stocks because in an environment where growth is dear, investors will pay more for growth. So we would say stick to a diversified strategy. You really want to have both because trying to time those factors is very, very difficult.
Katie Nixon, always great to speak with you. Thanks so much for taking the time to stop by the studio. All right, let's get a market check with Julie Hyman. Hey, Julie.
Hi, Shauna. Thank you so much. Well, we are seeing stocks show some real strength here once again today. The S&P 500 right now up 2.7%, around the highs of the session. If you look at the 5-day chart, you can see the big swings, of course, that we have been having here and the volatility that continues in this market. But really, it does feel like a more risk-on day today. For example, we've got yields moving lower below 4% here. We've got the dollar moving lower as well, which has tended to help stocks as of late. So that's something else that I'm watching. Take a look at some of the other elements here. Banks is something else that we're watching in today's session for a couple reasons. Bank of America, of course, was out with numbers that beat estimates, saw record net interest income, and that's as we have seen the Federal Reserve raise rates. Net income overall was down but beat estimates, but net interest income up 24%, and the shares are up 5% today. We also got news on Goldman Sachs, which according to Bloomberg and the Wall Street Journal is doing some restructuring, including continued sort of wind downs of its consumer banking business. Those shares up 2.5%. Just quickly here, if we look at the sectors, you see the strength and the broad strength that we're seeing within stocks, say with all of the groups up, consumer discretionary, real estate, tech leading the pack, but really you're seeing a broad-based gain here. And then NASDAQ also seeing broad-based gains, almost all green. One more mover that I wanted to point out to you because it's the top trending ticker on the Yahoo Finance platform. And that is shares of, and I'll just wait for it to come up, Roblox. Roblox shares up 21% today. And that's after the video gaming platform came out with its daily active users for September, coming in at 57.8 million, and the company is now forecasting for September bookings of $212 to $219 million. This is the biggest one-day jump that we've seen for shares of Roblox going on till May, and since May, and again, sort of reflective of this risk-on sentiment that we are seeing come back into the market. It's a marked contrast with what we've seen from Roblox this year, with the shares down some 58%. So benefiting from risk coming back in. Broadly today, in terms of commentary, we're hearing about the gains that we're seeing. Most are still calling it a sort of bear market bounce here, but Mike Wilson at Morgan Stanley says we could see maybe another climb up in the S&P 500 from here, even as high as 4150. He's still a bear over the longer term, but is looking perhaps for this bounce to continue for a little bit. Much more All Market Summit and Yahoo Finance coming your way next.
Straight ahead, the evolution of e-commerce, how Walmart's Suresh Kumar plans to move forward into the great digital transformation.
The landscape of modern wealth is complex. Challenges and opportunities intersect. That's why we created the Northern Trust Institute, using advanced analytics and the best financial expertise of our firm to develop advice that's tested and tailored. We help you navigate tax policy, the art world, impact investing, real estate properties, cryptocurrency, and beyond. Where there's a trend, we're ahead of it. Where there's a gap, we bridge it. Where there's your moment, we help you grab it.
Well, tech may not be always synonymous with Walmart, but the retail giant is moving aggressively to change that, with Suresh Kumar at the helm. As executive vice president and the company's first global technology officer, Kumar's been tasked with transforming the Walmart experience by driving innovation from the inside. And he's got 25 years of experience to pull from, with prior stops at Google and Microsoft. And we're pleased to welcome in Suresh Kumar from Walmart headquarters today. Suresh, good to talk to you. You have been...
Good to talk to you, Akiko. Thank you for having me.
Yeah, I mean, you've been in this position since 2019, so you're going on 4 years. You've built out a team of about 20,000 workers globally, tech-specific. Earlier this year, though, you announced about 5,000 people you're adding to this team, with hubs in places like Atlanta as well as Toronto. Where are you along in that journey? And what does that say about how Walmart sees tech driving its next chapter?
Yeah, I am leading a global team of wonderful technologists across the world, and we are building the next generation of retail, the experiences for our customers, and we are building the tools and technologies that are completely transforming our business. As you know, Walmart's purpose is really about saving money and helping people lead better lives. Technology is such a critical part of delivering on this promise, and that's what we are setting out to do, whether it is enabling the customer to be able to buy right in the middle of their social feed when they get inspired, or having their products delivered all the way into the refrigerator. We are building the technology that enables all of this to happen. And we are building tools and capabilities that are completely transforming our business. Retail is getting disrupted, and the role of technology really is to actually help Walmart be the retail leader in the disruption that's already starting to happen. And we can see that in customer experiences. We can see that in the way in which we use data to drive efficiencies. We can see that in the ways in which our associates are working in order to be able to serve our customers better. All of this is part of the transformation that is enabled by technology, and that's what me and the team are setting out to do.
And we'll get into more of the specifics in just a bit, but I want to pull back because you've talked a lot about the transformations that have happened in retail. And you've said, look, they happen about every 20 years. I think a lot of our viewers are familiar with the most recent one, which I would argue is the push to e-commerce driven by your competitor, Amazon. But you say we are in the middle of another cycle. What does that look like?
Yes. See, every industry goes through disruptive cycles. Typically, all of these things are actually driven by advances in technology. Like you mentioned, the last big disruption in retail was really the introduction of e-commerce that was enabled by the growth of internet. But since then, we have seen so many improvements in technology. We have got incredible computing power in the palm of our hands. We have mapped every single square inch of the planet. We have computers through deep learning that can recognize and understand natural language, and we have computers that can recognize objects. All of these things are coming together, and they are the fuel for the next round of disruption that we are already starting to see. We are starting to see that in the way in which customers are finding, discovering, and getting inspired for new products. We are seeing disruptions in terms of how people shop. We are seeing disruption in terms of how products get delivered to the customers. Walmart is in a unique position because the true disruptors are those who are going to really be able to look at the whole customer experience. It's not just about online. It's not just about the stores. It's about making sure that the customer experience is a delightful experience from the time that they get inspired all the way to when the product gets delivered. It's not just only about reducing friction, it's about creating a delightful experience, and that is actually going to continue to get disrupted. Walmart, like I said, is the company that can take care of the whole customer experience. And the role of technology is to be able to enable that in a way that only Walmart will be able to deliver.
And so when we look at that and changing the shopping experience, number one, I mean, you've sort of taken a two-track approach. Number one, developing technology in-house, but also partnering with those like Adobe. Let's talk about the in-house part of it. How are you determining where to put your investments? How much of this is about driving efficiencies to improve the experience? How much of it is about the shopping experience itself?
Absolutely. So the way in which we look at our technology investments, largely there are three different things that we concentrate on. First, like you said, is really about the customer experience. We want to create absolutely delightful customer experiences, no matter how they shop and when they shop and where they shop. Great example is what we just rolled out, which is, be your own model. Shopping for an outfit, we want to make it as fun as possible. When you're shopping for an outfit, you don't want to rely on some model that we have chosen to see what the outfit actually looks like. So this is a technology that we have used advanced machine learning so that we know how the outfit will actually drape on your particular body. So you can be a lot more comfortable about buying that particular outfit. It reduces friction, it makes it more delightful, and it increases trust. So those are one area where we really are focused on, how to make shopping not just friction-free, but really delightful. The second area is really about enabling our 2.3 million associates to help serve our customers better, more efficiently, so that they can focus on what they need to do best. Same types of advanced technology can be used for our associates as well. One good example is what we call as WizPick. This is where our associates can use AR to be able to be guided in the back room to figure out what products they need to pick and put it in from the back room, bring it from the back room, and restock it on our store. It makes it very, very efficient for them. They don't need to print out a list. The system guides them. So they can focus a lot more on being efficient in what they do. The third area is really around transforming the business through automation by extracting insights out of the huge amount of scale and data that only Walmart has got to not just automate, but to optimize every part of our decision-making, whether it is about how we choose our assortments that are local, that are customized for the market that we serve, all the way to how we price, how we mark down, to how we optimize our supply chain in real time. All of these things are enabled by the scale, the data that we have, and our ability to reason over that using machine learning, using advanced models. That really allows us to be able to reduce the cost and really go back to our purpose of saving people money.
And Suresh, you just pointed on a key word that I'm thinking about when you're talking about all these products you're rolling out, which is the collection of data. I mean, that itself is such a big commodity for so many companies. Number one, it tells you what shopper behavior is going to be like. It allows you to sell ads online against some of that. I mean, how are you thinking about the commercialization of that as you integrate technology more and more into the Walmart experience?
Yes. So the great thing about Walmart is that we serve our customers in what we talk about is the whole customer experience, right? So whether it is online, whether it's inside the stores, we serve our customers the way they want, where they want, and how they want. And this basically means that we can get a lot more insights about what is the best way to be able to serve our customers. This comes from both the whole customer experience nature as well as obviously the scale at which we operate. What we are focused on is to take that data and turn it into insights that ultimately serve our customers better, right? When we talk about commercialization, or when we talk about taking the data, ultimately we want to do two things. We want to be able to serve our customers in a much more personalized, much more, in a much deeper way. And we want to create an ecosystem where not just Walmart, but all of our partners and all of our suppliers and all of the ecosystem partners also benefit from that. So that is what we are trying to build over here, so that it's an open system. It's not a walled garden. We want everybody to be able to participate and ultimately benefit the customer.
You are the global CTO. I can't let you go without asking you about crypto, because Walmart did make some headlines at the end of last year when you filed a number of key trademarks that appear to point to the company's intentions to sell as well as market virtual goods. You've already got blockchain technology integrated into the system here. What's the role of crypto in Walmart's future?
It's a great question. I think that there are three major areas of disruption. Crypto falls in sort of the middle of it. I have talked before about the way in which customers are getting inspired and discovering products. That is changing. And part of that is going to happen in the metaverse. Part of that is going to happen on live streams inside your social media app. So whether it is physical goods or virtual goods, they play a part in terms of what the customer wants. Crypto will become an important part of how customers transact. We want to make sure that we make it as friction-free for customers to be able to transact and to be able to buy, and how they are able to derive value out of it, right? And that is where I think a lot of the disruption is going to start happening in terms of different payment methods, different payment options. The role of crypto is going to continue to play a very important role in that, and obviously we want to be there where the customer really needs us to be. The last part of it is how products get discovered, products get delivered. A lot of disruption going on over there, but when you specifically talk about crypto, it is going to be about discovery of products, whether it is physical or virtual inside either the metaverse or upfront, and then how people transact.
Okay, certainly a lot of good people are going to be now looking for an announcement potentially from Walmart, at least short, medium term. Suresh Kumar, Global CTO for Walmart. Really appreciate your time today.
Thank you.
Straight ahead, our focus is crypto with Grayscale CEO Michael Sonnenshein. Stay with us. Welcome back to Yahoo Finance's All Market Summit, sponsored in part by Grayscale. It's been a volatile year for stocks, and crypto is no exception. I'm here with Grayscale CEO Michael Sonnenshein. Michael, great to see you.
Thanks for having me. Great to be here.
So, a lot to talk about, but why don't we start off with talking about your lawsuit that you filed against the Securities and Exchange Commission and get us up to speed on the whole legal dispute there.
Sure. So Grayscale operates today the largest Bitcoin fund in the world, Grayscale Bitcoin Trust, ticker GBTC. It has been trading publicly since 2015, and we have long held conviction that this should be an ETF. We want to work towards having it become an ETF and work proactively with regulators. We had filed an application to convert it to an ETF, and that was rejected by the SEC this summer. The same day the SEC rejected that application, we filed a lawsuit challenging that decision. And we really feel that this lawsuit is not, Andy, it's not just about Bitcoin. This is about putting forward, straightforward, common sense legal arguments that really ensure that investors are protected and that the SEC is acting within their mandate. And so since that time, our legal team has been behind the scenes working furiously on the case. And just this last week, we filed the opening brief for the lawsuit. Some new arguments outlined in there, and probably the most significant of them is this idea of a significant market test. The SEC created this significant market test really out of nowhere. We've never seen them do this before for any other product, any other commodity that we've ever seen. And it applied it very, very stringently to spot Bitcoin ETFs like GBTC, but very leniently to Bitcoin futures ETFs, hence why we have several of them on the market. So the SEC is really acting outside of its authority under the Exchange Act, and that's really one of the strongest arguments. But again, this is not just about Bitcoin, this is about straightforward common sense arguments when it comes to the SEC.
Michael, can you put yourself in the shoes of the SEC, though, and understand their argument? I mean, first of all, they're looking to protect investors, but why are they taking this position against your ETF, do you think?
Andy, I can't understand why. As I said, this product is trading every single day, hundreds of millions of dollars. Over 850,000 investors in the US own shares of GBTC, all 50 states represented. You have bills passing across the floor of Congress, both sides of the aisle supporting it. You have companies moving outside the US because our regulatory landscape isn't catching up fast enough with the innovation taking place here. Why our regulator would not take the opportunity to bring Bitcoin, to bring investor protections closer into the regulatory perimeter, I just don't understand. It's exactly what they're here to do.
I want to get back to that a little bit in a second, but first of all, maybe you can remind us or tell us a little bit more about Grayscale. You have these ETFs, what else?
So the Grayscale family of products today has now 17 digital currency investment products. So really our mission has been about lowering the barrier to entry for investors to access crypto. So we have a whole family of publicly traded securities so that investors can buy and sell crypto exposure in their brokerage accounts, retirement accounts, you name it. We also launched an ETF earlier this year, the Grayscale Future of Finance ETF, which was our first foray into an equities offering. And I think as we kind of move through this crypto winter, we're starting to explore some really new offerings and new wrappers and new ways of giving investors access to the digital economy more broadly.
You mentioned the crypto winter. I'm glad you brought it up because now I want to ask you more about that.
Sure.
I think Bitcoin is down, 70% year to date. Why is that? And is it really the case that it goes down and then goes back up to new heights every single time? Or maybe this time's different?
So this is a crypto winter, and we call it a crypto winter because we're talking about sustained lower prices across the crypto ecosystem. We've been here before, and unfortunately, Andy, I'm going to tell you and anyone tuning in, we're probably going to be here again at some point, right? And that's the kind of cycles that the crypto asset class has. We see it go on to take out new all-time highs, comes to some level of correction, starts to form a new base, and during these times, it's really a time to build when you see this retraction. What we're hearing from investors is actually not that they're shying away from the asset class, quite the contrary. I think you and I now for years have been talking about diversification within this asset class. People have that core Bitcoin core Ethereum position. But they're now looking at things like infrastructure, for example, right? How do they marry that crypto exposure they have in tokens with the underlying infrastructure that powers these protocols? So we just recently launched a new offering, the Grayscale Digital Infrastructure Opportunities Fund. And that really gives investors the opportunity to invest in Bitcoin mining, for example, right? An industry that maybe took on too much leverage, and we're really giving them a distressed opportunity. So this crypto winter, too soon and too tough to predict how long it will last, but investors are not shying away from the industry and, if anything, looking for new opportunities.
But there is all kinds of risk. I mean, hackers have stolen, what, $3 billion of Bitcoin and crypto coins this year. How do we protect against that?
It really is a question of who you're working with as you think about crypto exposure, right? If you think back to the early days of the internet, many companies were building products and services, and the regulatory environment hadn't caught up with it yet. You didn't see the emergence yet of some of the Web 2.0 applications that we today couldn't live without. Things like Amazon, things like AWS, Google, you name it. And I think we're in that kind of a phase when it comes to crypto, where we're learning lessons as an industry. There's certainly going to be missteps, but as an industry, we get stronger, we become more resilient, and we start to weed out bad apples over time.
What is Bitcoin for? And maybe this gets to the SEC situation. Is it an investment? Is it a currency? And is it losing market share to Ethereum in some things like NFTs?
It's a great question. So Bitcoin depends on where in the world you fall, right? Over the past couple of months, if not over the last year, you've seen all kinds of volatility across a variety of asset classes, massive movements in fiat currencies all over the world, sometimes to unprecedented, levels of volatility that we've just really never seen before. I think here in the US and in other developed economies, you're seeing Bitcoin being used more as a store of value or as an investment. I don't see necessarily yet how or why we're using Bitcoin day to day in our everyday, transactions, buying a cup of coffee, things like that. But if you wake up in other parts of the world today and the currency that your government issues that you use to buy that cup of coffee lost 20% of its value last night, well, something like Bitcoin, something that's non-government backed, something that's non-government issued, actually becomes something really attractive. And so as you're seeing these different macro factors continue to change the landscape, I think depending where you are in the world, Bitcoin will mean different things to different folks.
Is Ethereum getting more market share than Bitcoin at its expense?
No, not necessarily. I think there are today, last count, over 17,000 different digital assets out there. And so something that we're certainly committed to at Grayscale is continuing to make sense of that universe for investors. Where do you even start when there's so many options available to you? And there is a world today and a future state where multiple digital currencies will coexist with one another, or digital assets. They'll have different use cases, different addressable markets, and different prices. And Bitcoin is, gonna coincide with things like Ethereum, and it's gonna coexist, and it's okay that they coexist and have different use cases in different markets.
What about coexisting, though, with fiat currency? I mean, what do you see, 20, 30, 40 years down the road? Are we gonna have fiat currency and cryptocurrency coexisting?
Well, I think we're certainly seeing new use cases emerging out of this asset class every day. We are certainly moving towards the tokenization of a lot of new kind of ideas and a lot of things today that may have frictions or maybe not the most efficient types of settlements or oversight of ownership or perhaps authenticity. That's one of the things that NFTs as a technology are helping us to understand. So I think from an investor standpoint, we are certainly moving into that realm where a pie chart that an investor has, which is diversified across equities and fixed income and commodities, certainly is going to have a slice that goes towards crypto or digital assets more broadly. How diversified that'll be depends on who the investor is and how they actually start to think about crypto affecting the other things they invest in.
I mean, is crypto really better than the US dollar?
That is a loaded question, Andy.
Right.
Well, I think that the U.S. dollar has certainly, maintained its dominance as the global reserve currency, no question about it. Arguably, Bitcoin is one of, if not the most incredible invention that we've seen over the last, call it 2 decades or so. It was literally invented out of thin air and has now been used by hundreds of millions of people around the world. And anytime anything challenges it, it somehow becomes even stronger and more resilient. So I think it's too early to say. And there's also not necessarily a winner between those two, right? The fiat world, the crypto world, these are two worlds that can and will likely coexist.
Yeah, when you get ransomware attacks, they want to get paid in Bitcoin, though, right? I mean, how do we get rid of that stigma?
Not really. I kind of think that stigma is dying, Andy. It really is. You got to understand that because the Bitcoin blockchain is immutable and traceable, unlike exchanging physical dollars for someone doing something nefarious, Bitcoin would be a really bad mechanism to use if you didn't want to get caught doing something. So I don't think that is as nearly as prevalent as it once was, and for that very reason.
And how do you look at some of the experiments that some of these countries have undertaken with crypto? I mean, like El Salvador, maybe a mixed picture there?
I mean, it's one of those places in the world, right, where a lot of these economies have been either dollar-based or they're not doing a terribly great job managing their own currency. A lot of people have moved into leveraging mobile technology, so they're living their lives on their phones. It doesn't have to be a brand new iPhone or a brand new Android, but they're moving into a state where the connectedness of cell technology is bringing them together, and their banking either hasn't caught up or isn't allowing them to have access to those types of services. And so Bitcoin and these types of technologies are actually allowing people to enter the conversation, create savings, pass money to the next generation, things that just the traditional banking system may not be catching up to in certain parts of the world.
I mean, is it possible then that because we're in a place in the world where we rely on the dollar and fiat and legacy systems are so prevalent that we don't see the change coming in the rest of the world?
I think that's one of the unique things about being a Grayscale. Being at our part of our parent company, Digital Currency Group, we have investments in over 40 countries around the world. And so we don't sit in a room all day and tell each other that Bitcoin is happening. We actually have companies that are building products and services in every corner of the globe and seeing how volumes are changing, see what customer adoption looks like, seeing how often people transact. And the numbers tell a really compelling story.
And we've talked about this before, Michael, but what about the correlation between just say plain vanilla equities and crypto? And let me have you answer that and we can get to other correlations.
So it's a great question because the narrative on this has flipped very recently. When you look at where and how crypto has historically been categorized, it actually has followed tech stocks and a lot of the momentum trades that we've historically seen in the equities market. Some of those assets are down 70, 80+% year to date. And what's interesting is that even though crypto has fallen precipitously, and Bitcoin in particular, it's actually now been trading very tightly in this band. And so the volatility that you're seeing in crypto has come down tremendously. So a lot of folks are now looking at that narrative and saying, well, is that going to hold up when crypto does wake up from this crypto winter? Is it going to continue to follow those types of trades and be that kind of momentum? Or is the macro environment really reshaping the way people might think about crypto's role in a portfolio?
What about the economy then, Michael? I mean, a lot of talk of recession, and there's a crypto winter. Correlated? Coincidence? What do you think?
Probably more coincidental than not. I mean, it's early days, right? Because you do have some folks calling for a recession and other folks not so much, just saying that this is, just a relatively momentary blip in the grand scheme of things. And eventually we might see, things move to all-time highs in the not too distant future. I think crypto does this. It's done this multiple times, and unfortunately, they'll probably do it again. We've seen drawdowns of 50, 60+% before. And again, what hasn't killed crypto has made it stronger.
How is your business as a CEO looking out and seeing, growth, customer relationships? Are you seeing a slowdown? Maybe that would have to do with overall economic activity rather than adoption of crypto.
Well, certainly investors are continuing to average down on their positions, right? I think a lot of investors realize that anytime you see this type of pullback and your conviction on something hasn't fundamentally changed, that's something you should be taking advantage of, right? And so investors are not shying away from that perspective. Investors are now also, I'd say, as informed as they've ever been on the asset class itself. And so they're always looking for new opportunities to either diversify their exposure. And we're starting to see that they're developing interesting narratives around different sub-themes or subcategories of crypto, much the same way they do around the equity space.
And final question, Michael, talk about the demographics of people who are buying crypto and maybe how that's changing and some trends you've seen recently.
So the stigma that crypto is only for young males,
Rose,
it's over. It's over. What we've seen is that crypto has continued to pervade men and women. We've seen it actually creep up into older and older demographics. They realize the staying power of the asset class, and as a result of that, the momentum has been there, and I think it'll continue to move into other demographics as well.
Michael Sonnenshein, CEO of Grayscale, thank you so much for joining us.
Thank you.
You're watching the 2022 Yahoo Finance All Market Summit. We'll be right back after this.
Welcome back to Yahoo Finance's All Markets Summit, sponsored in part by Grayscale. As the crypto world faces volatility, it continues to flourish with institutional adoption and real-life use cases. Joining us now to discuss the crypto landscape beyond just where the market price of Bitcoin happens to be sitting, we've got Crypto Council for Innovation CEO Sheila Warren and Apollo Head of Digital Investments and Assets, Christine Moy, along with Yahoo Finance's David Hollerith. Great to have you all here with us for this conversation. First and foremost, just to tee up where the conversation is going to go, we should acknowledge that we are in a crypto winter right now. And David, I'll kick things over to you to really kind of set the scene, especially as we've seen kind of this deceleration or this decline in some of the crypto prices right now, and where that kind of influences some of the investment decisions going forward too.
Yeah, Brad, my first thought is sort of just to tee it up. You know, in the second quarter, we saw crypto assets fall first under macro conditions, and then a lot of sort of idiosyncratic sort of issues with the asset class, insolvencies, all that. And you know, that was obviously something unique. Since then, cryptocurrencies have mainly stayed fairly flat compared to other assets like equities. And so I think that's a good place just to start, is just to turn it over to each of the panelists, Sheila and Christine, and just sort of ask you what's different about sort of this crypto bear market compared to previous cycles.
Sheila, we'll go to you first on that.
Sure, thanks so much. You know, I think the last time, 2017 to 18, there was still this question: is crypto as a class? It really was kind of the Bitcoin or blockchain days, and is this just a flash in the pan? Is it all going to vanish and just evaporate? And this time around, I think there is a sense of the stickiness, the inevitability of this, not just as an asset class, but as a technology. It's going to have tremendous impact, I think, across a broader variety of industry ecosystems and subsets than just financial services.
Christine, same question to you. What's different between this crypto winter and past crypto winters that we've seen?
Yeah, sure. I mean, as Sheila mentioned, in the last crypto winter, there was a lot in development, but there hadn't been any mass uptake or adoption. Like, people had bought some Bitcoin and Ethereum through like crypto exchanges. Maybe a very small set of people started participating in token sales, or what were called ICOs. But generally, you know, even in the enterprises, when we were using blockchain technology, it was still in pilot or prototype stage. Now, in the last bull cycle that we just saw, going into today's crypto winter, we've seen mass adoption in a variety of different forms. So, you know, we saw, for example, a number of technological enthusiasts and financial enthusiasts participating in yield farming through the DeFi summer of 2021. We saw a long tail of creatives and non-technical consumers participate in the NFT markets in 2022. And then across this whole time, a broader adoption of stablecoins for payments and regular business use cases, like just trying to pay like my employees globally. You know, now the result of this is that a broader audience has become more informed around this technology. A number of those use cases required being able to set up a self-custody wallet, a self-custody crypto wallet. And so, you know, basically what we're dealing with now is a more kind of invested audience, and intellectually invested in terms of like having done the work to get set up with this ecosystem. The last crypto cycle was really brutal and long. And for those that managed to survive, they went on to become the biggest companies and protocols in our industry. And so I would say that in this crypto cycle, or in the last bull cycle, you know, many of the investors and the companies raised what sounded like egregious amount of money at the time, but basically building a war chest to weather this particular winter. So, you know, basically, whilst we do see this winter being severe and long, because, you know, before we didn't even have the broader macroeconomic uncertainty around inflation and potential recession, you know, I would say that the industry is a little bit better prepared. And additionally, institutions, enterprises are continuing to build in this space. You know, just recently announced Bank of New York Mellon is now offering Bitcoin custody as just one example.
Okay, so I want to take a brief step back, because there's a lot to unpack there, right? For better and for what we still need to work through too. But first, perhaps just defining, for the sake of the conversation, Web3 This is a more decentralized internet. This is an internet that's running on, or a connection point that's running on blockchain technology. This is new for a lot of people. This is also new for the way that investors like yourself are also evaluating some of these companies, right, Christine? And so with that in mind, there's the traditional thought of what's the path to profitability for some of those companies? And is that path to profitability hindered because you don't necessarily have the immediate return, and it's a much further looking out type of investment that you're really evaluating here? How does that really influence some of your investment thesis around Web3?
Sure. Just taking a step back, a lot of buzzwords in the space. We've got crypto, blockchain, digital assets, NFTs, DeFi, Web3. And so for someone who's not following the space, it can be quite intimidating. However, I like to just explain what is happening right now as a multi-year technology shift that is accelerating financial innovation. It's driving new investor behaviors, and it's creating new financial markets infrastructure that has already begun to start impacting payments, capital formation, lending and borrowing, and asset management, and then a long tail of other things, including culture. Now, we blockchain nerds that are in the industry like to think of what's being built as the internet of value. Now, the internet that most of all of you know and love, we think of as the internet of information, basically the set of technological protocols that made it possible to make 24/7, 365 distribution and exchange of information around the globe. The democratization of content and information creation and distribution through platforms like social media, where individuals were empowered to become platforms empowered by this technology, and information gatekeepers or incumbents were challenged and forced to evolve. Now, if you take that sort of framework and you apply it to not information, but now technology impacting value and value transfer and value creation, you can kind of see where we're going with this now, like in this new internet of value. Basically now that digital value transfer can be 24/7, 365 and peer-to-peer. We're seeing that now with the advent of stablecoins, or how there's been a broader democratization of value creation and distribution. We've seen that with the fits and spurts of capital formation through token sales, as an example, or how financial services at large are being unbundled into financial primitives, more jargon, but basically turned into tech microservices, basically libraries of code to do things that typically banks and financial institutions would do. And NFTs, broadly in experimentation in creating bespoke digital assets with the new ability to ascribe value to something that previously would just have been just another copy of a JPEG. But now, because we're able to track digital scarcity and provenance with this new Web3 technology set, we're able to ascribe cultural and historic value to digital things. And so, with this large technology shift that's happening, institutions like Apollo, and by the way, Apollo is a $500 billion asset manager with over a 30-year track record investing and participating in public and private equities, fixed income, credit, retirement services, and insurance. We believe in a world where this technology shift will basically impact existing financial market infrastructure and business models as more real world assets and real world applications emerge with this technology. Now, to be clear, it's not going to be a lift and drop of existing markets onto blockchain technology. I think that has all been tried like in the previous years, of the last half decade. That didn't really necessarily work, nor is there really a business case to do that. And it won't be magic internet money that ignores the financial realities of, appropriate risk and return. I think that the recent crypto markets unwind and, market idiosyncrasies we've seen have proven that. But it's going to be a unique, never before seen intersection of crypto native new product and market development that has been grounded in the financial realities of risk and return relative to the broader tradable markets. And powered by automation and composability we've seen through smart contracts and digital ledgers. So at least here at Apollo, we're focused on being real world practitioners of Web3 technology, rolling up our sleeves, actually testing out the blockchain protocols, building on smart contracts, helping to build new products to help support and shape this industry as this technology shift is happening.
Right.
And then additionally, we've started investing across the technology stack, focused on identifying ambitious founders that can benefit from our markets expertise across those markets and our scale. And so it's been an incredible entry point for us at Apollo, since we're just starting with a bunch of dry powder in this space in this winter cycle.
Certainly. I mean, look, if you find any of those founders that can help me turn any of my old JPEGs that I created in Paint into something valuable in the future too. I know this is just a small part of the broader NFT landscape and broader crypto and blockchain landscape, but I would certainly appreciate that as well.
Working on it.
Yeah. David, I'll turn it over to you.
Well, yeah, I mean, Christine, to your point, I mean, you've been working in the space for a long time, and you're deeply enmeshed, and it sounds like looking at some of the cutting edge sides of the technology. But, you know, Sheila, if we turn to, Washington, the story of regulation, at least in the US, but I think you could say sort of more broadly, is like very unclear. And, we've seen President Biden release his executive order on cryptocurrency, and we're starting to see federal agencies respond with reports coming out. And I was sort of curious, how has the conversation in Washington around cryptocurrencies changed over the last 6 months? I mean, it's often sort of a topic of sort of what is holding back maybe the asset class from getting more adoption.
Well, it's changed a lot. And I think to the point you're making, David, it's not just about Washington. We're seeing a lot of activity happening all around the world from the regulatory space. I think the thing to note is that technology is moving so fast. Christine did an acronym dump on us earlier, right? You've got DeFi, you've got NFTs, you've got DAOs, you've got so many of these concepts that are still being formed. The market hasn't yet weighed in on the direction that these things should go or will go. At the same time, you've got regulators scrambling, I think that's the right word, to keep up and provide some clarity around this, both to help the industry shape and build on more solid foundation, but also to help consumers make sense of what all of this means. So we're seeing activity out of Europe, we're seeing activity in South Korea, Australia, the UK, India, Japan, I mean, really all over the world. United States, in Washington, tremendous activity, both federal and the state level as well. And I think that the thing right now, we've got two very active bills that are being discussed. One focusing on kind of which agency ought to have the stronger hand or a hand at all in regulating this space. The other on stablecoins specifically, thinking about what should happen in that environment. How do all these things play together? Will there be a digital dollar in the U.S. like the digital euro that Christine Lagarde announced earlier this year? It's complicated, and so I think the next 6 months are going to have us in an even different place. We're going into the midterms now. There'll be a potential shakeup and how the voices that are the most prominent voices and the positions that they hold on various committees. But all I can say for now is it's a space to watch. It's critically important to the entire ecosystem. And the decisions made, I think, over the next 6 months, certainly over the next year, are going to play an outsized role, I would think, in the development and the way that this technology ultimately lands with consumers.
So Sheila, with that in mind, and perhaps it's trivial of me to ask to kind of apply the rule of threes to this, but if I were to ask, what are 3 big things that regulators need to get right when they're thinking about and working through what crypto legislation should look like, especially here in the US? What would those 3 things be?
Oh gosh, it's so hard to pick, right? So here's 3 things I think that are important to keep in mind. And one is, this is global. Nobody's waiting for the United States to act or not act, as the case may be. And so while there is some influence, the US still has significant influence over these markets, that's not going to last forever. We are seeing MiCA, which is the big comprehensive legislation that's landed in Europe, start to be implemented. That's going to have huge implications potentially on how builders build, how consumers engage with this technology and offerings. The second thing I would say it's really important to note is, despite the attention on the price, and this entire framing of this conversation is about how that's not the most important or only thing, this is about a lot more than just financial services products. This really is about building a new version of the internet, a decentralized internet. Christine laid out what Web3, what that concept means. So thinking about how this will work in spaces like data, spaces like the creative economy, all of that is really, really important. So global frame, more than financial services and products. And the third thing I would say is that the details really, really matter. So I think a lot of folks tend to think of regulation as just kind of providing this very broad, playbook, but actually there's a lot of nuance and detail, and the conversations are happening live right now. And a lot of that is going to be critically important. So meeting with technologists, making sure that there's understanding about what's actually happening in the trajectory, what's moving forward, is also just it's just critical and crucial here, even more than it's ever been before, I'd say, in other industries.
So Christine, hearing all that, what's the timetable for Web3 to be part of an everyday person's life? I mean, if we're going to transact and get our coffee, or whether we're going through, a car transaction, what is the timetable that we have to look out towards?
Okay, that's a really good question. I mean, I guess the thing with technology evolution, it's one of these things where when you're in it, it rolls out like quite slowly and incrementally. But then in retrospect, it looks like it happened very fast. And so what I mean by that is, you mentioned I've been in the industry for over 6 years. And in those 6 years, I've seen the building blocks of blockchain protocols actually be created and get adopted, or, stable coins get created, or, the primitives around lending and borrowing via smart contracts, which later evolved into DeFi. All of these things started as very big ideas against a backdrop of a difficult reality. In fact, that it didn't exist. And also there was a lot of regulatory, stuff to navigate. But in the past 6 years, all of that has actually come to fruition. Ideas have come to life, and they've been used and actually tested with real money, and actually have had multiple teams around the world with different, levels of expertise around technology and financial markets and infrastructure, all contributing in open source code. So, it's moving fast, but moving fast and slow at the same time. In terms of, and so, I feel like we're just kind of at the stage where, the key building blocks of the infrastructure have been put in place, but now it's about the real world applications. And this is where, the real world assets that we're hyper focused on from Apollo's point of view, may start to emerge. But then additionally, a lot of work around user experience. Blockchain technology is actually back-end technology. And, if we do this right, Web3 doesn't become a noticeable part of our lives. It just sinks into the background. Yeah. It's just stuff that drives, the applications and our use cases. And in fact, it becomes a little bit boring.
Certainly.
And so, basically I would say in the next couple of years, we should see an acceleration now that the foundational pieces are in, and now it's more focused on what do people find compelling. I think NFTs were a glimpse of how a broader user base could be compelled with, use cases that were broadly cultural, and maybe less financial. I think there's just a small subset of us nerds that, are kind of building, really interested in, all of the hyper financialization overall. So I think the path to, broader adoption is probably something more fun, funny, mimetic.
Absolutely.
Well, that's
so the next few years, we'll see the acceleration.
Thank you.
But it'll be slow and fast at the same time.
Yeah. That's about all the time we have, so I think we'll cut it off there. I just was going to leave it for closing remarks. Sheila, what should we expect in the next quarter as far as regulation goes?
We only have about 30 seconds, Sheila.
Yeah, very, very active conversation. Very active conversation in the US and Europe and all over the world. Hopefully there'll be some, symmetry, or at least compatibility in what comes out of these different places, but maybe not. So it's just a place to watch for sure.
Crypto Council Head for Innovation CEO, Crypto Council for Innovation CEO, I should say, Sheila Warren, and Apollo Head of Digital Assets, Christine Moy, joining us here today. Thank you so much for the time and the conversation.
Up next, the new director of the National Crypto Enforcement Team, Director Ewan Young Choi, on how the federal government is protecting investors while allowing innovation to flourish.
Welcome back to Yahoo Finance's All Markets Summit, sponsored in part by Grayscale. I'm David Hollerith. A year ago, the Justice Department stood up the National Cryptocurrency Enforcement Team to effectively lead enforcement of crypto-related cases. Since then, the team has prosecuted cases ranging from crypto mixing services to scams, insider trading, and national security threats. Joining us now to discuss the team's role in shaping the market integrity of cryptocurrencies and how it balances that without thwarting innovation is Anyang Choi, Director of the National Cryptocurrency Enforcement Team. Anyang, thanks for being here.
Of course, thanks for having me, David.
So to start off, can you just tell us, what is this team, INSET, what does it do?
So the National Cryptocurrency Enforcement Team was set up by the Department of Justice to really be a one-stop shop of subject matter experts drawn from across the department. And the reason for that is because the department realized that there had been a situation in which we've seen digital asset criminal use evolve. Early days, it was darknet markets, and it was people buying and selling all sorts of contraband and narcotics on those darknet markets. And these days, we're seeing it pop up in every single type of criminal activity the department looks into. We really need to bring together those who've been working on this issue for some time in order to address the more cutting-edge issues that we're looking at. And so, as you mentioned, one of the focuses we have is to make sure that we are appropriately addressing the ecosystem, looking at mixers, tumblers, and exchanges, and other money laundering platforms that help facilitate that type of criminal activity. And we also want to basically up everyone's baseline game when it comes to digital asset prosecutions and investigations, because we're seeing it in ransomware, we're seeing it in frauds and thefts of all sorts. And we want to make sure that it's not just the specialists who have the tools necessary to fight and disrupt this type of criminal activity, but that prosecutors from throughout the department can have access to those tools, understand how best to use them, and know where the resources are throughout the department to help them in their fights and their cases.
Yeah, and you're speaking obviously to this prosecutor network that was recently announced. Right. And so I'm curious there, what does success look like for that?
I think, well, just to give you a little bit of background, the Digital Asset Coordinators Network is a dedicated network of 150 plus prosecutors drawn from across the department. That's the 94 U.S. attorneys' offices, as well as the different sections at Main Justice that deal with things such as national security issues, antitrust, environmental and natural resources crimes, and even in the civil division and the tax divisions as well. And the idea is to be able to have a network of prosecutors devoted to being the first line of defense in each of their offices. So in any investigation in which a digital asset or a cryptocurrency issue comes up, people will know where in their office to find the help that they need to understand these technologies and to stay abreast of all the developments that we're seeing in the ways in which those technologies can be abused by bad actors. So that's really what the network is about. And success for us is making sure that each prosecutor feels empowered and armed with the right tools, knows how to apply the authorities that we already have to combat these crimes, and realizes that each prosecutor realizes that for every investigation, there are going to be challenges. Digital assets is one that you can address using the tools that we have in many instances and just understanding the new ways in which we're applying them to a new problem set.
And how is prosecuting cases involving crypto different from other assets?
So I think there are a few technological aspects of cryptocurrency that make them pose certain challenges and also certain benefits to law enforcement. So I think the easiest thing to think about is public ledgers. For the most part, most of the cryptocurrency crime that we see still rely on public ledger technologies, in which case you have a ledger that is available. You can see all the transactions that anyone's ever had. Now, that is very useful in terms of trying to chase down the flow of funds for any criminal activity, but we still need to understand how to get behind the addresses that are on that ledger. We'll know that the transaction may be criminal, but who is actually behind that particular transaction, that particular address. And that's one of the tricky things about cryptocurrency, is that it has built in this sort of anonymity, pseudonymity factor, because it does not necessarily put a one-to-one on the address and the actual real person that's behind those types of transactions. These are also very cross-border in nature. So, an example I like to give is you might have someone who's a victim of a cryptocurrency crime in the United States. The bad actor might be in country number 2. They may be using infrastructure such as a cryptocurrency platform mixer that may be incorporated in country number 3 or registered there even, but the data is in country number 4, and the people who work for that platform may be in country number 5, and trying to deal with bringing together all the different sources of data that you really need to do, both off-chain and on-chain, in order to get to the bottom of who's behind criminal activity can be tricky, like it is in all cyber cases or cross-border investigations generally. And also that it's, these transactions are immutable and they're irreversible. That's one of the benefits to cryptocurrency in some instances, in that these transactions can oftentimes be relatively frictionless and quick. But it also means that if we identify a particular transaction as being criminal, we can't go to some centralized, financial institution and ask for that money to come back. That's not how the blockchain works. And so finding ways to deal with that and still be able to chase funds to places where we may be able to capture those criminal proceeds back and provide them to the victims is one of the challenges that we face in this area.
Right, in the decentralized area of crypto, which DeFi, it's a broad term, it can mean a lot of different things. It's one of the most promising areas, at least people working in the crypto industry say, but it's obviously a place that has been fraught with what you call security exploits this year, or hacks too. People sort of say they're the same thing, sometimes they're kind of slightly different. So I was sort of curious, given the amount of hacks we've seen, it seems like one every week this year, what is the responsibility of sort of the private sector versus the public sector in sort of reducing the level of exploits in crypto? And added to that, what do you think the root problem is?
I think what is going on here is that the crypto industry and DeFi in particular has really exploded in market cap and size over the past few years even. And so I think it's unprecedented in the amount that the industry has grown and the ways in which DeFi have evolved the technologies that have traditionally been used in a variety of different ways, but now are being used to create financial products that in sophisticated multi-chain means. And so I think especially in these cross-bridge hack situations, which is what you're alluding to, the bottom line is that the industry is still, in our view, in a maturation phase. In a lot of respects, we're looking at companies and hoping that they will understand that doing things such as basic risk reduction, having robust compliance programs, and ensuring that they are decreasing the opportunities for these type of exploits on their own platform is sort of the first best line of defense. And I think a lot of these exploits, as we see them, are situations in which the code is exploited in part because maybe there would have been, if there had been more robust code audits, for instance, people might have caught these particular opportunities for exploitation before the code gets pushed out writ large. And so in those situations, we're hoping that people will now see every week we have multi-million-dollar exploits along those lines. People will start trying to think about ways in which they're making their code more robust before it's pushed out. I think that's the bottom line.
Yeah, and what does a partnership look like between the private sector and public sector and sort of enabling more security auditing, I guess, before code's pushed out? Because obviously this is a fast-moving industry.
Yeah, I think it's a recognition that we have to work with the private sector and ensure that they understand the ways in which we've identified particular tactics that bad actors might be using in order to exploit these types of platforms. I think generally there is an understanding that every single week, if you see a new one of these, perhaps people within the industry are going to think twice before pushing out code and invest more in the front end auditing and basic sort of cybersecurity concerns that we see, as a general matter that we have as an issue that recurs within the private sector. I mean, I think people are now in a mindset where they realize that cybersecurity is a serious concern from a business risk perspective, and it requires investments on the front end from those who are responsible, not just sort of rushing to market with a particular product, but really making sure that you've kicked the tires on that product, and so that you're eliminating opportunities for bad actors. Especially, from our perspective, we're especially concerned with North Korean nation-state actors who seem to be behind a lot of these particular types of exploits and using them as a means to avoid, sanctions sanctions regime designed to limit their weapons of mass destruction program, for instance. I mean, these are serious national security concerns that really stretch beyond the fact that there are millions of dollars being stolen in single episodes that we see with DeFi hacks and exploits.
Yeah, the national security topic is obviously one thing, but if we're just thinking about for individual investors, to you, what is the most concerning digital crime trend or crypto crime trend that you've been following?
I think one of the things that we're particularly concerned about is that there's a lack of familiarity about the technology, but the average American consumer or investor might be looking at historically pretty significant returns on certain types of cryptocurrency or cryptocurrency investments. And so, it's a combination of fear of missing out, FOMO, plus a lack of familiarity in the technology that allows some investors to sometimes be duped by fraudulent schemes that are out there, that people who would abuse, the name of crypto and the promise of innovation, and quite frankly, participate in a series of old school Ponzi schemes or rug pulls or other types of thefts and frauds that happen with the American public. And I think, just sort of making sure that investors understand that they should be applying the same type of scrutiny that they apply to their normal investments in traditional finance to crypto it would go a long way. So if something sounds like it's too good to be true, maybe it is in fact too good to be true, like guaranteed high returns on investments without a real clear explanation as to what's going on. If you don't understand the technology and what exactly the product is doing, then perhaps try to do more research to figure out if this is the type of thing that you want to be investing in. And generally using your good sense in trying to make these decisions and not trying to be swept up in, the FOMO and the jargon that gets used in the crypto industry to make investment decisions that you might regret later on. I mean, there have been good returns in certain circumstances, but it's an incredibly volatile asset class. And so people need to be wary of that and think about that when they're actually investing in their overall portfolio.
Absolutely. Anyang, I thank you so much for coming to talk.
Of course. Thanks for having me.
Up next, the post-COVID travel boom. Hilton CEO Chris Nassetta joins us right after the break.
Chris Nassetta is president and CEO of Hilton Worldwide. He has a long and accomplished career in the global hospitality business and has been with Hilton since 2007. He's also former chairman of the World Travel and Tourism Council. Nassetta manages almost 7,000 properties with over 1 million guest rooms spread across a multitude of brands in 122 countries. He's leading the hotel giant amid a sharp rebound in travel and tourism after the COVID pandemic.
And welcome back to Yahoo Finance's All Markets Summit presented by Northern Trust. I'm here with Hilton Worldwide CEO Chris Nassetta and Brad Smith. Chris, welcome back to the All Markets Summit. So let's get right into it here. If the 2020 to 2021 period in the lodging industry was a depression, what would you coin what we're seeing right now?
You know, first of all, thanks, Brad and Brian, for having me on. Great to be back. I think I was on a couple of years ago. What's interesting in our industry, you're right, 20 and 21 were terrible. I mean, in the beginning of the pandemic, we were down 90% in revenues and then sort of clawed our way back through the latter part of 2020 and into 2021. But as we had different variants between Delta and Omicron and other things going on, we sort of, we're going back and forth. But as we started to get stability, coming through the Omicron variant in the spring and throughout and into the fall, we've seen very, very steady recovery. So I would say we're at the beginning of what I think is going to be a new golden age of travel. I mean, what happened is a lot of people thought, in fact, you guys were asking me 2 years ago, is anybody going to want to travel again? And I said at that time, of course, people need to travel for all sorts of reasons. They want to travel because they want to see people in places. They need to travel for business purposes. They need to travel to congregate as part of meetings and events for all sorts of reasons, whether it's, culture building, whether it's sales conferences, whatever it might be. And they're doing it. And so we've seen a very strong recovery in all segments of the business, led by the leisure business, but very strong recovery in business travel, very strong recovery in meetings and events. And it continued throughout the summer, and it is continuing into the fall. So I'd say, we're in the midst of a very strong rebound coming out of your words, not mine, a depression for hospitality business in 20 and 21.
Chris, take us further into that demand rebound that you're seeing right now, and especially as it relates to the corporate travel. This is a cohort of consumers that really accounts for so much of the profit margins for leisure and hospitality businesses. So when you're re-engaging with them, what have you been able to track to say, in your forecasts going even into next year, that this is going to continue to return, especially as they're looking across some of their own travel and expense policies, and that's tightening a little bit right now?
Yeah, well, I mean, clearly that is, and we expect it to continue. Having said that, there's a huge amount of pent-up demand, Brad, that is being released for all sorts of business travel. When you back up and look at the core of our business travel population, even pre-COVID, it was 80% small and medium-sized businesses. That's probably about 85, maybe even a little bit higher today. And what we found during COVID, and certainly in recovery, is that they're a lot more resilient. And the reason is that they're running their businesses. They have to get out and travel. They have to meet their partners. Their salespeople have to get out. They have to go to their other offices. And so they don't have as much of the luxury of saying that they're not going to travel. And so what we've seen is the big corporate business transient is recovered nicely and is recovering in a very strong way now, but is still not back to historic levels, where small and medium businesses are above 2019 historical high water marks. And I think it has a lot to do, as I said, with just people going for an extended period of time without doing the basic things that they needed to do to run their business. And I think it was a really neat idea to think that you could do everything virtually and everything on Zoom, and you could do all your culture building and all your innovation and all your sales and all the partner and relationship work in a very efficient format. But the real truth is you can't. And I think that was proven. And so I think what we're seeing is sort of the other side of that, where people certainly are going to use technology. I'm not going to be silly about it, in different ways. And the technology, as it advances, will take certain trip occasions and change them. But they're just being replaced with higher value trip occasions because people realize they have to be out and meeting one-on-one or in groups with people. And so I feel, very good about where things are going. I mean, clearly the macro environment is more challenging. There's no question that here in the U.S. and in much of the world, with inflation where it is, that central banks, including the Fed here at home, are going to do what they have to do to slow demand in order to, get inflation under control. I think that's a given. I think, it'd be crazy to say that that's not happening and going to continue to happen. But what's happening in our business is, as you said, we were not a beneficiary of COVID. We got beaten up quite badly. And we're seeing sort of the unwinding of a lot of that gives us quite a bit of wind in our sails, I think, for a reasonably extended period of time. What are those things that are being released? Well, people are changing their spending patterns, right? They are spending, during COVID, they spent all their time online buying things, okay, whatever that was, cars, washers, dryers, microwaves, things, phones, technology. Now they're shifting their spending patterns back to what they had been doing pre-COVID, which has been a multi-decade trend towards spending on experiences. Well, we're experiences, so we have this big secular shift back to experiences. The other thing we have going on is international travel. The world is almost all of the world is open up. There are parts that are still not, probably China being the most notable, certain parts of Asia, although Japan is opening up. And as that occurs, you're starting to get all of that international travel that occurred prior to 2019 sort of back and going. We have a long way to go to get back where we were, but it is starting to happen. And then, as I already mentioned, just pent-up demand. Just people had 2.5 years of not doing things they needed to do, whether that was for leisure or business or meetings and events, and that is being released. So in the face of some macro headwinds, we have some pretty nice tailwinds that are propelling, our recovery forward still. And you can look at the industry data we haven't reported, so I'm not going to talk about our data, but you can look at all the industry data up through last week, and you're not seeing signs in any of the segments of our business that suggest that the consumer that things are weakening. They continue to sort of power up and continue to recover in a positive way.
Well, Chris, just some food for thought. I stayed at a Hilton recently, and I did a Zoom call. So just to give you a little insight into how I am the new face.
I love that.
I am the new face of business travel.
Hey, Brian.
Yeah.
But here's the thing. Mobility is you're making my case to a degree that we didn't talk about today, but I've talked about many times. The world is getting more mobile. Mm-hmm. Technology is enabling that. You had a lot of other things that enabled it, low-cost airlines and other things over the last 20 or 30 years. But technology is connecting the world, speeding the world up, and making people more mobile. And the reality is COVID accelerated that process, where the office environment is changing, how you work, how I work, how everybody works is changing in a way that I think people are going to be on the road more. People being on the road more and being more mobile is very good for our business.
Chris, my back of the envelope math right now has you being the CEO of a public company for 22 years. Of course, first with Host, now with Hilton. You've seen some economic cycles. Does it feel like what the Federal Reserve is doing is going to slow the economy down markedly? Does this feel like we're headed into recessions past?
Well, it's really hard to know, and I'm not an economist, so I'll leave that to others you're going to have on that are smarter than I am on those matters. I do believe that what the Fed is doing is going to slow the economy down. I mean, they've stated it. That is their intention. That is what they need to do, and so I think that they will do it. I am certainly hopeful that as a result of the actions that they're taking, along with some of the natural things that are going on that have pushed inflation so high, sort of working their way through the system, some of the supply chain issues around the world as those loosen up, some of the labor issues around the world, particularly in the West, as some of those free up, some of the commodities issues that have been so difficult, which already have started to sort of ease, not just oil, but other commodities. I think the combination of sort of the natural process of those things sort of working their way through the system, along with what the Fed is doing, will slow the economy, will help bring inflation down, and the hope allows the Fed at some point over the next 6 or 12 months to sort of stabilize, having done their job with inflation more under control, and allow the economy to get its footing again and start a process of reacceleration. That is my hope. What are the odds?
Right.
I don't know. My own view is that there's a reasonably good chance that we will get a, reasonable landing, which is sort of soft to bumpy-ish landing with the economy. And as I said, it'll be what it'll be. In the case of our business and industry, I think that the tailwinds that we have, are going to take us for a while, just because there's some natural structural things I already described that are happening that are wind in our sails that are going to, get us through a decent period of time. Depends how long and how deep any slowdown is to know what the impact will be. And obviously, macro impact is going to have impact on us ultimately. But, our business is in fabulous shape. Our balance sheet's in incredible shape. Our margins are higher than they've ever been.
Right.
1 in 5 rooms under construction in the world have Hilton brands on them. We're opening more than a hotel a day.
Let's talk about that construction.
And we're performing at the highest levels broadly, if you look through Q2 from a margin and profitability point of view that we ever have.
Chris, let's talk about that room development, because as I look across the number of rooms that you have in development, at least as of the end of the most recent quarter, it's in surplus of 400,000 rooms that are in development right now. And so as you think through the development pipeline and when those come online, how long does it typically take for the property to be accretive to the business? And has some of the more short-term homestays that the trends in the market are clearly pointing to from consumers, has that changed the type of developments that you bring online?
That really hasn't. So the gestation period, once it's under construction, and about half of those 400,000+ rooms are under construction. Depends on where in the world you are, but I'd say it's 24 to 30 months, sort of on average, maybe 18 to 30 months, depending on where you are in the world. But things have gotten a little bit longer given all the supply chain issues. So 24 to 30 months before, once it starts, before it's open and it's generating fees. What we have seen is, certainly the extended stay business, of which we are, a huge participant with Homewood Suites and Home 2 Suites by Hilton, have been the best performers throughout COVID, and they continue to perform well. And so given more mobility, I think those sorts of products, have been somewhat favored, but not to the exclusion of the others. All of our brands at this point, all 18 are growing at a healthy pace, are driving the highest levels of market share that we've ever seen. And the reality is the demand patterns, while they're not exactly what they were pre-COVID, and I do think there'll be a bit of a shift when we get fully to the other side and get stabilized, it's a lot more like it was pre-COVID than you would think. And so people are going back to back to their normal sort of travel habits by and large. Again, a little bit more leisure, a little bit more bleisure, sort of the blend of the business and the leisure sort of put together. A little bit more, extended stay, so longer stay, which favors some of the extended stay brands we have a little bit more, but nothing off the charts that suggests that any of the brands that we have in our family of brands today isn't really appealing to customers. Now, as we think about new brands, and we are, and I'm not gonna get ahead of myself, but we're definitely thinking about, on the margin, some of the things that did shift during COVID. Do they suggest to us that there may be opportunities in terms of serving a broader customer base? And I do think, watch over the next 6 or 12 months. I think you may see some things from us that sort of address that.
Chris, real quick before I let you go, I went back to my notes from 2019 when you were at the All Market Summit. I didn't ask you this. I'm going to ask you now. What is the secret to longevity? You've been the CEO of Hilton for 15 years. How do you get that done? Give us some secrets.
I don't know. You know what? It's balance. Steady hand on the wheel. You know, have a great strategy, build a great culture, have a great team you can leverage off of. Make sure you have balance in life. And, you know, while this is, of course, really important to me that they're, you know, friends and family and other interests that are important, and, you know, keep everything in perspective. But in life and business, I think my longevity has a lot to do with just having an approach of having steady hands on the wheel, whether it's my business life, my personal life. Have a plan, work the plan. Don't jerk the wheel around, just steady approach.
Well, you, my friend, are timeless. You still look 32. Hilton CEO Chris Nassetta, thanks for joining us again.
I have a few more gray hairs than I did in 2019, but that, you know, goes with the territory.
You said that, not me. Chris Nassetta, always good to see you. Thanks for spending some time with us. We appreciate it.
Good to see you guys. Thank you.
Brad, over to you. The stock market is still open.
Still open indeed. And in fact, it's about lunchtime, or lunchtime is wrapping up at least. And you can kind of see that in some of the intraday activity here. We've taken at least a little bit of a tick higher here, most recently over about the past 30 minutes here in this 1 p.m. hour. So taking a look at the Dow Jones Industrial Average, you're seeing that up right now on the day, intraday, by about 2%. 592 points added on today's session. Let's check in on the NASDAQ composite as well. You're seeing that up by 3%, more than 3% at this point in time, catching a bid to the tune of about 343 points. And the S&P 500, you're also seeing that in the green by about 2.7%. Want to dive into some of the sectors that we're tracking very quickly here. We'll take you on over to a heat map view and taking a look at some of the 11 S&P 500 sectors. Well, yeah, they're all in positive territory right now with this rip your face off type of rally, at least here today, that we're seeing at this moment. We've got more broadly the S&P 500 up by about 2.7%, but outpacing some of the move higher. Yeah, you've got consumer discretionary. Keep a close eye on XLY as we move on throughout the rest of today's session. That's up 4%. Also want to take a look at tech here. You've got that up by about 2.9%, and here's why. Let's get on to another heat map. We heard you like maps, so we've got some more maps for your heat maps out there. The Apple stock, Apple shares, you're seeing that up by about 2.9% here on the day. Some other mega cap tech also ripping to the upside here. Amazon, that's up by about 5.75%. Microsoft, MST, up 3.5%. Google, Alphabet, Alpha Google, whatever you're calling them at home, call them up right now. They're up by about 4% there. You've got some lingering red here in the screen here, of course. You've got Applied Materials. That looks like it's in negative territory right now by about 0.25%. But then even more so as we get into some of the Dow components as well, you're not going to find too many laggards there. In fact, none. All 30 Dow components are in positive territory right now, being led largely by some of those tech names. JP Morgan also up by about 4.9%. We've got more earnings that are coming forward over the course of this week, and so keep a close eye still on some of the banks that have yet to report. We'll get into the regionals as well, but even more so as we get some more of these Dow industrials that start to report, that's exactly where the markets could latch on to what they have to say about their future forecasts. We've got more right after the break.
Coming up, believe it or not, the holidays are right around the corner. We'll take a look at what's ahead for the retail sector with Target CEO Brian Cornell. That's next.
Right now, the worst place to be is stuck in between. Accelerate your investments or pull back. Change the plan or stay the course. That's why Northern Trust is here. With specialized expertise, a history of success through every economic climate, and proven strategies rooted in data and analytics, giving you more control, clarity, and confidence. For now and whatever's next, Northern Trust Wealth Management.
Brian Cornell is the chairman and CEO of Target. He leads a team of more than 400,000 people working in almost 2,000 stores throughout the United States. Cornell is tackling some big issues head on: inflation, a slowing economy, and those pesky supply chain issues. But in a year of retail train wrecks, yeah, that's you, Bed Bath & Beyond, Target has outpaced the competition. In the fight to stay ahead, Cornell has made some very tough decisions, embracing the athlete's mantra, no pain, no gain. And so far, it seems to be working. Target Chairman and CEO Brian Cornell joins us now. Brian, good to see you in person at Yahoo Finance HQ.
It's great to be back together.
So I've been making a list. I've been going to Target. I go there every weekend. You know this. And I'm like, I have to ask Brian these things when he's in person. First, the retail inventory glut. Is it over? When does it end?
Yeah. Well, Brian, one, I appreciate the fact that you're always in our stores and you do send me notes, and I appreciate that. And you know, back in June, we made a pretty bold and decisive decision. We said, all right, inventories have built up, consumer shopping habits have changed, they moved into different categories, and we said we're going to get out in front of this. So for Target, we put that inventory problem behind us, and now we can focus on great execution, delighting our guests, getting ready for the big holiday season. So we were pretty decisive and said, we're not going to just let this roll into the next quarter. We'll deal with it up front. And now we're excited that we're ready to play for the holiday season.
I've followed your entire time as CEO as Target, and you've made a bunch of bold decisions. You exited Canada. First thing you did, I remember writing on that story as soon as it out. 2017 investor conference, we're investing billions of dollars. Market didn't like it. Now you're clearing out inventory. How hard is it to make these decisions as a leader?
Well, if I think about each one of those decisions, there was probably a very similar model that we followed. Said, all right, what's the right thing for the Target brand? What's the right thing for the Target guest? What's the right thing for our team? And when we think about it through that lens, it's always the right thing for our shareholder long term. So whether it was leaving Canada and putting all of our focus on the US business, or making that decision back in 2017, when others were closing stores, we said, we're going to double down on stores and put stores at the center of our strategy. We took the same approach this summer and said, all right, across all of retail, inventories have risen. We're going to get out in front of this and make sure that we have the right assortment, we deliver great value, we protect that guest experience in our stores, and we also did the right thing for our team.
I think you mentioned this is your 9th holiday season as CEO of Target. How do you think this season will shape up compared to those other 8 or 9?
Well, Brian, you know we spent a lot of time talking to consumers, talking to our guests, and the one thing we've heard throughout this year is they want to enjoy and celebrate seasonal moments. So the guests has told us they're excited about Halloween. It's still a few days away. They're looking forward to Thanksgiving and celebrating with family and friends. And they are looking forward to the Christmas holidays. So we know the consumer in America, the guest that shops Target, they are excited about seasonal holidays. And we're going to be ready to make sure we delight them.
Recession? Anything? Any indications you see? Store traffic, what they're buying? Anything that would suggest this could be a gloomy holiday season?
Well, everyone's talking about recession, and sitting here today, there's different points of view. You talk to bank CEOs, some gloom and doom, others are saying really healthy consumer. What we've seen all year long is really healthy traffic, and a guest that's shopping in our stores and shopping online. So that strength in traffic has been driving our business. We've delivered solid comps throughout this year. We expect that to continue over the balance of the holiday season.
All right, that is good to hear. So back to my shopping list here, if you would just indulge me.
Let's do it.
42 count of Tide Pods online, $13. Now, I'm a dumb millennial. I don't keep track of things that I buy in terms of price, but to me that seems like a lot. Are shoppers to your stores trading down? That seems like a lot of money for a basic essential.
Yeah. Well, Brian, core to our proposition is making sure we deliver great value and affordability every time you shop. So we measure pricing really carefully versus our competition, and we want to make sure we're priced right daily, we deliver great value and affordability. So on those items that you're looking at, we've got to make sure we have the right price every time you shop, and the guests expect that from Target.
How is your private label business doing in this inflationary backdrop?
So we now have a $30 billion own brand business, wow. $30 billion. And it's performed incredibly well throughout the pandemic and continues to grow. So whether you're shopping Good and Gather or getting something for yourself, Goodfellow that you can wear on set, or shopping any of our great brands, we now have 11 billion owned brands in our portfolio. So that business just continues to perform and will perform over the holiday season.
It's huge, Brian. So yesterday I was actually in Bayshore Target. I go there every weekend. Bayshore Target, shout out Bayshore Target. 15 registers open. 2 of them were self-checkout, but 15 registers total. 11 of them were closed. Is that the worker shortage?
Brian, we've been staffed throughout the pandemic. I mean, we have 400,000 team members across the country. And going back to 2017, you remember we made a big commitment back then to invest in our team. We said in 2017 we were going to get to a starting minimum wage of $15. Now, sitting here today, we made another big investment just a few months ago to say, all right, depending on the market, we're going to start at either $15, but it could be as much as $24 an hour to make sure that we have the team in place. We're going to hire another 100,000 seasonal team members for this holiday season. So because of our investment in wages, in benefits, in training, you know that we launched a debt-free educational assistance program last year. We've had over 70,000 team members raise their hand and say, I want to take advantage of that. So those investments have allowed us to retain and attract great talent. And we'll continue to make sure our team is our most valuable asset.
Brian, 100,000 workers, that's a lot. Are you confident you can get that number?
We are. Wow. We're off to a great start.
Interesting. So you spent some time in the grocery industry. Of course, Target is big in selling groceries. And I know you watched the competition. What do you think about this Kroger and Albertsons merger? Does this change the game for the grocery industry, and does it make you change how you think about your grocery offerings?
Well, we'll watch it carefully. Obviously, it's a new announcement. It's going to take some time to close, but we're going to continue to focus on our food and beverage business. I mean, we've seen really strong growth and market share gains for over 20 consecutive quarters. So the strength of that business has really connected with the guests during the pandemic, and has come out of the pandemic is really a strong driver of growth. So we're all in on the food and beverage business. We'll continue to invest. We've got a couple of great owned brands there. I mean, Good & Gather is a $2 billion brand for us now in food and beverage. The guest has really responded all to a brand called Favorite Day. So we feel really good about food and beverage driving traffic and complementing our multi-category portfolio.
I think I've seen wine at a Target too. These are big departments.
They are. They're really important, and it's important for our guests. So we always listen to the guest, and they've told us food and beverage is an important category for them. It drives traffic, but I also know when they're there, they're shopping beauty, they're shopping apparel, they're getting something for their home. So it complements our business really nicely.
The new shops, the new cosmetic shops inside of Target, how are they starting?
Oh, the Ulta Beauty inside of Target, it's been great.
Bayshore just got one. Again, shout out Bayshore Target. Yep. It's a big part of the store. And the interesting thing is, Brian, and you know this, obviously, walk into a store, it's right there. It's the first thing you see when you walk into these stores.
Well, beauty's been an important category for years now. And Ulta just complements our beauty offering. And it was one of the things that our guests told us. We said, all right, what brand would you like to see here? On the top of their list, they said, we love Starbucks. We love the fact you've got Disney stores.
Don't take away my
and
Starbucks
Apple stores. But they love the fact that we've added Ulta Beauty. So those partnerships, whether it's CVS and pharmacy and Starbucks in almost every store, more Apple shops, more Disney shops, and now Ulta, it just complements the great offering we have of national brands and own brands.
You just signed on for another, I think the press release said about 3 years. So let's just say 3 years. What does the next 3 years in Brian Cornell's life look like in terms of chairman and CEO of Target?
Yeah. I think it's going to be another chapter of growth for our company and continuing to invest in remodeling stores and building new stores in great locations like Bayshore, developing our own brands, accelerating our national brand partnerships, and making sure that we continue to invest in our team. And there's lots of things I'm proud of. And the fact that we added $30 billion of growth since the start of the pandemic is something that our team feels really good about. What I feel, to me, what really fires me up is the investments that we've made in our team and seeing the diversity in our organization, seeing the growth opportunities, seeing our culture come to life. When I talk about culture, we always talk about a culture of care and growth and winning together. That's something that I'm going to continue to focus on for years to come.
Brian, I've only known you to be a fired up guy. You're fired up right now talking about the Target's business and its future. Where does that come from on a personal level?
Well, for me, this is an amazing brand. And I've got to tell you, Brian, I wake up every day feeling the responsibility of leading the Target brand. Those 400,000 team members that work for us, those families that depend on us across the country. So I wake up with a huge sense of responsibility. And the pride I have in the team, in that brand, in the role we play in America is something that gets me up each and every day, feeling great about the role that I sit in today.
Growing up, did you see yourself as a CEO?
Yeah. Well, Brian, I think you know my story. And I grew up right down the road here in Queens as a poor kid who kind of has worked for everything I've had. And I never even imagined I'd be sitting in a chair like this. But I embraced the moment, and I just feel proud to work for a great company.
I was just having a moment there. I very much identify with that, Brian. That much is for sure. How have you balanced it all? This has been a very challenging 3 years for executives, not just CEOs, CFOs, COOs. How do you balance this time, and how do you just stay grounded?
Yeah. Well, I'll go back to, I work with a great leadership team, the best leadership team I've ever been part of. I have an amazing wife who's been married to me for 40 years now, a great family that supports me, and as you know, I take care of myself. I make sure that I get to the gym every day and work out.
You called me out on that. Yes, I shouted that out.
Yep.
Full disclosure, when Brian, that news hit the wires that you were staying for 3 years, I said, look, Brian's a fit guy. He can stay on for another 15 years. How do you think about succession? At some point, you will not be the CEO of Target. Shareholders, I'm sure, won't like it. But is that one of your most important jobs right now, outside of planning for holidays?
Yeah, I think for any CEO, succession has to be something you focus on every day, not just for my role, but for my leadership team and the officers and those key roles throughout the company. So we spend a tremendous amount of time. I have a fabulous HR partner, Melissa Kramer, and we spend time every week talking about talent. Last week I was traveling, I was in Washington, D.C. I had a group of 28 Black Target officers that were with us in D.C. We visited stores together, we spent time with outside speakers, and I'm always investing in talent and making sure I get to know the team. I spend time with them, we travel together. But as a CEO of a company like ours, $106 billion growth company, you've kind of constantly be focusing on talent development and thinking about who are the future leaders that are going to guide this company whenever that day comes and I'm not here.
Fair enough. Let's just, before we let you go, we're running short on time here. Let's just go back to the economy real quick, because we are up against the holiday shopping season. So you see no recession. You think consumers will spend this season like they spent last season?
I think it's just a very unusual time from an economic standpoint. We're coming out of a pandemic. There were lots of stimulus checks that have been written, lots of child care support. We're starting to see a consumer get back to normal life. They want to travel again. They're out in restaurants. So sitting here today, we're on one side, we've got inflation that's at a 40-year high, but unemployment incredibly low. And I think those two things are balancing out right now. So we continue to see a healthy guest shopping in our stores and shopping online. We'll see how they react throughout the holiday season. But when we talk to them, they continue to say they want to celebrate the holidays. And we know they're out on the streets of New York, they're in restaurants, they're in our stores. So right now we're seeing a stable environment.
Do you worry about, I'm sure in the green we heard Hilton CEO Chris Nassetta just talk to us about what the Fed may do to the economy. Do you fear the Fed and what they're doing?
Well, we've got to watch it carefully. But in our business, Brian, we've got to be agile. We've got to prepare for any environment. It's part of the strength of our multi-category portfolio. We sell food and beverage products and household essentials. We have all your beauty needs. We have toys for kids and apparel and home items. So we'll balance our portfolio to make sure we're meeting the needs of the consumer no matter what the environment looks like.
All right, let's leave it there. Brian Cornell, always good to see you.
Great to see you.
It's been a pleasure following your time as CEO of Target. I'm looking forward to continuing to follow it, indeed. All right, we'll be right back.
Coming up, Pharma forging ahead. Pfizer CEO Albert Bourla lays out the company's plans for growth in a post-COVID world.
The world is trying to move past COVID-19. Many people in the U.S. are there already with large maskless gatherings, pretty much the norm at this point. Pfizer, of course, one of the companies that helped us get here. It is still relying on COVID for a lot of its revenue, but its CEO has his eye on what will drive the next phase of growth. And that CEO, of course, is Albert Bourla. He is joining me now. It's great to see you again. Thank you so much for being here.
Thank you for having me here.
You know, as I said, we are trying to move, of course, past COVID, but it's not quite done with us yet. You yourself had COVID a couple of times, I believe, in the August timeframe. And I wonder if we're ever going to get to the point where vaccines can actually prevent COVID and its variants entirely. Is that the end goal? Is it a realistic goal?
First of all, I had COVID once in August and one in October.
Okay.
And the second time was in the UK. I think that the goal is to bring vaccines that they can last a year. I think that will simplify things because I believe that people will not be that diligent to do the vaccinations as they are tired of making too many vaccines, and they want stability. But if we have a yearly vaccine, which is something that people are used, like flu, for example, this is something that will take a significant amount of people to be able to get it. And yes, I think with the right vaccines, we can prevent from infections to hospitalizations to deaths and severe diseases. But of course, the vaccine has shown that death and hospitalization, the prevention is very high. When it comes to infections, the bar is a little bit lower.
So it's more comparable to a flu than, say, a polio, for example, something that you're just trying to eradicate.
Oh, unfortunately, this virus is very nasty and makes a lot of variations and insists. So I think, although nobody knows, most scientists are in agreement that for the years to come, the virus will be around us. But we are lucky because we have a vaccine that can adapt. As much as the virus stops, the new technologies allow us, the vaccines, to very quickly follow and have a vaccine that's very effective against the current virus.
And indeed, you all have just introduced a booster that is targeted at one variant of that virus, Omicron specifically. Do you envision it where everyone ideally will get a booster every year? Or will it just be, recommended for certain portions of the population?
I think the health authorities will make those recommendations while they see what is the severity of the strains that are available. But in any case, I do not expect that people will comply with these recommendations as they did maybe in the first months of the pandemic that people were really scared. So complacency will be getting in the way. So I see that the volumes of people that will be getting the vaccine will be less.
And that's what we've seen already, right? Uptake of boosters has been pretty low. I saw one figure recently, 1 in 10 eligible people are getting them. You all have sold a number of boosters already to the U.S. government, so that demand taken care of. You're forecasting $32 billion in vaccine sales for this year, $22 billion for Paxlovid, which is to treat it. What kind of visibility do you have beyond this year in terms of those sales?
I have kind of visibility. I know orders that already have been signed, and I can calculate the demand. But 23 is going to be a year that likely will transition to many markets from governmental purchases to competition in the marketplace, which means that vaccines and treatments going through the normal challenge. I anticipate that will happen in the US in 23. Now, as with all our products, we will provide guidance to the best of our knowledge about how much we expect next year to make when we give guidance for 2023.
Now, I saw an estimate today, the prices are going to go up as it goes more towards a normal type of marketplace. So. I saw an estimate from a company called Airfinity that the average price per dose is going to go to $37 next year from $18 last year. Does that seem in line with what you all are planning?
I don't want to speak about price, but right now, in our contract with the US, the average price was 30. And that was divided between some that are less, some doses, multi-vials, and then all the way to 50 in the single vials. And likely in the launch, we will have all the way to 50. The vaccines will be priced based on their cost effectiveness. And the cost effectiveness is multiple of what it is right now, the price when we give to the governments in the pandemic.
You, of course, came out with the vaccine in partnership with BioNTech, which is the German company, and you've split the revenue with them. How long does that partnership last? Will it last even as we get to different stages of the pandemic? Is it an indefinite partnership?
Absolutely. It's an indefinite partnership in COVID. And we are both focusing on bringing new science into building new, most effective vaccines. Apparently, the one most important element is what we discussed before, a vaccine that will last a year. And of course, combination with flu is another very important.
Right. I wanted to ask you about that. You just started phase 3 trials, right, of the combination COVID flu vaccine. I think that was in mid-September that
What
started.
we started, it is a combination study of a flu RNA vaccine.
Right.
And we are about to start a combo as well.
And what kind of timeline then do you look for that? For those
I think the flu vaccine, likely based on events, because it's an event-driven study, if there is a lot of flu, will come into fruition sometime next year. We don't do immunobridging for that one. We are very confident that the vaccine will have real efficacy. So we went directly to study the efficacy of the vaccine. For regulatory purposes, you are required only to do immuno studies. So that will take their time. And then the combination, if you have already an approved COVID-19 and you have already submitted, about to be approved flu, the combination is very easy.
Now, you mentioned more international expansion as well and different ways of marketing the vaccine. You have a partnership in South Africa with the semi-national company there, which is starting production of the vaccine now, but it sounds like that they may not actually bring it to market until next year. What can you tell us about where they are with that and whether that is sort of a model for other partnerships we might see around the globe with Pfizer?
First of all, this partner is a very trusted partner of us in South Africa. And we did this project because there was a lot of requests to feel good, better, the African countries that was in their continent production. But unfortunately, few months after the first months, we had enough vaccines for all that were produced, but those countries did very small number of vaccinations. It was not the availability of the vaccine, but it was many other reasons, infrastructure of them to be able to administer it, hesitancy from people. And I think this is the issue that we need all to address, to make sure that those people will believe and they have a system that is easily can vaccinate.
Yes, that's been an issue, obviously, everywhere, not just there, of course. What can we look for next from the messenger RNA platform? Because there's been a lot of talk about that this is just the beginning. It's been worked on for years. COVID was sort of the big breakthrough event, for better and for worse, mostly for worse for the globe. But what now? There's talk about cancer vaccines, it's used for other applications. So where is Pfizer on that?
I would say there are two horizons. One, it is applications, and the other is the technology itself. There's a lot of work that's happening to improve the technology. Now it's modified RNA, could be self-amplifying RNA, could be circular RNA. There are a lot of work happening right now that you can have, let's say, way better, even RNA vaccines. The other thing, it is what applications. And I think the easiest hanging fruit, the lowest hanging fruit will be other vaccines. So there is a lot of work right now that is happening. And we will know, I think, late this year, next year, if those work. A second horizon will be in cancer. There is a lot of work that is happening right now. And then the third horizon, I think it is in gene editing. Gene editing is a very exciting technology that for people that they have a mistake from birth on their DNA, and that causes a significant disease to them, you can go and correct this mistake. And for those people, it's really salvation. So I think we will see very exciting things from this technology.
And are you planning to do much of that work internally at Pfizer? There have been some questions on the part of analysts about whether how much progress you could make without a partner, as in BioNTech in the case of the COVID vaccine. So talk to me about how that's working within Pfizer.
No, there are issues with intellectual property, who has the technologies and the platforms, and there are issues with the combined work of two companies producing more. I think with BioNTech, we have a lot of collaborations. For example, we are about to enter in a zoster vaccine that, again, is happening with them. And we are working to expand even further. So there will be a lot of things that we are doing together with BioNTech. But they are doing a lot of things alone, and we are doing a lot of things alone. We are not shy from collaborations. Actually, we believe collaboration is a better way to bring science to the world today. For example, in gene editing, we are partnered with another biotech company that they have appropriate technology, and we have all the expertise and scale to be able to produce solutions faster.
Now, Albert, going into the pandemic, before the pandemic even began, there were a lot of questions about Pfizer facing patent cliff, et cetera, et cetera. And then the pandemic happened. You had recently come into the company and were trying to change it culturally and the way that Pfizer did business. The pandemic sort of did that, and you did that in concert. So where are you now in terms of that question of what is next for Pfizer? What's going to be the next source of revenue as you are going to see patents roll off for various products?
I think the pandemic, from that aspect, in all the bad things that brought to the world, brought us something very important that gave to the Pfizer organization a belief that nothing is impossible. A belief in the culture that if we set our mind to a goal, even if it is very big, we will make it. That's a big competitive advantage, I think, for the culture of this organization. Now, going forward, as you said, we are starting losing patents of some of our existing products in year 26, 27, 28, 29. So, and there is a lot of discussion on how are we going to bridge that gap. So from 25 to 30, depends which is the analyst that you read, could be from 17 to 20 billions of losses. We are having 25 billions that we are bringing through business development. COVID was nice in terms of revenue creation, like COVID vaccines, but we are investing all of that. And we are investing in science that could bring products in 25, 26, 27, 28, 29. We committed to bring 25 billions of risk-adjusted revenues by 2030, and we are already exceeded the 10. Now, our internal pipeline, it is what I think it is the biggest competitive advantage. And the business development will provide growth over the loss of exclusivity. We are losing 20, we are gaining 25, so it's a small growth, but the pipeline will be on top of it. Only next year, we are expecting to launch more than 10 products. Some we are expecting to see the results right now. That's why I don't give a specific number. 5 new vaccines, 2 oncology medicines, 2 immunoinflammation medicines. All of that next year. And 24, another round of new innovative vaccines.
And just by way of comparison, you said more than 10. What's a typical number of launches per year?
1 or 2.
In the past? Right, so so you guys are busy.
Very busy. I think next year for Pfizer, it is a pivotal year. It is the year that we can prove to the world and we can prove to us that we can do multiple launches. I believe in the strength of our commercial organization and in the strength of our manufacturing organization, because it's very difficult for any company to pull together 10 new medicines manufacturing-wise and revenue and sales force-wise.
And those, of course, are already in the pipeline at the company. That's not even to speak of acquisitions. You've made a couple of acquisitions this year, most notably Biohaven, which just closed recently, Global Blood Therapeutics, which was just announced. You have a lot of cash to make more. Are you going to be making a lot more acquisitions? And I think we've talked about this in the past, maybe not as large as legacy Pfizer, but maybe these sorts of mid-size acquisitions, is that the path you see going forward?
I think so. This is what we have told our shareholders, and this is what we believe, that it is the best value creation. We want to acquire science at early stages that we can add value to it by bringing our manufacturing capabilities, our clinical development capabilities, all of these things that we demonstrated during the COVID period that we are able to do it, so that we can do way more with these medicines in our hands than if it was in the originator hands. We promised, or we set a goal, that we will make 25 billions of risk-adjusted revenues. We will acquire 25 billions of risk-adjusted revenues. I feel very confident with what I see that there is enough substrate to do even more than that at prices and value that requires a discipline. We're not going just to buy things. We're going to be very disciplined with our acquisition. You mentioned some of them that are extremely well received by the market, the Biohaven, the Arena, and we will continue doing that.
Albert, good to see you. Thank you so much for coming in. Really appreciate it.
Thank you very much.
Thanks. That's Albert Bourla, the CEO of Pfizer.
Up next, healthcare access for those who need it most. Scan Health CEO Sachin Jain joins us right after the break.
Healthcare in America and addressing the inequality gap. Medicare Advantage insurer Scan Health is launching a new plan focused on older LGBTQ adults. Our next guest says the goal of the program is to help these underserved community and address their specific needs. Joining me now, Scan Group and Health Plan CEO, Dr. Sachin Jain. Sachin, thank you so much for joining us today. Really an absolute pleasure to have you today and to talk about a lot of really important healthcare topics. You ready for this?
A real honor. Thrilled to be here with you.
I want to start off with obviously the news that we got with your plan specifically focused on the LGBTQ community. Really an interesting move and really need an explanation on why it's important to break out a plan just for this community.
Well, Saturday was the start of the annual enrollment process for Medicare Advantage beneficiaries. And what I would say is what we're seeing increasingly across the entire marketplace is plans that speak to specific populations who have historically been underserved or unserved. And the LGBTQ plus population is certainly one of those populations. If you think about the era in which many LGBTQ plus older adults, senior citizens, grew up. They grew up in the shadows of society. They grew up having to hide their identity. And times are different in 2022. And we want to make sure that part of what we're doing as an organization is being inclusive of all older adults. And that, specifically includes making sure that we're meeting the healthcare needs, the distinctive healthcare needs of people who are part of the LGBTQ plus population. I think having grown up in the shadows, I think many people from this population ultimately feel, have a greater burden of mental health needs, a greater burden of needs in terms of navigating the provider networks, and finding physicians who are sensitive to and can speak to the specific, healthcare needs of that population. And so we were thrilled to be able to partner with Included Health, which is an organization that's has built specific product offerings that are oriented towards this community to make sure that we're offering care that is culturally competent.
And that speaks, we're seeing the progress there. We're seeing even the launch of telehealth and other startups that really cater to this community. Now tell me, how do you plan to do this at scale? Because scale has been the issue for every single company that has ever tried to really push some sort of equity effort or try to really focus on different communities. How do you plan to do that?
Well, I think it requires an organizational commitment. I think there's been a historic view that populations are monolithic, and I think one of the things that the pandemic taught us was that the only way you can actually move the needle on health outcomes is when you start to think about specific communities and their specific needs. And so, we at SCAN, are joining an increasing, number of companies in the healthcare industry that are actually starting to take a look at specific populations and go deep. We're making the kinds of investments that historically weren't made to serve specific verticals and specific populations. I think one example that you and I have spoken about before are the investments that we made in actually reducing disparities in medication adherence in the African American and Latinx populations. And I think what we've shown time and time again is that when you pick a particular population, identify the unmet needs, and actually build interventions to address those needs, you can actually move healthcare outcomes in pretty significant ways. And so our efforts in the LGBTQ plus population are just the next example of that for us at SCAN.
So when we're talking about how you plan to go about doing that and scaling that up, we've talked about, for example, the shortfalls that the overall healthcare system has and misaligned incentives. And that's some of the reasons behind no other large-scale company pursuing this. And for those who don't know, you've had the experience across the board in healthcare, in government, in insurance, and in other healthcare settings. So you really have seen behind the scenes. What would you say is the reason why we're not seeing more of these kinds of efforts?
Honestly, I would say it's leadership, Anjali. We've got organizations that have historically not necessarily given priority to these topics. You see a lot of talk coming from across the healthcare industries, entities that are, saying that they believe in health equity, saying that they believe in disparities reductions. But when you actually look at the real investments that they're making, they're small and they're insignificant in the context of the broader challenges we face as a society. And so, my view is that while there's a lot of rhetoric that's being devoted to serving, underserved populations, the true investments that are being made are actually quite limited. And so I think when I think of solving these problems, I think where it needs to start from is ultimately leadership and more organizations making real commitments as opposed to just the window dressing that we've tended to see. I think the window dressing has created the impression that organizations are trying, and because the metrics haven't necessarily moved, it's making us feel like, our efforts are failing. Mm-hmm. I would say the efforts have just not been significant enough, deep enough, or impactful enough because, they haven't necessarily been at the center of an organization's strategy. A lot of what we're trying to prove at SCAN is that when you actually set these priorities and make, relevant investments, you can not only move, clinical outcomes and reduce disparities, but you can also move business outcomes. And that's our goal. We're not doing the Affirm product, the LGBTQ plus product, purely for, altruistic reasons. We actually think that there's a market that is underserved here and where we can actually grow share. And so I think that there's this interesting moment in time when there's an alignment of business interests as well as doing the right thing from a social justice perspective.
And to that point, insurance has been largely the key factor that's been missing because there are a lot of cash options for those in the community. Now, talk to me about the blame game, because I know that's something you've also talked a lot about. And we know that right now, especially with what we saw with the Inflation Reduction Act and just generally, largely speaking, a lot to do with how healthcare functions. Tell me about this blame game of clinical providers blaming insurers, blaming the drug companies, blaming PBMs. Everyone points a finger at being the reason why healthcare costs are so high. How do we fix that?
I think what you said is exactly right, Anjali. I think it starts with actually taking a hard look at ourselves and looking at the ways in which we're making things more challenging for patients. It is very easy to point at drug companies and say that they're gouging patients. It's easy to look at hospitals and saying they're engaging in predatory practices. It's easy to say that about physicians. It's easy to say that about insurance companies. But the reality is that I think all of us are culpable in creating the healthcare system that we have. And I've, to your point about my background, I've sat in all these seats across the healthcare industry, across all these verticals. And, the common observation is that we're not necessarily doing enough from the seat that we're in and the moment in time that we're in it. And instead, we spend a lot of effort trying to blame others for why things are dysfunctional or broken for patients. And I think, there needs to be, to my previous comments, more leadership and more honest reflection about who we are, where we are, and what we're doing wrong. You saw a number of New York Times exposés over the last couple of weeks about the health insurance industry, about the hospital community, and some of the predatory practices related to billing, related to coding. And we have to clean up our act. None of us is blame-free in this environment of ever-increasing healthcare costs. You just had Al Bourla on talking about increasing the prices of vaccines as well as drugs. We have to take a hard look at what companies are doing, why they're doing it, and holding them accountable, both in the public forum, in the media, as well as in the pages of, as well as through regulatory processes, to ensure that patients are protected. Because what I see time and time again is a lot of rhetoric that doesn't necessarily match the action of healthcare organizations. And what we need more than ever right now is authentic leadership that's committed to doing the right thing. And I think what we see more often than not is organizations that should be more mission oriented, hiding behind the rhetoric of no margin, no mission, which is a nice statement to make. It makes us feel better about some of the profit seeking, rent seeking behaviors that we observe in healthcare, but ultimately ignores the fact that the mission isn't organizational sustainability. The mission is serving the community and keeping people healthier. And again, I think we've gotten confused over the last number of decades, and healthcare has evolved into this new normal where every sector of healthcare is trying to extract as much as it can. And it's frankly unsustainable and it's unethical.
Well, I wish we could dig in further to just solve all the healthcare problems today, but we'll leave it there. Sachin Jain, Scan Group CEO, thank you again for joining us at today's Market Summit.
Thank you so much, Anjali. Great to be with you.
You're watching the 2022 Yahoo Finance All Market Summit. We'll be right back after this.
Welcome back to the Yahoo Finance All Market Summit. For most, the pandemic may seem like it's over, but the man in charge of the White House COVID response team still has a job for now. With new variants bearing down on the U.S. this winter, Dr. Ashish Jha has a lot of different data to keep track of and to keep us safe. He's here now to discuss it all. Dr. Ashish Jha, thank you so much for joining us today.
Anjali, thanks for having me here.
Yeah, I mean, I kind of touched on it in the intro, but, where are we in this pandemic? Are we done? Should we just wrap it up?
So COVID is around. COVID is still with us, and we still have lots of work to do. I mean, right? So first of all, if you take a step back, no question about it, we're in a much better place than where we were a year and a half ago when the president took office. We're better than where we were a year ago. But we still have 300 to 400 Americans dying every day, still have tens of thousands of people getting infected every day. It's still quite disruptive. And so there is a lot of work to do to get this virus truly under control and to put it behind us.
And beyond that, you also have what some are naming a twindemic, or if you include RSV, 3 pandemics essentially, or 3 concerning outbreaks at the same time. How are you coalescing around that in terms of whether or not you might advise for a return to certain stricter mitigation measures? Is that on the table for this winter?
Yeah, so, again, if you take that step back and think back to the fall and winter of 2020, right? We didn't have vaccines. We didn't have treatments. We barely had enough tests around. At that point, masking, social distancing, shutting down large gatherings, that all made a lot more sense. I just don't think that's where we are as a country anymore. Right now, we do have widespread availability of these brand new bivalent vaccines that are free, widely available. Pretty much everybody's eligible for it. We have treatments. We have lots of testing capability. In that context, yes, I mean, obviously, we're looking at the flu. We're looking at and worried about we might see with COVID or RSV. But I don't think we're going to need to do anything that resembles what we had to do in previous winters. I really do think we're in a very, very different place.
Well, Dr. Jha, some would disagree with you, saying that even though you do keep saying we have the tools, they may not be accessible or reachable for everyone, right? There might be price barriers. Some people might have to budget whether or not they can buy so many tests. And the time that it takes to get the COVID shots, we've already seen such a low uptake on these boosters. Are you concerned about that and about the messaging versus the reality?
Yeah, so let's talk about that reality. It's a really good question, Anjali. So first of all, vaccines are free. Treatments are free. Tests are free for people who have any kind of insurance. If you have Medicare, Medicaid, private insurance, by the way, that's about 90% of Americans can go get up to 8 tests a month per member of the household for free. So just from a financial barrier, they are not substantial. Now, let me be very clear. There's still other challenges. These things are widely available, vaccines in 70,000 spots. Basically, almost everybody lives within 5 miles of a place where you can get a vaccine or a treatment. So then the question is, what are the barriers? For some people, it's still hard to take time off. We've been working with employers, encouraging them to take time off. For other people, if you're a single mom with 3, doing 2 or 3 jobs, it's going to be difficult. So we've done a lot of work to try to make childcare more accessible. There are still those challenges, but I do think for a vast majority of Americans, access and financial barriers are not what's slowing people down.
What about indoor air quality? I know there was a recent summit to discuss that, and there's been a lot of attention from some advocates about how to go about addressing that and the role that it plays in the spread of COVID. When you talk about not needing to bring back mitigation measures, I think about indoors and what we really need to think about for this winter.
Yeah, no, that's a great question. So let's take a minute to talk about that. I have been a practicing clinician for 20 years. I usually am in the hospital taking care of patients in December, January. The hospitals are always full pre-pandemic, largely because of the flu. Throw in COVID on top of that, throw in potentially a significant RSV season. It's going to be very hard to manage our healthcare system if we don't make some important changes. And one of the things that we can do is to bring the burden of respiratory viruses way down for everybody and for all viruses, and improving indoor air quality, better ventilation, better filtration. Many of these things, by the way, are really cheap to do. So you don't need to spend billions upgrading massive things. These are relatively cheap and easy interventions. They can make a substantial difference. I actually am convinced if people get their vaccines, if we make these improvements in indoor air quality that the government's been pushing and trying to help people do, we really can get through a good fall and winter season this year and make it safer in the years ahead.
Ashish, I have a very, very serious follow-up question for you. looking at your job prospects, we know that you came on board to help lead this response, but are you surprised that you're still in this role now? And do you see yourself returning to academia anytime soon?
Well, am I surprised that I'm still in this role? No. Like when I think about the work that we have to do every day, I get up early in the morning, I come into the office, we have long days. What are we trying to do? We're trying to help make sure that we have vaccines available for Americans and treatments and tests. We're tracking subvariants and making sure that Americans are protected against that. There is plenty for me and my team to do that no one has been thinking about. Boy, we're bored, we're running out of stuff, we got to close up shop. That's not been part of our conversation. We are focused on doing the work ahead of us, and none of us are thinking about kind of what happens after that.
Well, I want to follow up on that. I remember, back in April 2021, back when you were in your previous role, it was the day I was getting a vaccine, and you were talking about the reports that have been coming about the difference between who is opting for a vaccine and how it went along party lines and how that wasn't helpful. Now that you're in the hot seat, now that you're in the middle of all the politics, do you still stand by that? Or has the job changed how you perceive or how you see how politicized everything is?
Yeah, I still don't see this as a deeply political thing. I understand other people do that, and political commentators see a political lens on almost everything. The way I look at it is a majority of people who voted for Donald Trump have gotten vaccinated. Majority of people who voted for Joe Biden have gotten vaccinated. Majority of Democrats, majority of Republicans. People are getting vaccinated. More people need to go out and get vaccinated as we think about this fall and winter campaign. It is not helpful to look at how you manage a respiratory virus that's killed 1 million Americans. It is not helpful to look at that through a political lens. It is helpful to look at it through a medical and public health lens. And in that context, whether you're a Democrat or a Republican, you're going to benefit from these vaccines. You're going to benefit from treatments. And that's my message. And that's what we try to do every day.
And lastly, do you think that there are age limits or age parameters around who's really more in need of a vaccine than others? We've had some people say the older individuals or more vulnerable individuals really should get the vaccine, and younger, healthy ones may be able to pass.
Yeah, the way I look at this, I don't look at it that way. The way I look at it is we know older people are at higher risk. By the way, older people are at higher risk for almost every condition. So that's not a new idea. A lot of people seem to have discovered that for COVID. That's also true for the flu, by the way. What we know is that older people they're at the highest risk. They're going to benefit the most. Younger people are at lower risk. Their benefit still outweighs their risk of getting vaccinated, which is why I've encouraged all my family to get vaccinated, all my friends to get vaccinated. My nieces and nephews and kids have all gotten vaccinated, because for them, the benefit outweighs the risk. But no question about it, the biggest benefits are in older Americans. And if you're over 50, certainly if you're over 65, you've got to go get these vaccines, because it's actually literally could save your life. It's a difference between life and death.
Dr. Ashish Jha, to your point, I think a lot of people learned a lot of things about healthcare throughout this pandemic. But Dr. Ashish Jha, White House COVID-19 coordinator, thank you so much for joining us today.
Thank you.
Coming up, it revolutionized fast casual dining. Now Chipotle has some new tricks up its sleeve. CEO Brian Niccol joins us next.
Brian Niccol is the chairman and CEO of Chipotle. He runs 2,700 restaurants in North America and Europe. Niccol has instilled a culture at Chipotle of serving food that is both fresh and raised responsibly. Under his leadership, Chipotle has posted record sales and profits despite increased food and labor costs. Niccol plans to keep the growth story going by opening more restaurants and using new technology to drive sales. Oh, yeah, and to keep that guacamole flowing.
I'm here with Chipotle CEO Brian Niccol and Yahoo Finance's Brooke DePalma. Brian, good to see you here. Thanks for joining us. Look, we've been talking all day long about how the economy isn't doing great. You have stocks in the tank, yet you have guys like me spending up to buy double meat bowls from a Chipotle. How do you explain all this?
Well, look, I think what we've really focused on is making sure that in challenging times and in good times, we ensure we've got great culinary. We've got our teams trained and ready to get people exactly what they want at the speed at which they want it. And, hopefully that's why guys like you keep coming back for the double meat. So I'm glad to hear that.
Brian, is it just that your consumer is better off financially? You just focus on a higher income consumer. And right now, by and large, they're okay. They have the money to go out there and shop at Chipotle.
Yeah, look, our brand is positioned in a really great spot. Obviously, as you mentioned, we have some higher household income on average in our customers. We also skew younger, but we serve pretty much all income groups. And I don't love to see some of the lower income groups being impacted the way they have, but we're fortunate that we're positioned the way we are with our commitment to food with integrity. And frankly, I think the job that the brand has done to position itself in this space of being, an elevated food experience. So we get people trading down. And I think we also get people trading up and just in a really unique position. So, we're pretty fortunate, no doubt about it.
Speaking of that younger consumer, in Piper Sandler's fall 2022 teen survey, Chipotle was voted number 3. It's also the most preferred Hispanic cuisine level for across upper income and average income teens there. You're also making headway on Be Real. On TikTok, you have 2 million followers. How exactly are you viewing these social media apps as an asset to Chipotle and really engaging with that Gen Z community?
Yeah, look, we talk about this all the time here. We want to be a brand that's visible. We want to be a brand that's leading culture and then also in culture. And, social media, applications like Be Real are a part of that. That's something that has just really taken off lately. My understanding is we've maxed out all our followers. We have to continue to figure out how we evolve that platform. But, it's really important for us to show up in the places where people want to experience our brand and then do it in a way where it makes sense for us to show up. And, we're very fortunate to have, I think, one of the best groups of leaders running our social media efforts, our digital efforts, and just really researching where young people are headed so that hopefully sometimes we're ahead of them and then other times they lead us to where we need to be.
Another place that people can experience your Chipotle experience is on Roblox. That's another interesting foray for fast food. We see that others get into the game as well. So my question here is, what exactly is the opportunity that you're seeing in the overall metaverse there?
It's hard to put it into dollars and actual sales. It's much more to do with brand relevance and I think being visible and then playing a role in people's every day. People make their meal decisions or their food decisions every day, multiple times a day. And I think it's important for them to understand what our brand stands for, which is this idea of food with integrity, great culinary. We're going to do the right things for our people, our food, and then our customers. And if they're able to pick that up through programs like Roblox to, Be Real, that's hugely important to us. And then look, we're going to always experiment. And that's partly what we're doing with Roblox. This is more about experimenting so that we can understand where potentially future sales may come from. And at a minimum, right now, it's definitely the right place to be to communicate with young people.
Brian, before you came on, I talked to Target CEO Brian Cornell. He told me he is confident that they will be able to find 100,000 workers for this holiday season. I was just blown away given the labor shortage. Talk to us about your hiring plans right now. Are you able to find the workers you need to support not only the restaurants you do have open, but also the hundreds of locations you plan to open this year?
Yeah, look, that's a great question, Brian. And I fully believe our, opportunity to join our company and grow with our company and what we stand for will attract the right employees. We will open well over 200 restaurants this year. And obviously we got to staff that with new people. And then we also get to promote people into these roles. And, I think as people understand, 90% of our promotions come from within. We have industry leading benefits, both wages and those benefits that surround you, whether it's healthcare, mental health, debt-free degrees. We find that we're able to attract a huge amount of people. And then the key piece for us is developing them, training them so that then they become future leaders as we grow this company. But, look, I'm 100% confident we will get these restaurants staffed. I'm also 100% confident that our leaders in our restaurant will take the time to develop our crew so that they ultimately become general managers. Our general managers become field leaders. And, you can see how this cascades into just bigger and bigger jobs. So people are able to grow their career with Chipotle, as well as move forward our purpose of cultivating a better world. So we'll get it done.
And Brian, on the employee front, it seems like this is the year of unionization for restaurants, not only at Chipotle, but of course, others in the fast food industry. This past late August, one location in Michigan did choose to unionize. I'm just curious if you could provide an update on the stance of Chipotle on unionization.
Yeah, look, I was disappointed to see that happen. I really don't think we need a third party to get between our restaurant teams and our company. We do a better job of communicating directly with our employees on what it takes to be successful at our company, what it takes to have a great work environment, and what it takes to provide a great customer experience. So I was disappointed to see it. Obviously, we'll go through the process that we need to. But I really don't see a need for it. And, hopefully going forward, we'll continue to be able to communicate directly with our employees and grow our employees with that direct communication.
Brian, staying on employees, if I'm correct, 15% of your locations are in California. There might be law changes there coming up now that push up that minimum wage to $21 from $15 or so. How would that impact Chipotle?
Well, look, we already pay well beyond $15 an hour in California. So the fact that, there is legislation out there that has the potential to take the hourly up to, I believe it's $21, $22 an hour. That's going to put organizations like ours in a place where we'll probably have to raise prices. And, it's unfortunate because it also impacts the economic model that could impact how many restaurants we even open in the future in a state like California, which is a real shame because our brand is loved in California. Our employees love working at Chipotle in California. And I know the customers love getting our food. So, hopefully the legislation doesn't get in the way of, great economics that result in great opportunities for employees and customers. But if it does, we'll deal with it accordingly. But it'd be a real shame.
And in California, at 8 restaurants, you're also testing new kitchen management system software that will help to monitor cooking times and ultimately tell employees or crew members, rather, when exactly something is ready. I'm curious about how exactly these robots, like this kitchen management system, but also a robot, especially like Chippy, really comes together with your crew members and how you ultimately see that spreading to other locations, rather.
Yeah, look, this is something that we started down the path a couple of years ago because we asked our employees, hey, look, what are the tasks that either trip you up or, you find very hard to get done? Or frankly, when people join our company, they say, look, I don't really love doing that work. And they're kind of figuring out how they can just be done with doing that work. So some of the things we got feedback on were, hey, it's really tricky to know how much chicken to cook throughout the day because we get rushes, we get slow spots, then we get fast spots again. So this is really taking, artificial intelligence and understanding real time, how fast are you going through the chicken? How fast are you going through the guacamole? How many, pieces of chicken do you need to go put on the grill now? Because based on what we expect happening at dinner time, this is what you need to cook. And so it takes a lot of the guesswork out of it for the employee, and then it does it real time so that they can be, our crew doesn't want to be out of anything, right? Because it's a disappointing situation for the customer, and then the crew doesn't feel like they're doing a great job. So this is really a tool that will help them be more ready for the rush. And then if the rush exceeds what their expectations were, it informs them so that then they're prepared for the rest of their day so they continue to have a great day. You know, products like our chips, our customers always want us to be on the menu with our chips. And so what Chippy does is it helps us fry chips all day, right? Versus right now we fry them at some points in the day and then we sell through. And then it's like, oh, we're running out. Now we got to go fry chips again. And, you know, look, that's a tough job too, to be working on the fryer. And so we got the feedback that, hey, look, if you could automate this for me, that would be a huge win. And so there's other areas that we're working on as well. You know, we want to automate our digital make line. We're partnering with a company called Hyphen. And we're really optimistic that we're going to be able to automate a lot more of that so that our team members and crew are able to just focus more on the front line with the in-store hospitality. And then hopefully the combination of robotics, artificial intelligence can take care of those digital orders so that they're accurate, on time, and we just give people great experiences, whether it's online or in line in our restaurants.
Brian, two fun ones before we let you go here. Help the Yahoo Finance community know who Brian Niccol is first. How'd you go from, I think I've got this right, summer intern at P&G working on the Scope mouthwash account to being the CEO of Chipotle?
Well, you know, look, it's one of those things that you never really know where your journey's going to go. But I was very fortunate to get my first job at Procter & Gamble. I got to work with a lot of great people. They took the time to invest in me so that I became, I think, much better at marketing and general management skills. And I've taken that with me down the road. And, you know, here I am at Chipotle. One thing I did discover while I was at P&G, I had the opportunity to work on Pringles, is I loved working in the space of food. And, you know, it just resonated with me. And, you know, so fast forward, here we are today. You know, I still strongly encourage you to use Scope mouthwash, but obviously I'm a much bigger fan of guacamole and burritos these days.
I also know where to go with that, but let's end on this too. Because I also tell the Yahoo Finance community, you were the guy when you were at Taco Bell, you created the Live Más campaign. When you came up with that, did you know that that would be the home run that has become? They still use this, Brian. I hope you're getting royalty checks.
Well, you know, look, that was another example of having the opportunity to work on a great brand with great people. And, you know, we came up with what I believe was a very timeless, you know, concept around the idea of Live Más. And it's great to see they continue to use it. And I continue to see that they're having success. So, you know, it's always fun to see places where you've been continue to have success with programs that you had the opportunity to work on.
So very true. Well, we'll keep up the successful days over at Chipotle. Chipotle CEO Brian Niccol, good to see you. And thanks for joining us as well. Yahoo Finance' Brooke De Palma. And we'll be right back.
Hey, great being with you guys. Take care.
Welcome back to the 2022 Yahoo Finance All Market Summit. I'm Julie Hyman. 2021 was a blockbuster year for IPOs, more than 1,000 new issues, plus direct listings, a surge in SPAC deals. It was a busy year. This year, market debuts have slowed to a trickle, and the companies that started trading last year, the class of 2021, as I like to call them, they've taken a steeper hit than the overall market as measured by the Renaissance IPO ETF. I'm joined now by CEOs of two of those companies that came public last year, Nubank CEO David Velez and Brilliant Earth CEO Beth Gerstein. They also, by the way, are co-founders of their respective companies. And I talk about this theme a lot, that there were so many companies that came public in 2021, and there aren't too many of them whose stock prices, at least, have gained. Whether their fundamental businesses have done well is a very different matter. So I wanted to kind of tease that out a little bit. But I do want to start kind of in the beginning with both of you. David, you co-founded Nubank in 2013. Beth, you co-founded Brilliant Earth in 2005. How did you each decide to make the decision to go public last year? What made you decide to kind of pull the trigger? Beth, I'll start with you.
For us, it was a natural evolution. We've been operating for 17 years. We were growing, we were profitable. We had, I think, a lot of discipline, originally being bootstrapped. And so we thought it was a good time for us to be able to raise a little bit of money, for us to allow our team members to participate in owning part of the company, which I really am proud of. And I think we were right. It was a good time for us to go public.
David, what about you?
Yeah, about 2019, we started thinking about going public and getting into a process of about 2 years preparation. We obviously started seeing a lot of private funding available, but we are a business that requires a lot of capital. And at some point, it was very clear that we were going to go public to need to really access that liquidity. We had also been building Nubank already for about 8 years. So we put a stake on the ground in 2019 that by December 2021, we were going to do it. As the market went in that direction, 2021, we decided that it was the right time, and we were very happy that we were able to sneak in right at the end.
Yeah, you made that deadline just. And I was looking at how the stocks have performed. Beth, your shares were up 42% on the first day. Your shares went up around 32% over the first couple of days. They have trended lower, right, with the rest of the market. We've seen, like I mentioned earlier, most of the companies that came public last year, that's their trajectory. And I ask a lot of CEOs about their stock prices, whether they're new issues or whether they've been on the market a long time. And most of them say, well, I try not to pay too much attention to the stock price, which you got to pay some attention to the stock price, right? So, David, how do you think about the stock price action and how you interact with investors when you see the price going down?
Yeah, so it took us, I would say, we priced the IPO in December, and then we went into this market, and it took us a few months to try to figure out what was happening. What was the market telling us with the sudden movement in price? And after about 2 or 3 months of trying to understand what was going on, we kind of came to the conclusion that our thesis that the largest provider of financial services in the world, especially in emerging markets, will continue to be technology companies, and that the thesis fundamentally had not changed. And in fact, there were some trends in a market like this one that makes our business way much more interesting than a year ago, even though the market is a little bit more painful and the price is really not being able to price that effectively. And so what's happening is that effectively companies, everybody in tech is being traded the same thing, is being punished the same thing, but there's some whose fundamentals are unaltered, whose thesis is unaltered. That's our case. We're profitable. Brazil and Latin America, macro seems more concerning in this environment, but we've actually have a very positive view since the very beginning. And Brazil will actually grow 3% this year, more than China, with an inflation lower than the US. Colombia will grow 8%. So you start seeing a bit of a decoupling, at least through this year. I think next year will be a little bit harder. But in reality, what's happening is that everybody's sort of put in the same box without really understanding the differences between the different tech models or the geographies or profitability curve or any specific details about the company.
Well, and it's not even just tech, right? It's sort of like everything has been thrown into that basket. I mean, you guys at Brilliant Earth are sort of tech first, if you will, but you're a retailer, right? You sell diamonds and different kinds of jewelry. So it's interesting that you two are two different companies, different types and categories, but yet, you get this whole tarred with the same brush thing when everybody's looking at these new companies. You mentioned a moment ago, you don't get the timing. You think it was good timing still for the company. So how do you think about the stock price and the reaction that we've seen?
I agree with David. Like direct to consumer, has been a more challenging sector as a whole. And I think you end up getting lumped in with all of the companies that ended up going public at the same time period. We're very different. We've been operating for 17 years. We've been growing and profitable, continue to be growing and profitable. So I think it differentiates us, but investors are still learning. And frankly, I think right now, they're not really taking the time to look at each company. They're overwhelmed based on just some of the volatility. So for us, it's really about how do we, not pay too much attention to what the stock is doing on a day-to-day basis. Make sure obviously the team is motivated and that we're focused on the long term while making sure that we have the discipline in the current environment.
And it seems to me that both of you are probably in modes where it's not as though you would use your stock to go out and acquire, that you're sort of organically growing. Would the plans have been different if the stock price had done something different, Beth?
I think that, at this point we have a really strong balance sheet. So we have a lot of strategic options that are available to us, whether it's cash, whether it's, how we want to think about organic growth is actually traditionally how we've been growing for the past 17 years. So I feel like we're really well positioned. We don't, it would be nice to have that lever, but we have a lot of other opportunities as well.
David?
Yeah, the organic growth is definitely the preferred growth stage at this time. We have already over 35% of the Brazilian adult population is a customer, but we have less of that market share across all the different financial services products. So we have significant opportunity to grow with the cross-sell to that very large base, almost 70 million customers. In Mexico and in Colombia, or new markets, we've already the largest credit card issuer. So a lot of opportunity to grow organically, and we're seeing less competition in the environment. However, we raised more money than we needed last year, and we are seeing some potential M&A targets that we were discussing with 12 months ago back on the table at a valuation discount of 50, 60%. So both organic and inorganic opportunities actually seem more interesting in a market like this one for somebody like us that is fully capitalized than competing 12 months ago.
I agree. We have a real opportunity to take share in a volatile environment. And I think that, that is a unique thing in this market to really feel confident to do that.
Right. If you have a good balance sheet, as you were talking about.
And a good position.
Right.
That's the key. Good brand.
Let's also talk about the bigger environment, right? And recession talk, which of course has been everywhere. You were mentioning that Brazil is still predicted to grow this year. The U.S. is expected to still grow, even if it's not growing very much at this point. But what are you seeing from consumers right now? What are you expecting for the holiday season, for example? Talk to us about the tea leaves that you're reading.
Well, as a public company, we are in our quiet period, so I'll just start off that way.
What can you tell me sort of high level about what you're seeing?
From a high level, I think what we are really proud of is the positioning we have in our market. We have a really strong brand for Gen Z and millennial audience. Love persists in all different types of ups and downs, where people continue to get engaged and people that continue to celebrate with jewelry as a source of value. And we're well positioned because we're very asset light. So I think a lot of other companies have big inventories that they need to be able to discount. For us, we're very inventory light. We're able to scale up to meet the consumer demand. That puts us in a really powerful position. So we can really navigate no matter what the current environment is. And it has been a volatile market. I've said that in the past, and we're expecting for this holiday to be able to meet the customer where they are. And that's all I can really do at this point.
When you say you're inventory light and asset light, how does that work for you? Like if someone's ordering a ring or whatever they're ordering, do you then do sort of on-demand ordering? How does it work?
Yeah, so the way we operate, we work with a virtual diamond inventory model. So the diamonds that we have, which is over 200,000, are actually on our supplier balance sheet. And then a customer will order a ring and we will make that to order. So it really depends on having very strong supplier relationships. And those suppliers are ready for us to scale up as we see the demand actually happen. So those typically take around 1 to 2 weeks. So the customer gets a highly personalized, really beautiful, unique product, and we don't have the inventory risk, which I think in this environment specifically is gonna serve us really well.
Yes, we've heard a lot of inventory build news from all kinds of different retailers. Let's get back to economic activity for you, which is a very different picture because we are talking about emerging markets here. You mentioned the Brazilian growth picture for this year. Next year, a survey of economists by Reuters found that they're looking for growth of about 0.8%. So still expanding, but at a much slower pace. again, what are you sort of seeing through your customer base, and what are the indications? Does it feel like a recession is coming down the pike at some point?
Yeah, what's interesting about us is we grew, since we started business in 2013, we've effectively only grown through recessions. And it's interesting to talk to other US companies when they see, it's being talked about inflation and low economic growth as something that nobody has really ever seen. For us, it has been Brazil 101. We've only seen recession. We've only seen high inflation. We saw a 7% GDP contraction in 1 year as we grew. We saw the worst recession in 100 years. So as we look at 2023, yes, it's going to be more moderate growth, but relatively to what we have already experienced, it's actually much more positive. And a lot of the trends that we're banking behind are almost uncorrelated with the market. Regardless of where the market grows 1% or 3% or 5%, more people will go to digital banking because it's a better experience, it's lower fees, it's lower interest rates. Regardless of the growth, you have 250 million in Latin America that has no access to banking, that are migrating into digital banking. And so a lot of the technology trends underlying the growth of the business tends to be a bit uncorrelated. We definitely have credit risk, and that is the part of our business that is linked to the economy. So we have to have increased resilience in an environment like this one. We've been increasing resilience through the year. But in general, what we've seen so far is a bit of normalization from very abnormally low credit delinquencies through the pandemic. So much more going to normal basis where you still can operate with very healthy margins.
So circling kind of back to the beginning here. So we're going on a little more than a year since you became a public company, almost a year for you to be a public company. What's the biggest change for you in sort of, whether it's biggest lesson learned, biggest discovery, biggest lifestyle change? Are you running around more? What's the biggest difference?
Yeah, I'd say transitioning from private company CEO to public company CEO, it's a big change. It's humbling. I think being able to balance the long-term strategy, articulate the long-term strategy, and also be able to deliver on expectations is, for me, I think a good lesson to learn. I think it's made us stronger as a company. We've been more transparent with our team, with outside investors, and I think that also helps to clarify internally. Like, we are really going after being the #1 destination as a fine jeweler for this younger consumer. We have this really strong omni-channel strategy. We're really expanding in fine jewelry. So all of that, I feel like we're able to deliver as that long-term guidepost while still making sure that we are we meeting guidance? Are we able to talk about what's happening in the quarter? So holding ourselves to that standard, I think, is what the challenge is, but I think it's driven a lot of internal accountability.
Interesting. David, what about for you?
Yeah, I would agree with that. I think first, obviously, communication is probably the biggest challenge. Is you need to be actively communicating with a number of different constituencies, especially when there is so much volatility in a market like this one. Things are changing so much. And beyond that is, obviously, we don't want to change our view of optimizing the company's value for the long term. We think that that's still the right way to run the company. But we need to be able to also show investors that in the short term, we have very high rigor in terms of the decisions that we're making, and that there has to be really strong economic fundamentals in the business. So it's balancing the rigor and the communication that we're doing the right things in the short term with continue to double down on the long-term opportunity that the business has.
And I think because we're both profitable, it makes it a lot easier. We're coming from a position of strength.
And that's a differentiator, too, among those public W's. Really quick question for you. Most popular cut among engagement rings right now? One of our young producers wanted to know.
Oval.
Oval. Interesting.
Shapes, yeah.
Okay.
Elongated fancies are really popular.
Does it change a lot? Or?
It changes over time. Yellow gold's really popular now. Couples are making decisions together. They're definitely changing trends in the industry.
We'll have you back to talk much more about all of that. And we'll have you back too, David. Great to be with both of you. Thank you so much for being here. David Velez of Nubank and Beth Gerstein of Brilliant Earth. Much more AMS coming your way.
You're watching the 2022 Yahoo Finance All Market Summit. We'll be right back after this.
Welcome back to Yahoo Finance's All Markets Summit. Aggressive Fed policy has put the markets on edge, fueling fears that the economy is headed towards a recession as the Fed remains committed to getting inflation under control. Here to discuss this and much, much more, we want to bring in well-known business and economic policy leader Gary Coney, the vice chairman of IBM, former director of the National Economic Council under President Trump. Gary, it's great to have you. Thanks so much for joining us here in studio.
Thank you so much for having me.
So let's just start big picture. We have high inflation, Fed saying that it remains committed to getting inflation under control. Markets are bracing for what's next. What's your assessment of where we stand today?
I think you sort of summarized it. You know, everyone's talking about the last CPI report. Obviously, we're at 8.2% inflation in the United States here. A totally unacceptable number, a number that really hurts consuming Americans and it's really regressive inflation. So you understand from the Fed's standpoint, they have to tackle inflation. You know, they have a blunt instrument. They have a blunt instrument, which is interest rate policy at this point. They're trying to increase rates. They're trying to increase rates to slow demand down, to take demand out of the economy. They really cannot affect the supply side of the equation. The problem that we have, or the issue that people are debating now, is the Fed started raising rates earlier this year. We've gone through quite a few interest rate rises already, and the economy has not slowed down from an inflationary standpoint. That said, we all know that this monetary policy takes time to feed itself through the economy. Unfortunately, it hits consumers almost immediately. So if you've got an adjustable rate mortgage, it adjusts the next day. If you've got credit card debt that adjusts, it adjusts the next day. But the real policy effects on slowing down demand, that takes months and almost a year to a year and a half to feed through the economy. So there's this discussion going on. Has the Fed done enough in interest rates to slow down the economy? And we don't know because the effects are still being felt of the first rate increases, or have they not done enough because we continue to see inflation move higher and higher? So I think the Fed is in a very difficult position. They were late to the game. They started raising rates late, which means they're now playing catch up. I think we all believe that they will raise rates 2 more times this year at the 2 more meetings, probably at least 75 basis points in the November meeting, and probably another 50 to 75 basis points at the end of the year. So we will have gone from basically, 0 Fed fund rates in the United States to well over 4% rates in the course of a year. That's a fairly dramatic move, and we need to understand what impacts that's going to have longer term to the economy.
And what impacts do you think it could potentially have longer term? And are we going to be able to do this without going into a recession?
Well, the question is, what are the impacts? And as I said, the Fed can try and affect demand, the demand side of the equation. They can make borrowing money more expensive. They can make homes more expensive. They can try and slow consumers down because things are harder to buy because they don't want to finance them. They can't affect the supply side of the equation. And right now, when you look at the data and you look at what's going on in the inflationary front, a lot of the inflation comes from commodities and commodity inputs. So by raising interest rates, we don't create more oil. We don't create more food. So we're trying to create a balance of oil. We're trying to create a balance of food. We're trying to create a balance of workers back into the labor force. I think one of the big underlying components of inflation is wage price inflation. We keep seeing 5+% wage inflation. Wages filter through everything we do. As the economy has shifted during COVID to where we're buying lots of goods because we really couldn't leave our houses, so we were buying things, we were having them sent to our houses, and we were consuming goods, we're now back into a more normalized economic cycle. In a normalized economic cycle, we as Americans, we're good consumers of services. We like to go out, we like to be entertained, we like to travel, we like to go to events. The service economy is all labor. When you go out to a service event, you're really buying mostly labor. So when you go to a concert or you go to a restaurant or you go to a bar, you're buying some inputs, some commodities, but you're buying an awful lot of labor. That labor cost has not come down. And it's another area where the Fed is trying to get some response. They're trying to get businesses to not grow as fast. They're trying to get people businesses to not hire as many people. But we saw even in last month's unemployment report, we saw 3.5% unemployment. We still see non-farm payrolls growing. So the interest rate impact has not fed through to the business cycle yet. We're going to have to see job destruction if we're really going to see inflation be curtailed. And I think that's hard because we've gone through a lot of fundamental changes in this country. Prior to COVID, we were all talking about the aging American workforce. Guess what? We're still an aging American workforce. We didn't stop aging during COVID. Unfortunately, during COVID, we lost about 2 million people from the labor force, either through long COVID or unfortunately they passed away, which is a horrible event, but we've got to recognize we've lost people from the labor force. And then we had a bunch of people sort of late in their work cycle who decided to leave the labor force. So we now have a smaller labor force population in the United States. So businesses, to attract workers into the labor force, are having to pay more to get workers into the cycle, which is inflationary. Wages go up. They pass those increased wages on to the consumers, and we're in this inflationary cycle. So the Fed's going to continue to keep raising rates to try and break this cycle. They won't know they have broken it till long after it's broken.
So what does this mean then for the equity markets? Because here we stand today, the S&P off more than 20% year to date, NASDAQ down more than 30% year to date. When you try to gauge that downside risk here for equities, what does that look like?
So again, the famous adage, don't fight the Fed.
Yeah.
You know, it's been true for this cycle. It was true for last cycle when we had a zero interest rate policy. You wanted to own risky assets. When you've got the Fed increasing interest rates and the alternative, the risk-free rate, the rate of return at now sort of 4% for short duration treasury bills, that's an attractive rate of return for short-term treasury bills. And really what's happening more than anything is the equity market is trying to figure out what are the future earnings of a company. So remember, the value of a stock is the present value of future earnings. So if a company has higher input costs and it has higher labor costs, and hopefully if the Fed is successful, lower demand for their goods or services, what does the forward earnings of a company look like? Then I could put a multiple on that. And right now, the market is trying to determine what forward earnings are going to look like and what multiple that should trade at. And as long as the Fed is continuously raising rates, trying to slow down the economy, trying to make things more expensive, trying to make labor more expensive, the market is going to continue to try and find a clearing price for that. It's like everything else in this world. We won't know we have met that clearing price till long after the bottom is here. We may have met it already. A lot of people think we have not got to that clearing price, but the market right now is trying to figure out what future earnings look like and what multiple we should put on that.
Gary, I'm curious to get your perspective on this. The job that Fed Chair Jay Powell has done so far, are you satisfied with that?
I think they were late to the game. I don't like to criticize the Fed. I don't think any of us like to criticize the Fed, but they've got a tough job. But they've got an enormous amount of resources at their disposal. They stuck to this transitory inflationary argument way past where I think many of us, myself included, I'll make this personal, way past where I thought it was transitory. Maybe in the beginning, as we're bringing production back online, we're bringing supply chains back to normalized level, there was some transitory natures to it, but the Fed stuck to their transitory argument way deeper into the cycle, and it was clearly not transitory. We clearly had real inflation in the system. We had shortages, we had food shortages, we had energy shortage, we had a tough time getting people back into the labor market. So as I said, the Fed was late, and when you're late, you're playing catch up, and I think they continue to play catch up.
How much of it, because we know when we look ahead to the midterms, we're 22 days away from midterms right now, Republicans largely running on the fact that high inflation, slowing economy, that's the fault of the Biden administration and Democrats. From your assessment, I guess, how much of it is a result of White House policy versus factors that are just simply out of their control?
It's never, ever one factor. The one thing we learn is when we study the history, we'll know that wasn't one factor. A lot of people will point to the huge increase in money supply. So as the Biden administration was sending out stimulus checks and they're putting money in the hands of consumers, we were increasing the money supply. As you increase the money supply, you've got dollars chasing goods. Those dollars are willing to chase the price of goods higher and higher. So we clearly saw some inflationary pressure from the consumer being in a very good position, having very good balance sheets, unlevered. And by the way, we still see that today. If you see the bank earnings that we saw reported today, the banks were talking about the fact that they still have fairly high deposit rates. The consumers are still in relatively good shape. Delinquency levels are low. So we still see the U.S. consumer this far into the COVID relief, we still see the U.S. consumer with a very good balance sheet, still have the ability to spend, and that clearly is part of the cause of the inflation. We also had a situation where you could talk about the supply side. We had a change in energy policy, a fairly dramatic change in energy policy. Energy policy drove a lot of this. We've clearly had, some unforeseen weather events around the world in the food. We clearly have a war in Europe where we're having food disruption. So again, it's hard for me to put my finger on a single event, but all of these definitely have some blame and some huge contribution to why we're having this inflation.
Gary, one of the priorities of the Biden administration has been the chip sector, the passage of the $52 billion CHIPS Act. I knew you, along with some of your colleagues from IBM, made the trip down to D.C. to help that get over the finish line. From your assessment so far, how is the rollout going of this?
I think the rollout's going fine. I mean, I can't tell you it's going poorly or great. It's a slower rollout, but we knew that. The Commerce Department right now has been empowered to go out and spend the money that was given to them by the government. But really, the opportunity there was not just giving the Commerce Department money to spend. If this was going to be successful, it was going to be a huge public-private partnership. And I think we've seen the public and the private sector get together. We've seen the private sector announce massive investment in chips in the United States. You've seen it in upstate New York. You've seen it in Columbus, Ohio. And these are not, small investments. We've seen multiple billions of dollars, 10s, 20, 30, 40, 50, $60 billion investments by companies. IBM last week, when the president was there, announced a $20 billion commitment. You've seen Intel announce investments. We've seen multiple companies announce investments. So the government has done what they needed to do. They got leverage in the system. They talked about the importance of chips in the United States. They talked about being supportive of chips. We've got to get the permitting process sped up. But the private sector is bringing the money to the situation, because ultimately the money that the government's putting in is just a little tiny down payment on a big, huge issue of being chip independent in this country.
And Gary, I want to switch gears here just a little bit and talk about a story that's been in the headlines recently, of recent weeks. And that's a comment from Kanye West and what he has made public on his social media platforms, his large media presence out there, the anti-Semitic remarks that he has made multiple times. And I bring this up because it's been 5 years since Charlottesville. And here we are today with similar type of rhetoric, hateful rhetoric that's being said on a platform that has millions and millions of followers. What's your reaction to the remarks that we've heard from Kanye West?
Look, they're just unacceptable. I'll say the same thing about Kanye West's remarks as I said to the President of the United States at the time. It's just unacceptable in this day and age, in the world that we live in, for people in a leadership position with that big of a platform, with that big of a microphone, to make those type of comments.
And Gary, real quick, we tried to ask you this 2 years ago when you were at AMS, whether or not you were planning to vote for President Trump in the 2020 election. So I'm going to ask this to you, but put it in a slightly different way.
Did I answer back then?
You didn't answer back then, so I'm going to give it another shot here. What would you say to people that might be inclined to support a second term for President Trump?
Look, it's America. Everyone's entitled to vote for whom they want. That's the greatest part of our democracy, is that we allow people to run for public office, and the citizens of the country get to decide who sits in those public offices. We're in the middle of a midterm election right now, and we'll see who takes control of the House and the Senate.
Certainly will. 22 days away from those midterms. Gary Cohn, always great to have you here at Yahoo Finance. Thanks so much for joining us.
Thanks for having me.
Let's get over to Jared Blickery with a closer look at the market movers here in the final 30 minutes. Hey, Jared.
That's right, Shauna. After a market rout Friday, we are looking at the Nasdaq up 3.5%, the best day in weeks. Here you can see it on the intraday basis. Here's a look at the trailing week. You can see all the volatility. It is net up 1.3% over that time period. I want to take a look over a longer period of time. This is going to be the S&P 500 over the last 3 months. We are coming off of the lows of the year, and this is that volatile CPI print that we got now. I do want to check on the bond market. 5-year T-note yield, that is coming off of 4 and basically 0.25%. That is down 3 basis points. But you move down the curve to the 13-week T-bill yield. That is up 6 basis points to the highest level since 2007. The 30-year at the highest level. That is up 4 basis points since 2011. And the U.S. dollar index easing slightly. That's probably one of the things that's giving a bid, or at least allowing a bid, to equities right now. We're seeing consumer discretionary. That is XLY. That is in the forefront, up over 4%, followed followed by real estate, tech, communication services. The mega caps plus real estate really feeling the love today. And here you can see Tesla up 7%, Amazon close behind up 6.5%, Nvidia up 6%. And we take a look at some of the leaders here. You can see ARK, that is up 7%. IPOs, internet stocks, memes, Chinese stocks, cannabis stocks, software stocks, and gambling stocks all feeling some love. All of those are on the top row here. And we got to check in on the banking sector. Bank of America reported earnings. Actually, I believe net interest margin was up 24% on the year. That stock up 6%. We're going to have Goldman Sachs earnings tomorrow morning, along with Netflix after the bell. In the meantime, much more AMS for you. We're going to be right back.
Breaking the glass ceiling. WNBA Commissioner Cathy Engelbert tells us how the league plans to capitalize on a historic season.
Welcome back to Yahoo Finance's All Markets Summit. The WNBA just wrapped up its most watched season in 14 years, with viewership jumping 16% from just a year ago, and the league shattering fan engagement and on-court records. Here for more on that, we want to bring in Cathy Engelbert, WNBA Commissioner, also former CEO of Deloitte. Cathy, it's great to have you. Thanks so much for stopping by here at Yahoo Finance.
Great to be here, Shauna.
So let's talk about that record-setting season that you just wrapped up here. Obviously, the sport is getting more and more popular. How would you sum up this most recent season?
Yeah, you just named some of the viewership gains we had, but across social media, even in our partners like ESPN, they had 1.1 billion impressions on W-related content. So it's important our partners see the value of the WN women's sports. And there's a huge changing of the guard going on right now with Sue Bird in her last year, just retired, Sylvia Fowles, two icons in the game, but great players like Asia Wilson, who was MVP of the WNBA finals and just like an amazing, and just won the gold medal at the FIBA World Cup for the Las Vegas Aces, now, you know, winning their first ever franchise championship. So huge changing of the guard to the younger players, and really great with our veterans too.
That 16% jump in viewership there that I just mentioned in the intro, what do you attribute this to?
You know, part of it is when, you know, if you build it, they will come. So one of the things we've done, more marketing, more digital, meet our fan where they are. Our fan skews more diverse. Our fan skews younger, more women. And so finding that fan, bringing them in, retaining them in the game, getting them to games, getting fans in seats. We come off 2 tough COVID years for the W. One in front of no fans, and last year in the 2021 season. So we expanded the number of games up to 36. We had an amazing all-star game, an amazing draft, most viewed draft since 2004 when Diana Taurasi was drafted. So again, a lot, we raised capital back in February. We're deploying that capital against things like digital and marketing and telling player stories. And the players, the on-the-court records, triple doubles, double doubles, the excitement of the game is really driving it as well.
Yeah, I want to talk a little bit more about that capital raise in just a few minutes. But first, let's talk about when we talk about getting more eyeballs on the games. A lot of the focus when it comes to sports, at least over the last several months, has been the shift to streaming. I guess how important are streaming deals when you're looking to grow the sport? Because a lot of times we talk about Amazon when it comes with Thursday Night Football. We talk about the MLB's recent streaming deals. But WNBA, you have a deal with Amazon. You've also aired some games, or streamed them, I should say, on Twitter.
Yeah, the whole marketplace in media is being disrupted, as we know, not just linear and traditional, but also streamers are now being disrupted. And actually, you're trying to get into live sports is something that's still getting a lot of eyes on the game, both in linear and in streaming. So as we see the NFL roll theirs out, we were a little before them, but we didn't have the marketing quite behind ours. So it's always going to be now a part of the package. And when your fan base skews younger, like our fan base does, and you're trying to bring in that digital native, that Gen Zer, who has probably cut the cord, and you've got to have Roku enablement, Apple TV enablement. You have to have all of that, and that's why you have to know who your fan is and look at the data and then drive it from a digital perspective.
And Kathy, speaking of that, I know your current broadcasting deal with ESPN ends in 2025. When you're looking for that next media agreement, what are you hoping, or what do you want that agreement to include?
Again, I think we're going to look at all different forms of how to bring the game to our fan base who does skew younger. And really, if you think about how it's being disrupted, it's also around marketing so people know where to find you and taking the friction out of viewing a game for the fan. They have to know where to go. They have to know where to go on the spot, or they're going to lose interest. And they also, the content around it, not just the game itself. And we're 120 minutes and you're done. So it's not a long, our games are quite fast. But it's the content around it and the storytelling around it and the medium and short form content that's going to drive, I think, viewers in to determine how we think about media going forward.
You mentioned that $75 million capital raise. You reached that in February since then. I believe that you've announced some plans to use some of that money for players to market the league in the offseason. What can you tell us about that? And I guess if it is already underway, how that's progressing?
Yeah, so it's just underway. We just finished our season, just handed out that trophy to Las Vegas, and we have 10 players under contract to market the league in the offseason. And it's going to be great. We've already had a couple of the players at the league office to talk to them about what this all means, how to build their brands and drive them into the next generation of household names in the sport. So, and there's such great role models for young boys and girls. It's not just young girls, it's young boys too. And a lot of people I meet say the first basketball game I want to take my kid to is a WNBA game, the purer form of the sport. So these players are great role models. Obviously, they have very strong social justice stances, and people view them as these kind of, multi-dimensional role models. And we have moms in the league, and they're really great role models. So that's why we want to market the players more and spend a lot more of that capital on the players themselves.
And Kathy, when you speak about growing the league, I know expansion, it's been a major topic now for a few years. You currently have 12 teams in the league. Any insight that you can share with us just in terms of what you're thinking for expansion, or when you think that WNBA is going to expand?
Well, one of the ways to grow the league is to have more eyes from more cities. And when I joined the league, quite frankly, I said, we're only in 12 cities. This is the longest tenured women's professional sports league in America, double any other. We'll be in our 27th season this year, and we should drive off that strength. So we're looking at a variety of markets. We're using data, psychographics, demographics, NCAA viewership, current W merch buying. You can get a lot of data by city to determine which cities would be the best. We have to find committed ownership groups with a great arena situation. So there's a lot to think about, but that's certainly one of the areas now. The hard work starts in the off season around strategizing around those cities. But, for instance, I'll just throw one out. When technology is driving so much of your economy and you don't have a team in the Bay Area, that doesn't seem right? So that's on the list among another 9 or 10 cities.
Kathy, you mentioned efforts that the WNBA has in helping players really build their brand. And it brings me to pay, because pay compensation has long been a topic. When you take a look at the WNBA, I know salaries are increasing. $234,000, I believe, is the supermax salary for this upcoming season. The max just over $200,000. Even with these raises, though, players do still tend to make more when they play overseas. I guess, how has this impacted your league, and what are you doing to address that?
Yeah, so we're starting to chip away at an economic model. When I came into the league, I was hired by Adam Silver to look at the economic model and how to drive it. And you're seeing a transformation before our eyes, but we're not there yet. And it's all around the ecosystem of how we get valued by corporate sponsors and how we get valued through media deals. And when less than 5% of all media coverage is women's sports, yet 40% of the athletes in America are women. And when less than 1% of all corporate sponsorship dollars go to women's sports, that denominator is huge in men's sports. So we're chipping away, and just a couple hundred basis points is moving the numerator, and we really have our WNBA changemakers companies really stepping up. So we're getting there. We now tripled the top players' pay. We've got this marketing dollars. We doubled the playoff bonus this year, up 53%. We have a Commissioner's Cup now prize pool of over $500,000. So we're just chipping away at all the ways to pay players. But you can't do it without being financially savvy about growing an economic model to not just support it for today's players, but support it for the next 25 years.
And speaking of support here for players and also just growing your brand, I guess, how do you also increase the international component of this, which I think would be very important here when we're just talking about growing the value of the WNBA?
Yeah, another reason I wanted to raise that capital is to globalize the game. I've really admired what the NBA has done through their global games platform and how they've turned these players into global stars. So players go overseas and they're well known and they're household names beyond the United States. So we've announced a preseason game in Canada as first step, again, coming off the pandemic now. And then I hope to get to like an EMEA games, and Africa is very interesting, and certainly Asia. So this year we had, I think it was 23 players from 13 different countries. That was our highest. And so we're kind of chipping away at globalizing our own players, as well as then taking our U.S. players and making them more global household names. But it's not easy because the women's game isn't followed as much. But, for instance, 3x3 basketball, so 3-on-3 is a #1 most popular urban sport globally in both men and women. So we can kind of capitalize off of that and bring our game outside, the U.S.
Well, Kathy, speaking of international playing overseas, I want to turn to an issue that I know is very front of mind for you, and that, of course, is Brittney Griner, the seven-time All-Star detained in Russia since February. I guess first, just what can you tell us about her condition and how she's doing?
Well, first of all, wrongfully detained. Important to use that word, wrongfully detained in Russia. And Brittney is amazing. She wrote me a letter recently. She can only handwrite letters that go through, the government. I'm sure they're to lawyers, then gets to me, and we've been writing her periodically throughout the year. And this is just an unimaginable situation. I'm sure, mentally it's very, very taxing the longer she's there. She's got an appeal coming up on October 25th. Which, we're pretty sure we know that the legal process there isn't not going to yield anything favorable to Brittney. So we've been talking with the State Department, the Special Presidential Envoy for Hostage Affairs, and everybody in the administration and they're all Brittney all the time. They're trying to find every different way to get her home safely first and as soon as possible second. So her 32nd birthday is tomorrow, and so we'll be making sure she knows we're remembering her as part of a social campaign around We Are BG and bringing Brittney home safely. So it's geopolitically complex.
Yeah.
So when you take these jobs, you never know how complex it'll be in situations, and this one's certainly one of the more complex situations I've dealt with.
Well, speaking of that, when President Biden recently saying that he would only meet with Vladimir Putin at the upcoming G20 meetings if, quote, he came to me at the G20 and said, I want to talk about the release of Griner, I'd meet with him. I guess, what's your reaction to that, and whether or not the president should be more forceful in pressing this issue?
Yeah, I think from our discussions with the administration, they're trying everything they can do to get a deal done. Obviously, the legal process we knew was not going to yield a favorable answer to Brittney when it should have, but that's why she's deemed wrongfully detained by the State Department and the administration. And I think the government has been doing everything they can, but there's not a willing party on the other side, and the Russians need to step up, get a deal done for both Brittany and Paul Whelan, who's another wrongfully detained American there. So again, our hope is first, number one, get her home safely and as quickly as possible. But as I mentioned, if you think of diplomatically, geopolitically, even if you had a neutral party step in, there's no easy answer here. And I think the administration is full court press, to use a basketball analogy, to try to get Brittany home. And I think you need the other side to come forward with a reasonable deal.
And Kathy, while we have you, I also want to get your thoughts on a massive story that really walked not only the sports world, but also had ripple effects through every single industry. And that was what we just heard about the National Women's Soccer League, that year-long investigation finding systemic abuse of players. As commissioner of the WNBA, what steps are you taking to protect your players?
Yeah, this is really, really important. It's really important not to have a misstep in this area. It's unacceptable. It's disappointing. I know they've had leadership changes over the years, and as a commissioner of the WNBA, we want to be leading with a player-first agenda, respect in the workplace, all of that, making sure that our policies, which have been in effect for years, are solid and that players feel comfortable coming forward when there's an uncomfortable situation, whether it's with a coach, an owner, or whatever. So that it's important to create a culture where players, it's great to have a hotline. Just in the corporate world where I worked for over 3 decades, it was great to have an anonymous hotline, but if nobody's using it, then it's like, okay, they don't feel comfortable because the culture's not there. So culture, always important in the workplace. And sports is an interesting place because people don't think of culture in the workplace in sports, but it's just like, you and I working in the corporate world.
You mentioned your 3 decades experience in the corporate world. You're CEO most recently of Deloitte. How do you think that prepared you for the job you have today as commissioner of WNBA? Because 2 very, very different roles, if you look at them, I guess, from a 50-foot view.
Yes, I always say you went from a 100,000 person workforce to 144 players, so it sounds very different, but sports is big business about relationships. So I was so blessed to have the career I had at Deloitte that prepared me for things like collective bargaining 4 days into the job when I came in, building relationships with players and the whole ecosystem and the stakeholder group, like 12 different owners, 30 NBA owners who also own a share of the WNBA. And then lastly, really, George Floyd, Jacob Blake, a league of 80% women of color, and dealing with a workforce, call it, that was really rattled and rocked. And I learned a lot by listening to the players and trying to put myself in their shoes. And that's all stuff when you're leading a big company like Deloitte come in handy when you're leading something like the WNBA.
Kathy Engelberg, great to have you. Thanks so much for taking the time to join us today.
Thanks so much, Anna.
Straight ahead, it's a new era in Hollywood. Actress Fran Drescher is here to explain the big changes coming to the box office.
Globe award-winning actress and producer Fran Drescher is the current president of SAG-AFTRA. The union represents over 160,000 actors, artists, influencers, and other media professionals around the world. Drescher is leading SAG during its biggest upheaval in history as the industry adapts to a post-pandemic world. Contracts are now being shredded by the new economics of the entertainment business, and it's changing how everyone in Hollywood gets paid. Something that again exploded into view last year was Scarlett Johansson's blockbuster lawsuit against Disney. And that's just Drescher's day job. She's also a tireless health advocate and was appointed public diplomacy envoy for the State Department during the Bush and Obama presidencies. Fran Drescher, the one and only, thank you so much for joining us.
Thank you. That's a nice introduction. I'm going to have to remember it.
Well, Fran, I want to dive right into this because there's so much to talk about. You became president of SAG-AFTRA last year, a pretty critical time for Hollywood, right? COVID-19 was still an issue. Scarlett Johansson had just sued Disney, citing breach of contract over the release of Black Widow on Disney+. What was that time like for you entering in during that environment?
It is an interesting time. It was and remains so. I think that my biggest actual challenge was trying to unite a dysfunctional union. I was determined, if I got elected, to not be partisan, party blind, I call it, and really just listen to everybody's ideas and grievances. If it makes sense to me, as with everything, I'll go to the mat for you. I don't like marginalizing anyone or making anyone feel less important, even if they are, for whatever reason, more of a minority opinion. And with regards to Scarlett Johansson, I was shortly thereafter negotiating a movie deal. And we handled the negotiations completely different in the event that the movie would go straight to streaming. And they kept postponing the theater release because of COVID. And ultimately, they decided to just go straight to streaming on Amazon. And so, you know, I recently got a nice big chunky check buyout.
and you know, I want to pick up on that point because, you know, streaming has really upended the industry. And how are you talking about those contracts? Like you were saying, redoing all those contracts to account for streaming?
Yeah, you know, we just had a very successful negotiation with Netflix. And then the AMPTP wanted to work on a fragment of the theatrical negotiations that we're about to go into with them in 2023. I'm organizing my negotiating committee right now for all of the other aspects of that negotiation. We began discussing the Netflix negotiation. The union was talking about, for me, what sounded like incremental alterations to an existing contract. And I saw a convergence of opportunities that would probably not come along for a very long time that needed to be leveraged with a great deal of strength and conviction right now, or forever be chasing after a different kind of a contract that's always just outside of our grasp. We really used our legislation that we had in the state of California. During the negotiations, we had a lot of high-profile people meeting with our California representatives who were instrumental in pushing forward the particular bill called the Law Act, Let Actors Work. And I myself went on one of the hottest days out to Glendale to meet as well. We were very lucky that they heard us. They understood that we were the underdogs in this equation. They felt the truth of the matter is that when an entire industry changes and the rules of the game change on behalf of the employer, changes are going to have to trickle down to the employee as well. You can't have it both ways.
I want to pick up on that point too, because, we know about all the big players in Hollywood, right? Like we were just talking about Scarlett Johansson. They're already making millions, but the reality is that most of your members, they're not A-list. They don't get the big paychecks from Disney. They're part-time, they're stand-ins. Can you give us some perspective
Well, and
on
also,
that?
yes, of course, it's all about the journeyman actor. All of these negotiations, because people like Tom Hanks, they're not really impacted by this stuff. They make their own deals. And even people like Scarlett Johansson are given allowances to do other jobs if they want her. You'll see a lot of very famous actors that appear on multiple shows. And they're given that allowance because they're promotable and they get an audience, and the producers give them that privilege. So it's always kind of the journeyman actor, the middle class, that always is getting squeezed. And that's really why unions exist, to protect and defend their rights, because employers understand that they desperately want to work. We need to always honor and respect them with a very fair and equitable arrangement.
The Nanny film reboot, yes or no? You in or you out?
It's in the talking stage. I would definitely be in. And, we'll see what happens. There's a Broadway musical in the pipeline. And so, it's the gift that keeps on giving. And for that, I'm very grateful. We have an Anna's for the Nanny book at Cancer Schmanza for all the fans. 100% of the proceeds goes to Cancer Schmanza. And we have new fans now from HBO Max that are children, tweens, and teens who weren't even alive when we were shooting it.
That's amazing. Definitely a new generation enjoying that show. Fran Drescher, thank you so much for being here.
My pleasure. Be well.
All right, now a check of how stocks ended the day here on this Monday afternoon. Dow is up 1.86%. That is good for, let me get the grand total here. That is good for 550 points. S&P 500 up a little bit more, about 2.5%. NASDAQ up nearly 3.5%. And you can see just barely clawing back those losses that we had from Friday, but still up 25 basis points or 1/4% over that time period. Now, here's our sector action for today. Retail stocks, especially those discretionary ones, really getting a boost today. That is up, that sector up 4% in the S&P 500, followed by real estate, tech, and communication services. A lot of those mega caps present in these sectors here, plus real estate. To the downside, Staples still above 1%, although it is the least favorable sector today, followed by energy, healthcare, utilities, industrials, and then materials. And I do want to get a check on our meme stocks, because as a sentiment indicator, we are seeing a lot of risk, not aversion, kind of the opposite here today. But as we've seen over the prior few weeks, in fact, much of the year, it's been risk on one day or 2 days and then risk off the next. So Tuesday going to be very critical this week. And we got a bunch of earnings tomorrow, from Goldman Sachs in the morning to Netflix in the afternoon. All right, we want to get a check on the EV market. Tesla, that is up 7% today, coming off some pretty heavy declines. Here's a 1-year look. Now you can see making new lows for the year, taking out those May, June, July lows very recently. And we can see coming off of $219. We're going to have to see if anything comes of this, but a giant pennant formation there in Tesla over several years. So we've seen these before, and we'll probably see them again. Before I go, I do want to get a check of the travel sector today, where you're seeing some big outsized gains from Airbnb, that it's up 6.5% today. Expedia up over 5%. So some of the travel booking names doing well. Now the airlines, they're doing well. United is up over 1.5%. American up about 0.5%. And it looks like Hilton, that stock is up about 3%, guys. We're going to be right back.
Up ahead, the Hollywood blockbuster is alive and well. We'll speak with legendary film producer Jerry Bruckheimer about the wild success of Top Gun Maverick and the next big thing to hit the box office.
Jerry Bruckheimer is one of the most successful film and television producers of all time. A consummate risk taker, Bruckheimer has redefined the Hollywood blockbuster and television entertainment. From Beverly Hills Cop to Pirates of the Caribbean, his films have grossed an estimated $15 billion at the box office. And after more than 4 decades on top, Bruckheimer is still smashing records. His latest blockbuster, Top Gun Maverick, is his biggest movie yet. It's also Tom Cruise's highest-grossing movie ever. Bruckheimer's productions for the small screen are no less impressive. His scripted and reality shows have been among the most popular on television for decades.
Jerry, thank you so much for joining us.
Thanks, Allie. Thanks for having me. It's a pleasure.
Yes, so first of all, I want to start with Top Gun Maverick.
Really? I wonder why we would start with that.
Did you ever think it would be such a smash?
I always hope for the best, expect the worst. So it worked out really well for all of us.
Why do you think it was so big? It really created a moment when I think people needed it the most, and people hadn't been in theaters in a long time, too.
You know, it's a big, entertaining movie with, you know, great cast, great people behind the camera. Joe Kosinski, Tom Cruise is a force, Chris McQuarrie, who worked with us as a producer and a writer, and the rest of our writers. And you know, it was just a great experience across the board. Tom is the hardest working person you'll ever meet. He cares, he loves to be on a set, first of all. He cares about every single moment, about every single performance, not only his, he's all over everything. And he's a much better producer than I'll ever be.
Really? And your relationship with Tom goes back a really long time, too.
He was like 20 years old when we first started with him.
I remember hearing a story about how he was actually one of the only people in the original Top Gun who could deliver lines from the cockpit.
Well, that's how he learned to make Top Gun Maverick a lot better, because he decided that we have to train all the actors for 3 or 4 months prior to filming to get him used to the G-forces. So we started him in a prop plane, very easy, then an aerobatic prop, then we put him in a jet, and finally in the F-18. So they were accustomed to taking 7-8 Gs, which when you see the movie, you see the look on their faces. That's all, they're not acting. But the hardest thing for these actors, including Tom, you only see a third of their face. So all their acting comes from their eyes. So it's fascinating. They got such great performances, and it was so difficult for all of them because we'd shoot them they'd stay up there for about 2 hours. We couldn't see what they were doing. They'd come down, we'd look at the footage, and then we had to send them right back up again if it didn't work. And they had to turn the camera on themselves. They had to know where the sun was because they had to match other aerial stuff that we did. So it was really an exhilarating and scary proposition, and they were beat up, let me tell you. Dealing with those G-forces, it's really, really difficult.
Well, and kind of to that end, you know, those in a theater, it really plays particularly well, right? Like the intimacy of those shots where you really see their eyes. Do you think that's part of why people were so excited to see it in theaters?
Absolutely. I think the fact that we did it for real, obviously the explosions, some other things we couldn't do for real. But what's really the reason that people have gone back multiple times is the emotion. It's about the emotion and following these characters and watching Tom's arc through the movie. The guy who starts out very lonely, at the end of the movie, he finds a family that he can be with. So that is the emotional core. And then you have Iceman in there, Val Kilmer. And Tom said, I'm not doing this movie unless Val is in it.
Which is one of the most moving scenes in the movie. Was that logistically complicated and a logistically complicated shoot?
The logistics weren't hard, just to get the performances. And what journalists and everybody don't really understand is how good Tom's performance is and Val's performance. But Tom, through the whole movie, his understated performance is just absolutely brilliant. And the fact that we had the best technicians in the business, from the cinematographers and production designers, editor. I mean, Eddie Hamilton, who edited the movie, he had 814 hours of aerial footage to go through. He had 26 hours of just carrier footage. And all he cared about was finding the very best shot. And all that footage. Can you just imagine when those dailies come in, how much time he had to put into editing the movie? But again, it comes down to the writing, performances, and the emotion. It's always about the emotion. A lot of people can shoot great action, but if you don't have the emotion, you don't have a great movie.
You are somebody who has made movies people love for decades. You've stayed on top for so long. What is the secret to understanding an audience?
I don't understand them at all. I really don't. I just know what I like, and make movies that I want to go see. Someday that'll change, but fortunately it hasn't.
And in terms of sequels, have you and Tom talked about Top Gun 3?
No.
No, not yet.
No, not a word.
And as you're thinking about the movie theater model, did Top Gun Maverick prove that it's alive and well, or was it an exception?
No, it's alive and well. You just got to make movies that embrace an audience. And unfortunately, the pandemic, we weren't making a lot of movies that really could play in theaters. Streaming has its place, theaters have its place. I always use the analogy, you have a kitchen, right? Mm-hmm. But you like to go out to eat. So it's not always you want to stay home and watch something on television. It's a group experience. It's exhilarating when you go to opening weekend and people are cheering and applauding for the right type of movie. And that's what happened with Top Gun. I went all weekend, the first weekend, and stood behind the seats at the Chinese theater and I'm watching the movie in IMAX and watch how exhilarated the fans were at watching that movie. And when you talk to people, most people haven't just seen it once. They've seen it twice or 3 times. One person wrote us, he'd seen it 100 times. So it's that kind of an experience you want to give to audiences every time you make a movie. Obviously, we can't do it, but every once in a while we get really lucky, and we had the right people involved at the right time for the right audience. And the fact that we held it for 2 years was the best thing we could ever do. And the audience was ready to come out. I think this is the first movie where an older audience felt safe going into the theaters. A lot of people who saw the movie said, this is the first time they've been in a theater in 2 years. So it got them out because the people who saw it back in '86, '87 wanted to go back and see what we did. But you know what? They had their arms crossed. That was such a good movie. I know they're going to screw it up. So we had to overcome that first. So I think when you first hear that gong and you see those jets taking off, they relaxed a little bit.
This movie made a killing without China, without Russia. Does that prove that there could be a future for Hollywood without China and Russia?
Well, we'd love to have them. Unfortunately, the world politics, we can't get there right now. Hopefully that'll all change. Look, we'd love the whole world to see our movies. We make it for the whole world. The fact that Top Gun Maverick has made more foreign than domestic, you can just see how there's a worldwide audience for what Hollywood does. And even on a very American subject with American Flyers, they loved the movie because it was a great experience. It was something that you felt great when you walked out. It took you away from your problems for 2 hours, and that's exactly why I make entertainment.
Do you feel audience has evolved over time? And as you think about your audience now today, is that different than it was 20 years ago?
They just want to be entertained. That's all. That's all. Get them in the seat, entertain them, make them feel something. It doesn't always have to make them feel good, but give them completion at the end.
Well, and give them emotion.
Always emotion. It's always about emotion. The reason Bad Boys was such a big success, it was the biggest picture of, 21 or 20, because it was an emotional story.
You're working on Beverly Hills Cop 4 right now with Netflix. Is there a difference between producing for a studio or a streamer?
It's all for an audience, and that's what we key on. We want to make the audience enjoy what we do. And there's an audience at home, and there's an audience that leaves home and goes to the theater. But Top Gun is a movie you really have to go see in a theater. I mean, it's done phenomenal in streaming so far. It's been just great. I think it's the #2 of all time already. And it's something that when you watch it, you want to see it again because you felt so good.
And for you, sequels are where it's at right now, a lot would say. You have Beverly Hills Cop 4. We haven't talked about Top Gun 3 yet. Bad Boys 4 is reportedly in the works. For you, are there any other sequels you're thinking about right now?
Well, we hope to do another Pirates.
Really?
Yes.
That would be awesome. Kind of to that end, you are a risk taker, right? Pirates wasn't obvious initially, right? Do you feel, what's your relationship to risk taking, and do you feel like Hollywood has stopped taking risks?
Well, that's the financial people, it's not me. I love making movies that I think that I want to go see, and hopefully an audience will agree with me. And it certainly happened with Pirates. Was another movie you can talk about that people had their arms crossed when they walked into it. First of all, it's about a theme park ride. 2 other movies about theme parks ride just recently failed. So us coming out there, they say, oh, we're looking for this one, we're going to shoot arrows at it. But when you get a great performance from Johnny Depp, and it was just took people by surprise because of the humor and the wonderful character that Johnny created.
the soundtrack to Pirates,
Right.
became completely iconic, right? A lot of the soundtracks of your movies have become completely iconic. Do you think about soundtrack a lot as you're working on a project?
It's important. It really is to get something that's works for the movie and is also something that creatively is unique and different. And the Lady Gaga song, we have all the different ones that we put in our movies, and working with Hans Zimmer and Lauren Banff and a lot of the other composers that we've worked with, Harold Faltermeyer, they're all great artists. And look, I think our company, what our secret sauce is we know talent. We understand talent, and we seek out new talent. And we look at it from a wholly different perspective. We see things differently. That's why our movies are a little different.
Talk about that different perspective a little bit.
I wish I could tell you. I'd sell it and give it to somebody else and go to Hawaii and not even worry about it. But it's something that the way we work so hard at everything we do. We find these new directors. We're doing a picture right now for Disney Plus with Daisy Ridley called Young Woman in the Sea. It's a fantastic story about a swimmer back in 1926. But the story is that a ferry went down in the early, I think, 1919 or 1920. 3,200 women and children were killed, drowned. So the mother, this German immigrant mother, said, my 2 girls are going to learn how to swim. The father was totally against it. It was uncouth for women to swim. And the one daughter took to the water. She was amazing. She went to the Olympics. She didn't win, but she decided to swim the English Channel. She tried to swim it once. She was poisoned because the coach had tried it 21 times and failed. It was embarrassed that a woman could beat him. And then she swam it again, and not only did she swim the English Channel, first woman to do it, she beat the male's record by 2 hours. Extraordinary feat. She had the biggest parade down Fifth Avenue for an athlete ever, including today. So when you see the footage, we have the real footage in the film, you won't believe how spectacular it is.
When you looked at that story, how did you know it was something you wanted to do?
I like to tell stories about people that were forgotten in time and made a difference. We did it with Remember the Titans and Glory Road and Black Hawk Down. So this is another movie that fits into that category. The same thing happened with the first Top Gun. There was a TV series that was on the air that failed about aviators. And the conventional wisdom was that no movie about flying could ever be a success. Same thing with pirate movies. So many pirate movies that failed. But you look at it a different way. And Top Gun, we looked at it a different way. We gave you the real experience. We tried to on the first one. We didn't succeed, but the story was so good that you got away with being on a gimbal a lot. Where in this one, they're flying, they're up there. Those actors are really in those planes.
So CSI Vegas season 2 just kicked off. You are as big on television as you are in the movies. You know, what's the future of TV look like for you? Do you approach TV any differently?
No, it's about entertaining audiences. That's it. It's about getting people to enjoy what you do. And I like to do shows that give you an inside look into a world you'll never be a part of. CSI is part of that. We have a new show called Fire Country, which was the highest rated new show. Just came out 2 weeks ago. And the ratings actually went up in the second weekend. So it's a new show. And it's giving you an inside look into what firefighters do. And you know, CSI gives you a good look at what CSIs do. And Top Gun gave you a great look at what aviators do. But I guess it's what we call process. I love giving people process.
I have to ask, is there an area that you've been curious about that you haven't explored yet on film?
I think an all-out comedy would be fun to do. We haven't done one of those yet, but maybe someday.
I do want to talk a little bit about your part ownership of the Seattle Kraken.
Right.
Tell me a little bit how you approached that, how you knew you wanted to own an NHL team, and what to you it means to be a good owner of a sports team.
Hire good people. That's what a good owner does. And we have a fantastic group of people running the team. And David Bonderman, who financed, who was the big lead investor on it, he's just a great gentleman and really supports what the management wants to do with the team. And surround yourself with good people, you're never going to fail.
What's the secret to Jerry Bruckheimer? You've been on top for so long in an industry that's famously fickle. How have you done it?
Hard work. That's it. It's a Sunday. I'm here with you. Or Saturday, and I'm here with you. I even lose track of time. I was in London yesterday. I just got off a plane at midnight last night, and here I am doing an interview. So, and then I'm jumping on a plane to go see a Kraken game tonight. But do what you love. That's it. I love what I do. I love going to movies. I love sports. I love hockey. I love being involved with great people and being supportive and trying to do as best we can do. Again, entertain. Listen, hockey is no different than making movies. It's entertainment.
And how did you know when you were good at producing movies?
I think I started when I was a little kid. I was like 10 years old, 11 years old. I put together a hockey team. I put together a baseball team. So I was always good at organizing things. And I didn't have winners, but it was fun doing it.
For anyone out there who admires your career, do you have any advice you give?
The harder you work, the luckier you get. But what it is you have to find something that you love doing, A, and B, that you're good at. A lot of things I'd love to be a professional hockey player. I'm just no good. Or a lot of things I'd like to do, but I'm not good at them. Find something you love doing that you're good at and pursue that, rather than dream about being something that you might not be very good at.
Thank you so much.
Thank you.
You're watching the 2022 Yahoo Finance All Market Summit. Up next, we're joined by one of the biggest names in media, Paramount Global CEO, Bob Bakish.
Paramount CEO Bob Bakish leads one of the world's top media and entertainment companies with a powerful collection of brands from CBS, Showtime, and Nickelodeon to MTV, BET, and Comedy Central, and not to mention one of the most storied Hollywood studios, Paramount. The media and entertainment industry is going through a complete rewrite with quote-unquote new normals triggered by COVID-19 and shifting consumer demands. Bob Bakish joins us now to discuss that and so much more. Bob, thank you so much for being here.
Great to be here.
All right, I want to start first with streaming and Paramount Plus. We've seen this roller coaster focus on profitability, these subscriber slowdowns, but Paramount Plus, they've been killing it. 43.3 million total subscribers. In your view, what has Paramount Plus done right, and what do you think it still needs to work on to be in that top of the streaming wars?
Yeah, so we're thrilled with the performance of Paramount Plus. And when we launched the product a year and a half ago, and it was a rebranded version of CBS All Access that we built on and expanded, people said, you're too late to the party, you're too small. And we looked at it and we said, well, wait a minute. We think there's an opportunity in the marketplace for a broad service, and we think that really leverages our unique portfolio of assets. So we came to be news, sports, and a mountain of entertainment, and we put really the weight of the whole company behind that. And since then, through a strong content, through marketing, which leverages our platforms, through a tightly integrated distribution strategy, we went on to become much bigger than anyone thought. And in fact, if you look at 2022, we've led the industry in the US in subscriber additions every month this year, except February. And in February, one of our competitors had the Super Bowl and the Olympics, and okay, we were number 2 that month. But other than that, we've been number 1. So we're growing very quickly, and we're extremely happy, and we see a great road ahead for this service.
And you confirmed earlier reports that there are talks to potentially combo Paramount with Showtime. Have those talks advanced in any way, especially with the departure of David Nevins?
So we're focused on developing a compelling consumer proposition and, by extension of that, a compelling distributor proposition. And when we launched Paramount Plus, at the core, we said our advantage is broad. So, and when you look at that, every month we prove that right. The combination of news and sports, having the NFL back is awesome, having UEFA is awesome, mixing that with Paramount films, which, by the way, we've had 6 #1 films
I want to talk to you about
this year.
Yeah.
Adding the fall to slate with CBS, which we won 5 of 7 days last week, and we have the top 1, 2, and 3 new show. And then, of course, adding our robust library and ongoing production from our cable networks. It really is a compelling combination. With vis-a-vis Showtime, we use Showtime in a number of ways. Internationally, it's integrated into Paramount Plus. We felt that was the right way. We didn't have a standalone Showtime, if you will, linear service. So the brand wasn't quite as developed. We thought that's a compelling proposition. In the US, you can buy Showtime separately, OTT versus Paramount Plus. It obviously has a linear service. It has a well-developed brand. And we're happy with how it's doing on a standalone basis. A while ago, we introduced a price bundle, which was you can have Showtime and Paramount Plus together at a modest discount. And we're pleased with that. Last month, we introduced an app with Paramount Plus with Showtime inside as an option. So instead of a price bundle, you now have one app and you get the benefit of the Showtime content should you choose. We've been very happy with the take rate there. And I can tell you, I use that version of the Paramount Plus app, and it is yet again another proof of broader is better. As seeing those Showtime, whether it's the originals or some of the movies in the carousels mixed in with the other Paramount Plus stuff really works. So again, what are we focused on now? We're focused on how do we make a more compelling consumer proposition, and how does that aid in getting distributors even more behind our product. So we're looking at optionality, and I don't know exactly where it's going to go, but I can tell you our product will continue to get stronger. It'll continue to evolve, and that'll bring down churn, and it'll continue to grow the sub base.
Are you using those bundled offerings that you were just talking about as a sort of test to see what a combination service could bring to the market?
Well, absolutely. We're getting more data every day on Paramount Plus on a standalone, what works under the covers, how does sports content interact with films, et cetera. We're seeing how the bundle performs on a price basis. We can look at variability in pricing. So yeah, we learn more about streaming every day, and that informs our going forward plan.
You mentioned pricing. I want to pick up on that. Pricing has gone up for a lot of these streaming competitors. We got the news recently that the Netflix ad tier that's going to be $6.99 in the US. Where's that sweet spot for you when we think about pricing relative to competitors, but also wanting to make sure that you're not leading to increased churn?
Yeah, sure. So a couple points on pricing. One is streaming represents an extraordinary value in general for the consumer. Point two is within that, Paramount Plus is not the price leader. We are very much a value offering. We tuck in under, say, Netflix, under HBO Max, et cetera. Point three is, in general, and you've already seen this start to happen, streaming pricing is going to go up. One of our competitors just announced a 30% price increase. Netflix has raised price multiple times. So the price umbrella on streaming will go up, and we'll tuck in under that, and we will raise price as well. Can't tell you exactly when that'll happen, but directionally it's going to happen for sure.
So do you say you're watching competitors pretty closely when it comes to their pricing? Does that factor into your decisions?
We look at a lot of things. We look at the performance of our product with our consumers. We look at what competitors are doing. We obviously look at what's going on outside of streaming. All that gets factored into our decision making on our course of action for streaming and the business at large.
And when we think about content, you were mentioning sports content. Obviously, Paramount Plus has a ton of kids content, but there still seems to be a need for this buildable franchise type of content across the sector. So what do you think will be key for your content strategy moving forward?
Well, you just hit on something, the word franchise. One of the things that Paramount Global brings to consumers is a deep collection of franchises. And it's certainly core to our strategy in general and with respect to streaming to leverage that. Look at our Paramount film slate. More and more tilted towards franchises. Why? Because they have built-in fan bases and you can evolve the storylines. Same thing in linear television. Franchise. Look at CBS this season. FBI Night crushed it, multiple FBIs. NCIS crushed it, multiple NCISs. So franchises are key. In the kids space, Paw Patrol. We did our first Paw Patrol movie last year, killed it. We're doing another one next year. SpongeBob, we've done derivative product from that. Camp Coral, et cetera. And then, of course, Yellowstone, the biggest show on television. We brought the world 1883 last year. We're bringing it 1923 this year. And actually, we're doing some more stuff with Taylor Sheridan, who's the writer of it, including Tulsa King with Sylvester Stallone. Franchises work, and we have an incredible collection of franchises in our company. So yeah, they're part of our streaming play for sure.
And besides streaming, you guys have also heavily invested in some unique partnerships, the Walmart Plus being one that immediately comes to my mind. So what's the benefit of a partnership with Walmart, and what other types of partnerships are you actively exploring?
So we've been in business with Walmart for a long time. You know, we sell consumer products with them. We distribute home entertainment with them. I know Doug McMillon, the CEO, well. And there was a point, I guess it was last year, where they started thinking about the evolution of Walmart Plus and having a video service. And we were naturally interested in expanding that partnership. And it really is a partnership. We're not investing in Walmart Plus per se, but we are the video offering in it. So if you're a Walmart Plus consumer, and you decide to opt into a video service, you get Paramount Plus. And we think it's a great model. It's early days. It launched in September. But we're already through what we thought would be our year-end forecast number. And that it is a tremendously powerful retail. They have 140, 150 million people going through their stores in the US every week. And then they got about 1.4 million employees. All of them can opt into Paramount Plus. So we're thrilled with the partnership, and it's off to a great start.
And let's talk box office. You mentioned your successful film slate several times. In this environment, how do you determine which film can go direct to the theater or which film you might want to go direct to streaming on Paramount Plus?
Well, we had a different point of view on films and streaming going back to COVID and going back to Paramount Plus. When COVID hit, a lot of people said you should put all your films on streaming, or at least day and date on streaming. We said no. We believe in the theatrical window, and we believe in it both to give the audience the chance to have that big screen experience and participate in those economics, and then we can move to streaming. So we adopted what's known as a theatrical and 45-day fast follow to streaming strategy. That's our default strategy. And because it was in COVID, that resulted in us holding certain films. As a result, Top Gun Maverick, we moved that date 5 times because we said this is a big screen movie and it should be in the theaters. And I'm glad we did, because that turned out to be a good call. I think the theatrical with 45-day fast follow, which by the way, on Top Gun, we're going a little bit longer than that by the nature of the film. 20 weeks later, it's still in theaters today, and it was the only film in history to be #1 on Memorial Day and #1 on Labor Day. So, and having a longer theatrical run makes sense. But in general, we like that strategy. I think that's the sweet spot of ROI, particularly with respect to films. And that is very much our going forward strategy with Paramount.
Yeah, so with Top Gun, you guys demonstrated your ability to pivot. I want to talk about the Wall Street sentiment of it all. There seems to be a lot of doom and gloom right now. You're a bit more optimistic, but when we take a look at Paramount's stock price, it's down more than 40% year to date. You have some downgrades on the street. How do you convince analysts and investors that these macroeconomic headwinds, the decline of cable television, the uncertainty surrounding streaming margins, are not concerning to your fundamentals?
Look, I don't think there's a lot of people walking around that's happy with the state of the markets. I mean, they're up today, but in general, it's been a rough half year with respect to equity valuations and certainly our company stock. Worth noting, on a relative basis, relative to some other media companies, we've actually done better, i.e. less worse. But nonetheless, there are concerns on the street. There's concerns relative topics. My view is you have to decide what you believe in and play through. As I said, in theatrical, people said, release it direct to streaming. We said, no, we want to do theatrical and then streaming. When we did Pluto we closed in early 19, we showed up and talked about it. People said, what's that? That's a joke. By the way, it had 12 million MAUs and 70 million in revenue. 3 years later, it had 70 million MAUs and over $1 billion in revenue. And now everybody's like, whoa, this fast category is really cool. But if you listen to the street and you listen to others, you would never have done it. So you have to decide what you believe. The two concerns in the street right now are advertising and streaming profitability. Advertising is a great business, and we have a fundamentally strong position in it. Our combination of linear reach, particularly with a broadcast network, plus the #1 fast service in the country in Pluto TV, gives us a great reach expression for advertisers. Add to that, it's all wrapped around great creative content that people love to be associated with, NFL, Survivor, FBI, Paw Patrol, what have you. Add to that advanced ad capabilities and an ability to do all that business on a turnkey basis. It's a fundamentally compelling proposition, and we will demonstrate it again. Second question people are worried about is streaming profitability. We've always had a plan to build a robust streaming business, but a profitable streaming business. Our business is only a year and a half old. It takes a little while. We always said peak investment year is 2023. It still is. But we are building a business that we see as over time having TV media-like margins. And we are tracking according to our plan. So are there concerns on the street that have negatively impacted valuations? Yes. Do we have to play through and deliver and continue to have the momentum we're showing? Yes. And ultimately, that represents a great value opportunity for people.
All right, well, you heard it here. Thank you so much, Bob, for covering all those topics with us. Bob Bakic, Paramount CEO.
Thank you.
Coming up, investing in a high interest rate environment. Billionaire private equity CEO Robert Smith joins us next.
It is one of the biggest enterprise software conglomerates in the world, and it's in private hands. Vista Equity Partners has more than $94 billion in assets under management, with a current portfolio of 85 companies, and it's still growing, recently striking a deal to buy cybersecurity firm KnowBe4 for $4.6 billion. Joining us now is the founder, chairman, and CEO of Vista Equity Partners, Robert Smith. Thank you so much for being here.
Thank you, Julie.
It's
Thank you
great
for inviting me.
you
Good to see you.
Yeah, you too, in person.
Yeah.
So obviously you have a big reach of your portfolio companies, all of those companies that I mentioned. So you have a lot of insight into corporate spending on technology right now because they are business to business largely. What are you seeing right now? What are you hearing from your companies, from your clients? And does it feel like from where you sit that we are on the cusp of a recession?
Yeah, great set of questions. I think importantly, enterprise software still is viewed as the most productive tool introduced in the business economy the last 50 years, like it will be for the next 50. So, in an environment where there's wage inflation, a lack of developer talent, challenges related to cyber attacks, companies are actually increasing, in many cases, their spending in enterprise software. Now, overall, again, we're about $24 billion in revenues across our entire platform, which, think about as maybe fourth, fifth largest enterprise software company in the world. And we have over, I think, 350 million users of our software. When we're looking at what the spending dynamics have been over the last year, over 25% kind of bookings growth, we're seeing kind of 20 to 25 now. So we're seeing some slowdown in certain sectors and, frankly, acceleration in others. Things like low-code, no-code environments, things for productivity. Things for anything around, cybersecurity to protect the enterprise. Those are the sorts of dynamics that we're seeing. So am I seeing a broad slowdown across our platform? No. Are we seeing some pockets where we actually see it? Yes. Typically, those would be in any of the B2B2C, any of those consumer-oriented businesses. You'll see a little more slowdown. You're not seeing people buying as much in the future as they used to, which you saw in some of the Apple and some of their numbers, et cetera, where some of the companies that we focus on really, this mission critical, a business critical enterprise software continues to be in demand and robust demand for the most part.
Is there a point you see in the future? Is there a point typically in these kinds of cycles where you do start to see that pullback? I mean, to be fair, when we were in the financial crisis in that recession, the enterprise software industry was not as developed as it is now. So I'm not sure we have a perfect analog. But what are you expecting to see?
Great analysis. So if you look at 2014, 2018, coming out of that great financial crisis, there's about 10-12% of the companies were in what we call a native cloud environment. Today it's closer to 35%. As a result of that, these companies grow faster. The productivity tools that they're delivering can be delivered more effectively, more efficiently, and so the utilization rates of them has actually been enhanced. The other thing that's actually quite interesting is the productivity dynamic. As you know, in the U.S. today, we've actually decided to effectively close our borders. And I like to say, the most scarce commodity on the planet isn't oil or lithium or cobalt. It's actually software programmers. There's 7.5 billion people on the planet. There's only 29 million of us who write code for a living. And these are the people who are actually providing and building these productivity tools that have to continue to enable and digitize not only companies, but entire economies and countries, in education and cybersecurity. Those are the areas that we're actually seeing that increased demand. Now, all that said, I still think that you're going to see the downturn in some of the consumer, interest rates go up. People are buying fewer and fewer, phones and cars and those sort of consumable devices, probably making decisions between, do I fill my gas tank with fuel or do I buy another consumable device? But in the business segments, businesses have to continue to think about how I can do more with less, and software is one of the ways, enterprise software is one of the ways that they're going to continue to embrace it. So is there going to be a slowdown in certain segments? I will argue in Europe in particular, I think we're going to see a more advanced slowdown in many other economies. We're not seeing it as much in the U.S. as we sit here today.
Are your portfolio companies doing any kind of preemptive battening down the hatches, so to speak, any kind of cutting in spending or hiring freezes, et cetera?
Yeah, not at this point. I mean, there's a few that actually, who have a little more consumer, what I call a little more consumer-facing orientation, who have to think about, okay, are we overbuilding in our sales capacity or development capacity? But for the most part, the companies we buy are typically, have a massive ROI. I think we talked about this before. Our average company, the products they sell to their customers, is a 640% return on investment. right? So if you think about that, almost anything else a corporation can do doesn't come anywhere near that kind of ROI. If you're doing any sort of, Six Sigma or Kaizen or, energy efficiency dynamics in your company, they're orders of magnitude below or multiples below that 640%. So corporations are continuing to advance in their spending. Now, in our companies, in cases we're thinking, they may not expand as much. Sure, you've got to think about, do you hire fewer people? But for the most part, the vast majority of our companies are still, meeting their annual operating plan, which includes, hiring. Our average company increases its organic employee growth by about 20% from the time in which we buy it to the time in which we go to a monetization. So that really hasn't changed at this point.
I want to turn to sort of your acquisition strategy. I mentioned No before. That's a leveraged buyout.
Right.
So was the Citrix deal, which was earlier this year for $16.5 billion. Big deal that you did with Elliott. The lenders behind the Citrix deal reportedly then when they turned around and sold the debt, they had to do so at a discount because we've seen some big changes in the funding environment. So how is the funding environment changed?
Sure.
And was it tough to get the No before deal financed as a result of those changes?
Sure. I mean, you've got two markets in essence that we think about. There is a syndicated debt market and we call the private debt market. And the syndicated debt market that Citrix was part of, I think there were 30 banks involved. So, the exposure of one of them was actually, modest, relatively speaking. But, it was a fully underwritten deal, fully priced from our perspective, and they go through distribution. Most of them ended up keeping it on their balance sheets because they know the work that we do and the value creation dynamics that will actually, bring those bonds back to par, and in essence they'll be get tidied up at the end of the day. If you think about the private market, that private market has emerged over the last 6-7 years as being quite robust. But it went from 10 or so lenders to now about 30 or 40 in that space, and so you may have to go to a few more, but we still see the ability to get deals like No before done, Avalara done in these private markets, as opposed to relying on syndicated debt markets. So that's a dynamic that we're seeing in the marketplace.
And what about on the other side? You mentioned exits.
Right.
Are any of your investors getting a little antsy here? Because it's tough to have exits right now, right? We were talking before we came here on set about the so-called class of 2021, the companies that came public last year. By and large have not done so well. It's a tough environment.
Right, it is. And part of what we do is we focus on a couple of things. We do them really well. A, valuation going in. So, we maintain a very strict price discipline in the way we invest. And just to give you some round numbers, we focus on what we call a growth adjusted revenue multiple. 2014, 2018 growth adjusted revenue multiple in the marketplace was about 0.43. When we went through this massive capital expansion in 2020, where I call it every central government on the planet decided to really flood the market with liquidity to make sure that their economies didn't go into a recession during the beginning of the pandemic. I call it created a lot of capital and a lot of ambition, right? A lot of funds put a lot of capital to work above what I call that normalized level. We were very disciplined and actually didn't have any that we did in above that level. We're still able to deploy massive amounts of capital, over $18 billion invested in that period of time. Now, all that said, it's still in a down economy that we're seeing today. We've just now completed, we announced yesterday, a company called Aptian that we sold. In that sort of environment, if you build high quality companies, we have the ability at that point to actually sell these companies in these down markets. So in the last 12 months, everything from Mediaocean to Datto to iSIMS. I mean, these are businesses I think we've done a great job in building the capacity of those companies to do really well. And of course, Aptian is one we just recently announced. And of course, the sale of Ping, which we completed, which I think closes the next week and a half or so.
So you guys have still been busy. I'm curious what your advice to retail investors would be when it comes to tech stocks, right? You obviously see some good valuations still out there. Right. Do you think that retail investors should be looking at tech stocks right now?
The way I like to say, not all tech stocks, of course, are created equal. Enterprise software, if you look at the earnings of a lot of the enterprise software companies, they actually are holding up pretty well. Now, their stocks continue to get hammered for a couple of, I'll call it, technical reasons. Part of which is they get pulled down by the consumer and the internet stocks. And you have, people who are, institutional investors, crossover investors who are creating public books. And in those public books, they had, consumer, internet, and enterprise. And if the consumer and internet books are down 50, 60%, and they've, levered that book up, they've got to meet those margin calls. Well, how do you do that? You sell into strength. So you're selling it into the enterprise businesses that have the float, have the capacity, et cetera. Our market is really interesting one because we're still, 70% 97% private companies. But in these markets, for us, as you've seen us, anytime we see downturns in the market, that's when we look at companies we really would like to buy and now have become what I'll call more affordable for the type of underwriting that we do, where we can bring our value creation metrics to it.
Let's switch gears a little bit. I want to talk about Morehouse and talk
sure.
about 2019 when you paid off the student debt of the graduating class from Morehouse. And then you ended up starting the Student Freedom Initiative, which helps to continue those sorts of efforts. But I'm curious to take a step back. Obviously, the Biden administration has done some student debt relief. Do you think we need a bigger overhaul of the student debt system in the U.S.?
I do. I think we need to rethink what it is that we want in our economy. We want productive students. We want them to be able to increase their quality and standard of life, again, relative to their parents. Everyone wants to see that level of improvement. And look, not all kids need to go to college in order to create a very productive standard of living. So I think we have to be thoughtful about that. I think the universities have to be, think about being responsible deliverers of high value education that can be used in work environments or entrepreneurial settings as part of what their relationship is with the customer, there being the student. The Student Freedom Initiative, which we set up, is basically a fund that in essence these students, they borrow money from so they can hopefully offset what I call the acute pain of parent plus loans, which I saw was pretty acute to the students at Morehouse. But when they pay it back, they actually pay it back into the fund that gets relent to the next generation of students. We focus on STEM students or HBCUs and MSIs or minority serving institutions, because we have to activate more of our citizenry here in America to be part of this digital revolution. STEM students have probably the highest possibility of participating in this digital revolution. So we want to ensure that we educate as many as we can and provide them with, the opportunities to, and on the other side of that, of course, is, internships and full-time jobs to participate in our economy. Again, that scarcity of developers, that scarcity of, technical talent, we need to address that, since we pretty much closed our borders at this point in time to immigration, which was one of the fueling dynamics in America to fuel our productivity. So we've got to turn to our internal resources, being our citizenry, to get them to enable them to participate in the economy much more effectively.
We're unfortunately running short on time, so I have one more question I want to ask you, and it sort of speaks to the last thing initially we were talking about. You're frequently referred to as the richest black man in America, right? And does that feel like a heavy mantle to wear, right? And what do you want your legacy to be with that sort of big moniker?
Yeah, that's a really interesting question. I think about it in the context of how I grew up. I grew up in a family where my mother and my father were very responsible citizens in the community. And that meant, providing fabric of opportunity. They were both school teachers, but they also were civically enabled. My father started, a North City Park Civic Association, was the chairman of the local YMCA. And, my mother and he worked on developing Head Start programs. And so they were very vested in the education in a segregated neighborhood of the kids, and giving them opportunities to improve their quality of education, quality of nutrition, quality of care, that I think really made a big difference for me and my family. So I think about it through that lens, and they had certain limited resources, very limited resources. I have a few more resources, so I'm delighted to bring organizational capacity, capital, and wherewithal to initiatives that I think are going to improve the standards of people on this planet and people in the communities that I come from.
Robert Smith, thanks so much for being here.
Thank you.
Really
good to see you.
appreciate it.
Yeah, thank you so much.
Coming up, a turning point in the war in Ukraine. Former U.S. Ambassador William Taylor joins us right after this.
Ambassador William Taylor is an American diplomat, government official, and former military officer. He was U.S. ambassador to Ukraine from 2006 to 2009 under Presidents Bush and Obama, and acting ambassador under President Trump. During the Arab Spring, he oversaw U.S. support to Egypt, Tunisia, Libya, and Syria. Taylor also served in various key diplomatic roles in Iraq and Afghanistan, and led U.S. assistance to the former Soviet Union and Eastern Europe. With that long and respected career, few American officials have more experience or a greater understanding of Ukraine and the threat Vladimir Putin and Russia now pose to the world. Well, Ambassador Taylor joins us now to discuss the Russian invasion of Ukraine and its effects around the globe. Welcome, Ambassador. First, for those who are tuning in, how would you characterize where we are in terms of the phase of the conflict, given these recent moves by Russia, the annexation, these civilian attacks, and of course, these Iranian drones as well, and the nuclear plant?
Yes, Rochelle. So, yeah, we're in a phase that is characterized by Ukrainians succeeding on the battlefield, and the Russians, desperate to change the subject, are trying to do other things. So President Putin, knowing that he's losing on the battlefield, is calling up reserves. He is conducting these referenda that you mentioned in parts of Ukraine. He says he's annexing parts of Ukraine. He's reminding us that he's got nuclear weapons. His problem, of course, Rochelle, is that he's losing on the battlefield. His soldiers are dropping their weapons in the northern part of Ukraine where they're fighting. They are abandoning their tanks. They're running away from the oncoming Ukrainian military, the soldiers. And so President Putin has a real problem on the battlefield. So he's trying to change it up. So far, unsuccessfully. His attempt to recruit more soldiers is failing. His attempt to placate the people on his right in Russian politics is failing. He sees the people in Russia fleeing the country. So President Putin has a real problem, Michelle, in all of these attempts to regain the momentum. He's failing in that.
And you mentioned an interesting word, which is desperation, which can push people into a lot of different directions. So as we talk red lines, the nuclear threat, how seriously is Putin considering a nuclear strike against Ukraine? And what would he be weighing in really making that choice?
So let me just say that I think the chances of the Russians using nuclear weapons is small, is very low. That said, when you have the president, the dictator of a big nation that has nuclear weapons, saying that he might use them in Ukraine, you have to take it seriously. And of course, the West does take it seriously. There's no higher priority for our intelligence agencies than to be sure that they have a careful watch over any indications in Russia that there's any preparation or any steps toward the use of nuclear weapons. So far, none. So far, there's no indication that they are taking these steps. We have to watch, we have to be careful, and we have to send the message to President Putin and the Russian military and the Russian people that there will be devastating consequences, catastrophic consequences, if they made a bad mistake, a bad decision, and used nuclear weapons in Ukraine. It would cost them dearly for all kinds of ways, which, to be clear, our government has made clear to the Russians. So that's an important part of deterrence. We don't want to see these weapons used. The Chinese and the Indians don't want to see these weapons used. The Russian people don't want to see these weapons used. And so that's the message that has to get through to President Putin. I think he must be hearing that.
So then you talk about what he might be hearing. Then what sort of conversations are likely happening within the Kremlin? You mentioned the oligarchs and the role that they play. What do you think is actually happening? Who's actually having Putin's ear at the moment?
You know, I don't think the oligarchs have his ear on military things. The oligarchs are probably telling President Putin that they're having great difficulty. Most of the big oligarchs that have anything to do with this war are sanctioned. They can't travel. Their assets are frozen. Their families can't travel. Their children can't go to school in England or in Great Britain or in the United States or wherever. The oligarchs are under sanctions, and they're probably expressing concern, expressing the fact that they're not happy about this. However, they're probably not the key voices in Mr. Putin's ear when he's thinking about his problems that I talked about earlier on the battlefield in Ukraine. Those voices are probably well informed. That is his interior, his intelligence services, his military, his defense officials. They're telling him probably what he wants to hear. So he may not be getting the best advice from them. He's a powerful man. They don't want to tell him things that he's not going to be happy about. So it's not entirely clear, Rochelle, in answer to your question, what he is actually hearing. What he can be sure of is that he's losing on the battlefield. And we know he understands that because he's calling up reserves. He knows his military is not doing well enough to stop the Ukrainians. Indeed, the Ukrainians are pushing his military back out of their country. The Ukrainians are pushing the Russians back out of Ukraine. And so President Putin has to call up a reserve. In order to do that, he has to be talking to his military and his recruitment services. So that message is clearly getting through.
And in terms of a red line for NATO, what is the tipping point that would perhaps have them escalate as they're seeing this escalation now with the drones, especially killing so many civilians at the moment?
So it's very, very clear to NATO what would happen if the Russians were to attack any NATO member. There's no doubt in the NATO members' mind. There's no doubt in the Russian mind, in President Putin's mind, that if the Russians were to again make this bad decision, this blunder, to attack a NATO member, that would ensure their defeat. That would ensure that would be like committing suicide. I don't think the Russians are totally irrational. I don't think they're suicidal. So I think, again, the chances of the Russians attacking NATO members is low. Can't discount it, have to be ready. NATO is clearly ready. NATO is building up its capabilities on its eastern front. NATO is providing weapons to the Ukrainians because that's the first line of defense. The Ukrainians are fighting the first line of defense. They are defending the rest of NATO, the rest of Europe, from the Russians. And so that's why the United States, as a leading NATO member, that's why other NATO nations are providing the weapons to Ukraine to defend Ukraine so that the Russians can't go further, can't go into Europe.
Now let's talk sanctions, another way that the West is trying to squeeze Russia. Now, we know that you have also pushed hard for these sanctions as well. But by all accounts, yes, it's affecting the economy, but it's not deterring Putin at the moment. What, if anything, would dampen his resolve at this point?
What will dampen his resolve, you're right, is not going to be sanctions. What sanctions are going to do is what you mentioned earlier, squeezing the economy. Sanctions make it more difficult for the Russian economy to continue to support this war. So that's the purpose of sanctions at this point. Make it hard for the Russians to be able to replace all these weapons, all these missiles, all these cruise missiles and guided missiles and airstrikes. All of those things cost money and all of those things need to be replaced. And the sanctions make it harder to replace. However, you're exactly right. They have not deterred President Putin from this attack. You ask what's going to deter him? What's going to change his mind? Continuing to lose on the battlefield. And in order for him to continue to lose on the battlefield, we need to continue to provide more and heavier and stronger and longer range weapons to the Ukrainians so they can push the Russians back out.
Now, in terms of assistance, I know you mentioned China, but you also saw OPEC Plus deciding to cut production of oil, which in turn benefits Russia, which benefits from that. But what do decisions like this, whether it's on energy or perhaps these purchases from China and India, what does that do not just to the effectiveness of sanctions, but really the dynamics with the rest of the world?
So you're right to ask about the dynamics of the rest of the world. One place where those dynamics play out is in the UN. Now, we know that in the Security Council, UN Security Council, the Russians have a veto, and they used it. So that they can stop action there, but they can't stop action in the General Assembly, in the United Nations General Assembly, where there have been a series of votes to indicate this dynamic that you're asking about, the dynamic in the rest of the world about where nations stand. The Russians have lost every one of those votes. The most recent one, Rochelle, was last week, and 143 nations voted to condemn Russia. 143. There were 5 nations that supported Russia, 4 nations plus Russia that supported the Russian attack on Ukraine. So 143 to 5. Now, there were some abstentions. Some 38 nations abstained. But it's very interesting. The Chinese did not support the Russians. The Chinese did not vote with the Russians. The Chinese abstained. The Indians did not vote with the Russians. The Indians abstained. So the Russians couldn't even get these nations, and they've got this partnership with the Chinese, and they can't even get the Chinese to vote with them in the UN. And the Indians buy a lot of weapons from the Russians, so they want to try to stay on the good side of the Russians, and they didn't support the Russians in the UN. Maybe they realize that the Russian weapons aren't so good after all. Maybe that's one of the reasons that the Indians, but when you look at where the international community is in terms of UN votes or in other things, you see that people are not, even the Belarusians. So President Putin is trying to lean on the president of Belarus, President Lukashenko, to support him, to support Putin in this battle, in this fight. And President Lukashenko really doesn't want to do it because the Belarusian people don't support the war against Ukraine. They're supporting Ukraine against Russia. So even this close ally is hesitant to support Putin. So this is all to say that the dynamics, the international dynamics, are against the Russians and support the Ukrainians. And Rochelle, if there were, going back to our earlier conversation about nuclear use, if the Russians were to decide to use nuclear weapons, they would lose all support, all support. They would be even more of a pariah than they are right now.
So when you look at what is going to happen in terms of any sort of pathway to peace and what the world looks like at the end of this war and the relationships between Russia and the rest of the world, how do you see any sort of path to peace going from here?
The path to peace, that's the right question. The path to peace runs through Russian defeat on the battlefield. The Russians have to recognize that they are losing on the battlefield when they try to fight the Ukrainians. The Ukrainians are pushing the Russians back out of their country. When the Ukrainians have pushed the Russians back out of their country, back beyond where the Russians were on February 23rd of this year, just before they started the invasion, when they're back toward the international boundaries that the Ukrainians want to reestablish, then President Putin probably looks for a way out and probably tries to come negotiate something. That's the way out. Eventual negotiations, when the Russians have been pushed way back into Russia, way back out of Ukraine, and then President Putin tries to salvage something from this horrible decision, this blunder. That's likely to be the path to peace.
Well, we'll see if that's a decision that Putin will take lightly. Obviously, a lot at stake here, and a lot of death, and a lot of people wondering what's going to happen next. We do appreciate you breaking down these dynamics for us, Ambassador William Taylor. Thank you so much.
John, good to be here.
That's our show today. We want to thank our great guests, our sponsors, Northern Trust and Grayscale, and especially you for watching. I'm Andy Serwer. Stay with Yahoo Finance for the best in business and financial news.